Ask Brett how to break bad trading habits and introduce new best practices, to explain why traders need to be adaptable in markets, plus how we should think about goal setting and measure progress. And of course, much more about how to enhance your performance as a trader. Now, if you do enjoy the interview, please go ahead and leave an iTunes review. Like I've said in the past, it literally takes you 2 minutes. You can do it while you're listening, and it really helps to boost our rankings in iTunes and attract more listeners. So if you'd like to support the podcast, please go to chatwithtraders.com/iTunes. Okay, folks, let's skip to the interview. You're listening to the Chat with Traders podcast, and here is a very special guest for episode 65, Dr. Brett Steenbarger. Brett, many people have been asking for this, so I have to say straight off the bat, thanks a million for being here. I appreciate it, and I know listeners will also. How's your day been? What's going on?
The day's been good. Thank you very much, Aaron, and I appreciate the opportunity to be here and to share some ideas with the listeners.
Sure thing. The pleasure is mine. So, as most traders already know, you are the go-to guy for all things related to trading psychology. So, of course, that will be the ultimate focus for our chat today. But starting from the get-go, Brett, if you could, give us a little insight to your background. Like, how did you get into the psychology field, and where did you initially start out after getting your PhD?
Okay, yes, the initial impetus for my entering psychology was an unconventional one. I came to psychology via philosophy. As a sophomore in college, I was interested in psychology and indeed had declared psychology as my major, but I never really considered it a career field until I read a novel called The Fountainhead by Ayn Rand. And that novel illustrated something that I hadn't encountered before, and that is the vision of people as heroic, as reaching their ideals, their potential. And the thought came to me, it was during a winter break in my sophomore year, the thought came to me that this was a proper role for psychology to not just treat mental illness, but to expand the best of people's potentials. And that's what has interested me in psychology ever since. And what I do now in working with traders and portfolio managers, and earlier, before that, working with medical students and residents in the medical field, it really has been working with healthy people, people who are bright and creative and energetic, and helping them make the most out of what they do.
Okay, great answer, and very interesting to get your backstory there. So where did the interest in trading come from? Like, when did that creep into the picture?
You know, the trading thing is something that I first expressed an interest in a project when I was in grade school, and later became more interested in a formal way during my graduate school education at the University of Kansas. And I actually opened a trading account and began trading individual stocks. And that was in the late 1970s. But that was completely separate from my interest in psychology. My degree was in clinical psychology, and my interest was in becoming a psychologist. The trading was a side interest, a challenge, and something I found stimulating and interesting. And those two proceeded in parallel for a number of years. I pursued trading as an avocation, and I pursued psychology as my vocation. And it wasn't until around the year 2000 that I seriously contemplated putting the two of them together and began writing a book. It was my first book in the area, called The Psychology of Trading, which was later published by Wiley. And that was encouraged by my good friend and mentor, Victor Niederhofer. So that's how the two came together. But up to that point, for a number of years, they were completely parallel interests. The book became popular and was discovered by a trading firm in Chicago. And they began asking me to work with their traders and then made me a full-time offer. So I left the academic setting that I was in. I was teaching at that time in a medical school in Syracuse and also running a counseling program, and went full-time to working with traders in Chicago. And that's when the psychology and the trading interest truly came together.
Okay, excellent. So let's talk a little bit about your time in Chicago. Like, what were you doing? Like, how were you actually helping these traders with the mental aspect, the psychology, and everything that goes on that side of the field?
Well, in Chicago, I was working primarily with market makers in electronic futures. These were people placing dozens, if not more, trades per day. So trading on a very short time frame. The average holding period for many of the traders was around 3 minutes. So they are very actively engaged in markets. And it fascinated me because they were trading in ways that were completely different from what I had read in the textbooks. The books on trading talked about technical analysis, fundamental analysis, and these traders who I was encountering in Chicago did none of it. Obviously, they did no fundamental analysis because the fundamentals don't change in 3 minutes. But technical analysis in terms of chart patterns and indicator readings, those were much too slow for these traders. These traders were entering positions and exiting positions very quickly, and they were working off a depth of market screen. They were working off the order flow, not backward-looking technical information. So that was an education in itself and sensitized me to the psychological challenges that they faced in making decisions so rapidly. It was easy for them to become frustrated, to become overconfident, and for all of those emotional factors to slant their decision-making. And so my work as a trading coach was to help them keep a level head, keep focused, and make good decisions in real time. And the fact that I was full-time working with them, and so on site, watching them trade and standing with them and helping them really helped the psychology become part of the trading.
Right. Yeah, that's very interesting, Brett. And we're going to dig deeper into that in just a moment. A question I have for you is, like, over the years, you've been in the field for a long time now. You've worked with many, top traders, like some very, very hard-hitting heavyweight traders, asset managers, fund managers, they're a pretty broad spectrum of market participants. Now, these aren't all guys who are struggling. Some of these guys are extremely profitable and make huge amounts of money. Why do they come to you for your help on the psychology side?
It's a great question, Aaron, and it's the same reason that successful professional athletes work with coaches as well. At that point, they're not struggling. They would have never gotten to that point for in a large majority of cases if they were marginal participants. So these are people with real experience, real strengths. But what happens is that markets are always changing. And even the most talented participants have to evolve with the markets. And that need to evolve itself brings its own psychological challenges. The need to be creative, the need to be resilient in the face of frustrations, and also the need to identify and build upon strengths. So many times, the portfolio managers are seeking me out when they are doing very well because they want to stay grounded in their strengths. They want to make sure they understand what they're doing well so that they can be more consistent going forward in making use of those strengths. And so that's the difference with working with someone who is struggling and wants to work on their weaknesses or vulnerabilities.
Okay, that's a great answer, and it makes total sense. I really like how you explained that. So, Brett, let's bring this up to speed now. What are you doing today? Like, what's your work involve, in current times?
Well, I work with several hedge funds and other financial firms. So I'm not full-time at any one place. I consult with a variety of funds. And what that's done is expose me to a variety of trading strategies. Some of those strategies are discretionary. Some are more systematic. Some of the strategies are more directional. Some are more based on relative value movement. Some are in macro markets, the big liquid markets, and some of them are very specialized in individual markets, such as commodity markets or rates markets. So I've been exposed to a variety of trading strategies and trading settings, and it's been a great education as a result. But in all cases, my main work is to help the traders, the money managers, with their performance, help them build on their strengths and help them learn from their mistakes so that they keep improving. A secondary focus has been at most of the places where I've worked, we've conducted internal research about what makes traders successful. And so I've been able to help the trading firms with their hiring processes and help them make better decisions about who to bring on board. So that's been a separate kind of work, but a very fulfilling area as well.
Sure, okay. Now that's really cool. Now that we're caught up on your background, let's really hone in on the subject of trader psychology. So one of the things many traders will admit and are well aware of is that they take profits too soon and they cut losses too late. That's mostly due to psychological reasons, I'd imagine. What advice would you give to those traders in that situation?
Well, it's a good question, Aaron. And as Ayn Rand would say, I would encourage you and listeners to check your premises with respect to the question, because I think that it can be a psychological issue, but is not always a psychological issue. I mentioned that markets are always changing, and one of the ways that they change is in their volatility. And so the market, as we are talking right now, the market is trading with a VIX of, which is implied volatility, of 14 and change. It wasn't so long ago that we were seeing VIX readings well into the 20s. So markets were moving much more a few weeks ago than they are currently. What happens is that traders don't adapt to that, either in their trading or emotionally, and so they're likely to take profits too quickly or likely to allow things to move against them because they are operating from an old regime, from an old set of assumptions that don't apply to the current market. So a good example, when volatility comes down, traders will start to make some money, and then when they try to let the position go, it eventually just reverses against them because the volatility isn't there, and you get much more mean reversion on a short time frame, and so they end up scratching the trade. Whereas in a higher volatility regime, that might have been profitable. So sometimes a problem that trader might have is logical, not psychological. It's a function of not adapting to markets. It's a function of not trading well. But you're right, there are other times where traders respond emotionally to making money, losing money. And as we know from the behavioral finance research, people are much more sensitive to losing money than they are making money. And so they're likely to be threatened by losses and not want to take those. They're likely to be afraid of losing whatever they gain and exiting trades early, and so forth. So a huge issue in trading psychology is identifying when is a trading problem a logical problem, a problem with one's trading methods, and when is it the result of a psychological problem, the result of being in a wrong mindset that biases your information processing.
Okay, that's an awesome answer. That was really, really good. So, I mean, I guess that is an example of a lack of adaptability, and in some cases, possibly even a bad habit. But in general, when we recognize bad habits in our trading, what's the best way to break these habits?
The first step in breaking any habit, whether it's a trading habit or a personal habit, is to become exquisitely aware of its presence. So we want to become mindful. We want to be self-aware. We want to realize that a habit pattern is playing out as it is starting. So let's say my habit pattern is overeating. The first step in change is to recognize when I'm starting to feel a craving for food or when I'm starting to reach for the refrigerator. If I can't identify it at the time it's happening, how can I possibly control it? So building awareness and self-awareness is the first step in the change process. Then, once you have that self-awareness, once you can become an observer to your habit patterns, rather than someone who is caught up in those patterns, then you want to make a conscious effort to rechannel yourself. So let's say, for argument's sake, I have this habit of overeating, and I tend to overeat most when I'm bored. So I catch myself reaching for the refrigerator, and then I calm myself down, I focus myself, and I purposely engage in an activity that I will find engaging, that will absorb my energy. Maybe it will be some physical exercise. Maybe I'll go play with one of my 4 cats. But the idea is I would address the boredom so that I no longer feel the need to compensate with food. The same principle is relevant with trading. So my habit with trading might be to place trades out of frustration after I've taken a loss. Revenge trading. And so that comes from frustration. I have a losing trade, I'm frustrated, and I want to make that money back. So I want to become self-aware about that frustration. I want to catch myself being frustrated and rechannel that emotion. So stepping away from the screen temporarily, calming myself down, and doing something that is gratifying, that's fulfilling, to counteract the frustration will help put me in the right state of mind so that I can go back to the screen and make good decisions.
Okay, sure. And I like how you mentioned earlier in that answer about more being an observer to your bad habits than getting caught up in the middle of it. I think that was a really cool concept.
Yeah, the important one that shows up actually in Eastern philosophy as well as in the psychology research, that we can't change something if we're not aware of it. If the pattern controls us, if the habit controls us, then we're passive. We have no say in what happens. So the first element of control is being able to step apart from the habit pattern, whether it's a habit of drinking, a habit in trading, a habit in our relationships. We stand apart from it and we recognize that this is causing us pain, this is causing us losses, and then we're able to try and do something differently.
Right. Okay. Now, the intro to Trading Psychology 2.0, you mentioned that all the traders you've worked with varied greatly in how they actually traded, yet they had many commonalities in how they did what they did. So here you were, of course, referring to process and habits. Could you elaborate on these observations for us?
Yes, absolutely. Obviously, the traders I work with have very different strategies. Some are more short-term, some are more long-term. Some are long-short investors building very large portfolios among individual stocks. Some of them are trading macro assets globally and trading macroeconomic themes. So they're very, very different in their approach to markets and in their trading styles. But at a process level, there's some real similarity. And that's what I talk about in the Trading Psychology 2.0 book with those basic A, B, C, D themes. A being adapting to markets, B being building on strengths, C being cultivating creativity, and D being developing best practices. And so what the really successful traders are doing is studying themselves and figuring out what works, what they're good at, and where their vulnerabilities lie, where their weaknesses lie. And they do more of what works. They act in ways that make them more of who they actually are. And they may be different strengths in different markets, but all of them study themselves just as they study markets and stay grounded in what makes them successful.
Okay, so the A, B, C, D that you mentioned there, could you just walk us through each one of those in a little more detail, just so we can understand, get a better grasp of each point?
Yeah, absolutely. Yeah, so A, is adapting to changing markets. And this, as I point out in the book, is no different than it would be for any entrepreneur. You start a business and your marketplace is always changing. And so at one point in time, if you're starting a restaurant, your marketplace may have one set of tastes, and then something else will become popular. And so you have to adapt by changing your menu, by changing your decor, by changing how you deliver service. Successful businesses never stay static. We see this in the technology industry. New smartphones are coming out with regularity because the marketplace demands new features and functionality. So we're always having to adapt. Markets change in their trend. Markets change in their volatility, as I mentioned. Markets change in their patterns of participation. The people who dominate markets now are not the people who dominated 10 years ago or 20 years ago. And so we see different patterns in markets. To assume that markets are static and that our edge will last forever does not work any better in financial markets than it does in the business world. A great way to go out of business in the business world is to assume that what you're doing well will last forever and you never have to change. That's how to become a dinosaur. That's how to become obsolete. And that happens in financial markets as well. So the successful traders are always studying markets and always studying how markets are changing. And the interesting part, Aaron, is that many times our mistakes in trading, our losses, our setbacks, our drawdowns tell us about changing markets. Because we do what we did do when we were making money, and suddenly it's not making money for us. And if we're reasonably disciplined in doing what we had been doing when we made money, then we have to ask ourselves, well, how come it's not working anymore? What has changed? And that helps us go back to the market, learn from our mistakes, and adapt. So we're using our drawdowns, we're using our losses as real information that helps us adapt to markets that have changed their correlation patterns or their trend patterns and so forth. So that's adapt. That's the A part, adapting to changing markets. The B part is building on strengths. And I alluded to this earlier. What I found in my research with successful traders and portfolio managers is that all of them have different strengths, but all of them have at least one distinctive strength. And it could be a personality strength, it could be a cognitive strength, but the really successful traders are really strong in some areas. As a rule, the higher frequency traders, the day traders, are very good at fast thinking skills. They see things broadly. They see many things across different stocks or markets, and they process real-time information across a wide area very quickly so that they can make quick decisions. The traders I worked with in Chicago were very much like that. They were great at pattern recognition. On the other hand, traders with a longer time horizon behave more like investors. They're slower thinkers, but deeper thinkers. They're more analytical. And so they are going into depth in different areas and finding out information that other people just aren't looking at. And so that becomes their strength and helps them, let's say, find an undervalued company that they can invest in over a longer time horizon. So we all have strengths, and the really distinctive traders, the traders who make distinctive returns, have distinctive strengths. And so the success is based on making the most of your strengths, not just correcting your weak areas. The C stands for cultivating creativity. And that's a topic that I have found tremendously neglected in the trading psychology research and writing. Creativity is all about seeing the world through fresh eyes. If we trade the same way that everyone trades, we're going to get the same returns that everyone gets. We have to see some fresh opportunity. We have to see the world differently from others if we're going to achieve distinctive results. Again, it's like the entrepreneur. The entrepreneur sees an opportunity that others don't see and is able to build a business based on that perception of opportunity. The successful traders that I work with have very distinctive strategies. I've been involved, as I mentioned, in hiring traders and successful traders at different firms. And I always know who has the potential to be a successful trader because we talk about their strategy. And when I hear the strategy, it hits me upside the head. It smacks me in the face. And I say, wow, why didn't I think of that? It's something unique. It's something different. If what they tell me is something I could have read in any of a dozen books, I know that that's not a distinctive skill set. So cultivating creativity is essential for success. And of course, creativity is a big part of what helps us adapt to changing markets. And finally, the fourth topic is developing best practices and turning best practices into best processes. So when we look at best practices, we want to look at them in every facet of trading. How we generate our trade ideas, how we manage our positions and how we manage our risk, how we review our results and learn from those. All of these are separate elements of a trading process. And we want to identify our best practices in each area. Our best practices in generating ideas, our best practices in managing positions, our best practices in managing risk and reward, our best practices in managing ourselves as performers. And we weave those together, those best practices, into best processes. And the successful traders I work with are always working on themselves and improving their processes over time.
That's awesome, Brett, and very, very insightful. Thanks a lot for taking the time to flesh that out for us. And obviously, if guys want to learn more about that, definitely check out your book, Trading Psychology 2.0. I'll link to that in the show notes at chatwithtraders.com.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
And just a couple questions to bounce off your answer there. Firstly, one about habits. Earlier we covered bad habits, how to break bad habits. What's the best way to form new habits and implement those, introduce new habits?
Yes, and you're absolutely right. We want to develop best practices by turning those into habit patterns. So often we hear that traders need to motivate themselves. And, they'll do various things with imagery. They'll do various things like have sticky notes on their computer screen to motivate them to do the right thing. But in fact, motivating ourselves is not the best source of influencing behavior, the best method for influencing behavior. If you look at the things we do consistently in life, it's not things we do through motivation, it's things we do through habit. So I don't have to motivate myself to eat breakfast, take a shower in the morning. I don't have to motivate myself to do the right things for the people I work with as a psychologist, because that is part of me and part of my routine. And so we want to take our best practices, our trading practices that work well, and repeat them with fidelity, repeat them in a routine way so that time and time again, with repetition, they start to become habit patterns. So repetition is really the source of developing positive habits. Once we identify a best practice, once we identify something that works for us, we want to be very conscious about employing that day after day after day after day. Tony Robbins, the well-known motivational speaker, makes the case that if we repeat something for 30 consecutive days in a reliable way, it eventually becomes part of us. And I think there's some truth to that by doing things again and again, they start to feel familiar and they start to become part of us.
Mm-hmm. Very, very great points there, Brett. Thank you very much. Now, you also mentioned weaknesses. So, every single one of us, we have our own weaknesses. How should we treat our weaknesses? I mean, some people with this school of thought that you should just focus on your strong points and really drill down on those. Others say you should, improve on your weaknesses. How do you feel on this subject?
Yeah, no, it's a great question. And, our strong areas, our strengths are there because those are competencies we've built over time, and they're also talents that we've been born with. And so we want to make the most of those. And, when you see people who have been distinctively successful, there are people who have really made the most of their competencies. With the weaknesses, it's rare that you could ever turn a weakness into a strength. But we can work around our weaknesses. So there are some kinds of trading that I personally am not good at. In fact, the trading that we were talking about in Chicago, very high frequency trading, making rapid decisions. I don't have the same kind of fast information processing skills that the very successful traders in Chicago had. And if I try to do that, I quickly hit a point of saturation, both cognitively and emotionally. And so that's not a strength of mine. So I want to avoid having to make rapid decisions and process lots of information in a short amount of time. So in my own trading, I will trade short term, but those tend to be intraday swings, or maybe swings from one day to the next, where I have enough time to process relevant information and not get overloaded. So by altering my time frame of holding positions, I'm able to dodge or avoid some of my weaker areas and play to some of my strengths, some of which are more research oriented.
Okay, so this might be, just to continue on this tangent here, this might be a little bit of a strange question, but how do you know that was a weakness of yours, that you wouldn't actually be able to trade like the guys you worked with in Chicago? Because, I mean, all of us, even those who could process information very rapidly, even on day one, we would still struggle and, for the first few months, maybe for the first few years. Even guys who could process information very quickly might still struggle in the beginning. How do you know when it's a weakness of yours and just not a skill that you're yet to develop?
Great question. It wasn't simply that I tried it initially and didn't make money from it. It's that I rapidly hit a point of cognitive overload. And in fact, that had happened to me in other areas of my life apart from trading. If I was in a situation where I had to process too much information at one time and make rapid decisions, I often would not make my best decisions. So let's say, for argument's sake, that I was in a situation in a relationship and there was some disagreement or some issue in the relationship. If I tried to deal with that right then and right there, often I was not as effective as if I took a step back, really thought about what was going on, really reflected upon myself, and then responded in the way that I felt and knew was best. And that typically wasn't a huge amount of time, but it wasn't spur of the moment either. So I had recognized in myself that I do well when I'm able to reflect. And the pattern recognition that the people were doing in Chicago was relatively instantaneous and really a remarkable skill. I admire people who can do that. And when I try to do anything similar, I just hit a point of cognitive overload. And that's how I know that I'm just not wired that way. I don't operate that way in any area of my life. And when I'm pushed to process information that way, it's unpleasant. Whereas when we act on our strengths, there's an intrinsic pleasure to that because we're doing what we're really good at. It feels fulfilling to us. So some kinds of analysis I really enjoy doing. I look at markets in a rather quantitative way, and being able to solve the puzzle, so to speak, and see quantitative patterns in markets is very gratifying for me, very fulfilling. And then being able to trade based on those and see them work out, that's very fulfilling and gratifying to me. So when we act on our strengths, we feel strong, we feel good, we feel fulfilled. And when we act counter to our strengths, it's intrinsically frustrating. And that's a big part of how we can know.
Right. Okay. I like how you mentioned there that you pull on, your strengths and weaknesses, and you find those in other areas of your life. And the crossover to trading is all very relevant. So, no, excellent point.
Yeah, let me just add another point that I've mentioned in my writings. I have never traded full time in my career. And a couple of times I tried to do it. I tried to trade full time. And I actually was making money. And I hated it. I absolutely hated the experience of trading full time. Why? Because one of my strengths is working with people. And one of the things that drew me to psychology was the opportunity to be a meaningful part of people's lives. And so trading full time wasn't playing to one of my greatest strengths and became frustrating. So we have to know ourselves, and often it's our feelings of happiness and fulfillment that tell us whether we're playing to our strengths or not.
Okay. Yeah, that's really interesting, Brett, again. Now, something I'm curious about, when you're working with other traders and you're implementing techniques to get them closer to peak performance, do any of the techniques that you work on operate on a subconscious level to provoke change?
It depends what you mean by that. When you say subconscious, any technique that, as you were saying, develops a habit pattern is making that pattern automatic and therefore out of consciousness. And so using techniques, let's say like guided imagery. Let's say a trader is afraid to lose money. And we will do some guided imagery to have them mentally rehearse scenarios in which they hit their stop levels. And they keep themselves calm and they keep themselves focused while they're going through this guided imagery. And they do that again and again and again and again. And pretty soon, the feeling of hitting your stop and getting stopped out is something that becomes familiar to them, not threatening to them, and they're able to keep themselves calm and controlled. And so it is, in a sense, reprogramming their emotional responses to a situation they had experienced as threatening. And that is happening at an emotional level. And so you could say that it's subconscious.
Okay, sure.
But what you're really trying to do, in a sense, is rewire a person. You're trying to reprogram their responses to certain situations.
Right. Now, Brett, one of the things I'd like to ask you more about is goal setting. I think your advice on this topic would be really valuable. So, how do you suggest developing traders best go about setting goals for themselves?
Yeah, there's actually research, and I've written on this on the Trader Feed blog. There's research on effective goal setting. What happens a lot of times is that people set a goal, but they don't follow up the goal with a specific plan. And so if I have a goal, let's say my goal is to lose weight. Well, that's only going to work if it's part of a day-to-day plan. And that's only going to work if it's meal by meal. I have to eat less calories. I have to do more exercise. And that's day in, day out. And so the goal is the big picture, but what makes it happen, what makes it effective, is the day-to-day implementation of a plan. And what traders often miss is they'll set a goal for themselves to make a certain amount of money or to avoid losing a certain amount of money or to trade a certain way, but they don't drill down so that the goal is something they are concretely working on each day in each trade. So we want to be effective in goal setting by being very planned and very consistent in working those plans. A goal without a plan is a wish. If you have a goal and you don't have a specific plan, that's just a good intention. That's a wish. And it's nice, but it's like New Year's resolutions. For the most part, they're not going to happen unless we have a concrete plan to actualize them.
Okay, so you brought up an interesting point there in your answer about traders wanting to make a certain amount of money. What's your take on goals that have a monetary value attached to them?
I'm not a fan. One of the problems that affects traders and affects people in all performance fields is something called performance anxiety. And performance anxiety arises when we become so concerned about the outcome of the performance that it starts to interfere with the process of performing. And so if I'm a public speaker and I become very worried about how my audience is going to think of me and whether they're going to be interested in my topic, well, pretty soon I'll forget what I'm speaking about. So by putting the profit and loss, the P&L, front and center in our goals, we're emphasizing outcomes, and that can put pressure on us and interfere with processes. Sometimes markets offer more opportunity than others, and to have a fixed P&L goal doesn't really take that into account. What I would rather do as an outcome-related goal is look at improvement. So, am I improving from month to month, year to year in my trading performance? And I would look not only at P&L in absolute terms, but I would look at it the way that hedge funds look at it and the way most financial professionals look at it in terms of risk-adjusted returns. How much money am I making per unit of risk that I'm taking? And try to improve not only in my absolute returns, but in my Sharpe ratio or in my risk-adjusted returns. And that, I think, is meaningful.
Okay, good point. Now, just continuing on this path, how do you think traders should think about failure or loss? Because I know that some people are genuinely afraid to fail. So in your work, do you ever try to get traders to reframe negative thought patterns or anything similar to this?
Yes, and I think an important part of trading is it's funny, making friends with loss, and in a sense, making friends with failure. That it's, as I mentioned earlier, it's often our losing trades that teach us about how markets have changed. Look at it this way. If we follow a best practice and we are relatively diligent, if we're relatively consistent in our trading, and we follow our best practice, and then we start losing money, well, something has changed in the market. We're doing the same thing, but something has changed in the market. We want to use those losses as a prod, as a stimulus to learn about what has changed in markets so that we can adapt. Our losses are information. They're telling us something. If I'm running a store, let's say I own a department store, and I normally sell 500 pair of blue jeans in a week. And now suddenly I'm selling 150 in a week. And that happens in week 1, that happens in week 2, that happens in week 3. And pretty soon I say to myself, what the heck? Why aren't people buying blue jeans? And sure enough, I go to the fashion magazines and people are into something else. And I realize I have to adapt. I have to change my inventory as a retailer. That's how business works. That's how trading works. Our losses, our mistakes are there for a reason. They are there to teach us something. And if we embrace them, if we don't push them away, we can learn from our mistakes. It makes us stronger. It makes us more adaptable. So yes, it's frustrating. Yes, it sets us back temporarily. But ultimately, that's how we become better, by learning from our mistakes.
Absolutely. Now, Brett, I'd like to ask you about the actual subject of money. So let me ask you this. When you're coaching and working with traders, do you try to change how they think about and how they view money? Because straight away, by default, many people have a tight psychological attachment to money. So how do you treat this?
Gosh, it's a great question. And the answer, I don't know, maybe it'll surprise people. No one ever thinks about money where I work. The minimum portfolio size for a regular trader at one of the funds where I work is $200 million. But no one thinks about money. You think in percentages and basis points. And so whenever you ask someone, how much did you make or lose today or this week or this month, they'll always say, I made 50 basis points. I made 1%. So they're not thinking in dollar terms. And that's very, very helpful. Because if you start to think of it in dollar terms, it'll drive you crazy. That if you have a $200 million portfolio and you lose 1%, you've just lost $2 million. But by putting it in basis points, then when you grow your capital, a 30 basis point loss is the same when you're trading a smaller book as when you're trading a larger one. And so that's a big part of how professional traders get around thinking about money. They think in those percentage terms.
That's a really great pointer there, Brett. Many of us often feel, many developing traders often feel a great amount of pressure to succeed and become great traders. How do you feel about pressure? I mean, is it a good thing to place, sometimes quite a lot of pressure on yourself to succeed, or can it have negative effects?
Oh, it definitely can have negative effects, and it's hard to take risk, when you feel under the gun. It's hard to make good decisions, under conditions of pressure. So I absolutely think that is a challenge associated with trading. One of the things I've commonly told traders, and I've written about, is that for me, a element of success in trading is making sure that you have something in your life more important to you than trading. Because if you have something in your life that's more important to you than markets, than trading, than profits, then during periods of drawdown, you'll always have something to turn to renew you and inspire you and keep you positive. Sometimes I hear traders say to me, I have a passion for trading, and trading is the most important thing to me, and I work on it, 14 hours a day. And, that's being vulnerable. Trading should not be the only part or the major part in your life, because then you'll have nothing to balance yourself and to balance the pressures during inevitable drawdowns. So I think living a balanced life, having sources of happiness and fulfillment and energy and closeness to people apart from markets, very, very important to trading success.
Right. Well, this leads into an interesting topic. So from what you've observed, what factors have the greatest contribution to a trader's satisfaction and sense of accomplishment?
What contributes to satisfaction and accomplishment?
Like, do they get excited about making huge profits in, a month, or do they find satisfaction in other areas of their business? I don't know. Is that an appropriate question?
It's a great question, and I'm pausing to reflect, which is what I mentioned I do, and why I don't process information super quickly, because I like to reflect. And I'm thinking about specific traders, and I'm thinking about my work with them. And, and if I look, and I certainly know traders who get a lot of excitement and satisfaction from making money in markets, and I certainly find that to be gratifying. But the ones who have longevity in the business, who have been at this for a while, have some source of satisfaction in trading that is separate from their profitability. In other words, it's not that they find fulfillment in trading, they find fulfillment in markets. And I think that's an important distinction. That if you find your fulfillment in markets and learning about markets and learning new strategies and trying new things, then you can find gratification. You find your intellectual curiosity is gratified, your sense of puzzle solving and challenges are satisfied, even during those periods of drawdown. If your only source of gratification and fulfillment comes from the profitability, then psychologically you're barren, so to speak. You're bereft. You don't have anything to sustain you during those periods of drawdown. So I think it's important to have sources of fulfillment in trading that are separate from profitability, even though profitability is obviously one of the important drivers of our satisfaction.
Okay, I like it. Really, really good answer there, Brett, and an awesome one to take us out. So let's wind things down now. Where can listeners go to find out more about you?
Well, the easiest way would be through the two blogs that I write. One is Trader Feed. The address is Trader Feed, all one word, TraderFeed.blogspot.com. And the second is the blogs that I write for Forbes online. And if you go to the Forbes online site and type it by name, you'll see a lot of articles pertaining to positive psychology and financial markets. So those are two ways that are free and that you'll find more information than you care to know. And obviously, I've written 4 books in the area of trading psychology, and those go more into depth into the topics that we're discussing today.
For sure. And you're also on Twitter, I know. So what's your Twitter handle?
Oh, yeah. So Steenbab, Steenbab, is my Twitter handle. And so I try to post at least once a day.
Excellent. Now, like you mentioned, you've got several books out, the most recent one being Trading Psychology 2.0, which came out towards the end of last year. Yep. I'll be sure to include all the links that Brett has mentioned just now at chatwithtraders.com, including a link to his book and some of his prior books. Is there anything that really separates your most recent book from your previous material?
Yeah, that's why I called it the Trading Psychology 2.0, because I really wanted to touch upon themes that were not traditional in the writings on trading psychology. So there are many topics related to positive psychology and building on strengths. There are many topics related to building creativity and well-being that typically we don't hear about when we read books on trading psychology. A lot of the traditional trading psychology dealt with controlling your emotions, being disciplined, and all of those are great. I would say those are necessary, but not sufficient. In the Trading Psychology 2.0 book, I tried to go beyond those traditional themes.
Good one. Okay. All right, guys. Well, check that out at chatwithtraders.com. Brett, thank you so much for doing this. I really appreciate you taking the time out of your day. I hope listeners get a lot of value from this, and I have no doubt that they will. So, again, thank you.
Well, thank you for having me. I appreciate the opportunity.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, team? You're listening to episode 66 right now, and a big thanks for being here. This week we have returning guest Dan Shapiro, who was first on episode 32. And after receiving a lot of really great feedback from that interview, I knew I would have to have him back on. So here we are. Dan works on an intraday time frame and predominantly trades high beta stocks. He's been trading for 16 years and during this time has experienced the extreme highs and lows that this business can throw at you. For a good part of his career, Dan was heavily involved in the prop world, but now trades independently from New York. Over the next 60 minutes, you'll gain some insight to Dan's methodology, thoughts on managing risk, an outsider's view on the current state of prop trading, and much, much more. This interview will leave you with plenty to think about and may even help you to adjust your mindset if that's something which is holding you back. Anyway, guys, I hope you enjoy it. I hope you find this really helpful. I'm Aaron Fifield, and here is my guest, Dan Shapiro. Dan Shapiro, welcome back, man. What's up? How's things?
What's up, buddy? How are you?
I'm doing very well. It's great to be speaking with you again. Now, last time we really honed in on the psychology side of trading, and we covered fairly extensively your journey coming up as well. This time, we're obviously going to change things up. So I think a good place to kick things off would be by discussing your actual method and the way you approach trading. Now, I know a big part of what you do is based upon pivots. So first up, what is a pivot?
Well, let me start off this way. First of all, I want to thank you very much for having me on. It looks like we had a lot of great feedback the first time around, and this time around we kind of wanted to give the people more of a kind of a macro micro type of environment of what a trader goes through. More importantly, what myself just kind of diving into the pivots. First and foremost, the word pivot. Okay, if you really think about the word pivot, and a lot of people use the word pivot in different ways. A pivot, first of all, is an area of a chart. Okay, an area of a chart that potentially can shift in direction. Now, a lot of people use different pivot points, all these different macro studies, this, that, the other thing. I use them a little bit differently. I actually have created a system out of pure desperation. I had a week run, maybe 3-4 day run about 2 years ago, which I couldn't really get anything going. I just couldn't get anything going. And the one thing that I do every single time I can't get anything going, I can't lose, I try to start looking at charts. Like the same way I started looking at charts back in 2003, how to look for a different arbitrage, different edge. And about 2 years ago, I said to myself, well, what's not working now? Like, why is the market so stagnant? Is it me? Is it the market? Is it the sentiment? What about this period in the last 3-4 days that I can't figure out? And what I do out of pure desperation every single time, because I always know the market is always changing every single day, every single interval, because of technology, because of new market participants, because of the inflows in capital, whether it's government, individual, retail, institutional, whatever the case may be, the market's constantly changing. So I constantly want to go back and see where can I find my defined edge. And about 2 years ago, I started looking at charts. Now, I didn't look at charts to see where a stock can be going. Okay, I don't care where it's the next move to go. Anybody could look at a chart and say, well, the high for the stock is 20 and the stock is basing out in 5 days. And if it takes out that 20, it should go higher. I don't care about that. What's more important to me is how did the stock get to that 20, right? How did it get to 20? Why did the stock go from 17 to 18, from 18 to 19, 19 to 20, and here we are present day? So I started looking, and I came to a realization that pivots by themselves may or may not be a directional, potential shift in direction, right? Everybody knows it because everybody uses the word pivot very, very differently. But then I stumbled upon, after doing thousands of charts and countless of hours of back testing, and it felt like I was doing it for a year, but it was literally I was doing it for 2 days. I noticed that charts by themselves, pivots by themselves, are kind of a coin flip. You know, maybe the stock goes higher, maybe the stock goes lower. But what I found out, if a stock is a potential pivot, and it hits a supply or demand zone, okay? And again, for those who don't know what a supply or demand zone is, it's any moving average, any Bollinger Band, any linear regression line, anything that you could put on your chart. A lot of squiggly lines, right? A lot of lines, a lot of data. Anything that you could put on the chart that will show you a point where emotional buyers meet technical sellers or emotional sellers meet technical buyers. Now, when you combine with that on a 60-minute interval, right, on a 60-minute interval, it gives you a very, very defined, clean look. Now, as everybody knows, I am one of the most outspoken person about social media. I think social media is the best and the worst thing that could possibly happen to a new trader. I think there's so many opinions out there, 99% are just complete nonsense, complete garbage. And in fact, with so much information overflow, I think there's so much garbage out there, but there is a lot of depth as well. If you can go through all the garbage, you could find that one diamond in the rough. And for years and years and years, because social media has been sensationalizing the happy action, you know, I'm going to be trading on a pool, I'm going to be trading on a yacht, diamond rings, you know, Ferraris, you know, this, that, the other thing. It's all action. Everybody has been brought to the attention that trading is fun. It's exciting. It is the place to be. And the most important thing that everything got thrown down the throats, especially for new traders, is the 1 minute interval. Right, Aaron? You hear this all the time. Well, if you look at the 1 minute chart, it's breaking out on the 1 minute chart. If you look at the 1 minute chart, it's breaking down on the 1 minute chart. The problem with the 1 minute chart, think about this. You have 392 1 minute charts for the whole day, right? 392. I look at 6, okay? I look at 6 60-minute candles. Within that 392 1-minute channels, okay, you have a whole bunch of uneducated, underfunded, no process, no pain tolerance bunch of traders, correct? And everybody's asking, where's my stop? And within that 1-minute channel, you can't be right within that second. You have to be literally right within that minute, because every minute that goes by, think about what happens. You get more players that come into the stock. You have more uneducated day traders, and then you have the funds that come in. Because remember, day traders and fund managers are two different things. So for example, if a stock is breaking out on a 1-minute channel and David Einhorn comes in and says, you know what, I want to sell 1 million shares of this stock, you, my friend, are getting stopped out. So there's a lot of noise going into all these 1-minute channels, but you've been kind of, not you, but the social media environment as a whole has been forced down their throats to say this is normal. The 1-minute channel is normal, but the problem is, and the bottom line is, everybody keeps on getting stopped out on that 1-minute cycle. You're constantly getting new participants joining into the next 1-minute cycle, and then all you're doing is spinning your wheels, rinse, repeat, rinse, repeat, rinse, repeat. The broker dealer wins. And that's not normal to me. That's not normal to me. What normal for me is when I found in the last 2 years where you can completely remove all the noise. You can completely remove all the noise. You can completely remove all the buyers and sellers, the organic players that are coming to the channel. And I notice if a stock, we call it a pivot. If a stock is pivoted, it goes against supply or goes against demand, and the next candle confirms that supply or demand on a 60-minute view, there's a good chance that the stock is going to go your way. And what I found, and again, basically outside of my live webinar, there's 2 other of my buddies who trade this. You can't find this on YouTube. You can search any strategy on the planet on YouTube, opening range highs, buying IPOs, selling IPOs, within the first 30 minutes of the day, this, that, the other thing. You'll never find this because, again, it's not normal, right? But again, if 90% of the people are in the same stocks, 90% of the people are losing money in these stocks, how could the 1 minute channel be normal? So what I found 2 years ago, there is a definitive advantage. There is a definitive edge, kind of removing all the noise. And instead of watching 392 1 minute channels, all I'm watching throughout the day is 6 60-minute channels. So that's it. And when the stock violates the top of the range and builds upon that level, I go long. And when the stock breaks below that range and starts building below that pivot, I go short. And as long as there's room, right? As long as there's room in the trade that stocks go from supply to supply, from demand to demand, it's a valid setup. Now, again, the one analogy that I always talk about, especially in the live webinar, it's called the Barry Sanders effect. Okay, Barry Sanders, especially for all you guys who are in the UK and Europe who are not familiar with the NFL, Barry Sanders was one of the greatest running backs of all time. Okay, and he used to run behind one of the worst offensive lines in NFL history in the Detroit Lions. And he would have a game or he would have a half that he would run the ball 15 times for 32 yards. Right? 15 times for 32 yards. He just couldn't get going. And then next thing you know, in the third quarter, he breaks a run for 60, 70 yards, and he scores a touchdown. That's the whole point of the PS60 theory. That's the whole point of trading 60-minute channels. Most stocks are not tradable, right? Think about this. Most stocks are not tradable. Every stock moves, but most stocks not tradable. So every time you're trying to trade a stock that is just moving, that's not tradable, you're going to get stopped like Barry Sanders did for 2 yards, right? And you're going to get stopped 20 times a day. But that one chart, right, or that two charts or that three setups throughout the day, that supply gets confirmed on another 60-minute channel to the upside or to the downside, that's your home run. That's your cash flow. That's your Barry Sanders effect. You need room to run. You need valid setups. You got to get rid of all the noise. And instead of being the normal, the 1 minute rah, 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 sis, boom, bah, social media bungee jumping off their toilet bowls, you are looking at now very, very patiently 60-minute channels that confirmed. And once they confirm, it works very, very well. So it's a completely different theory. I know people who are listening to it at home are just like, what the hell is he talking about? But it's real. I've been putting the price action on social media, especially Twitter, way before the price action, because, again, I want to show people the power of how these pivots get confirmed. And when they confirm very, very well, and especially via the high beta names.
Okay. Awesome. Well, we're off to a running start. So, Dan Shapiro, how do you identify a pivot on a chart? I mean, I'm sure there are various indicators that may do this for you. Do you use any of these, or do you just do it by eye?
Yeah, here's the deal. As everybody knows, I am probably the self-proclaimed king of the idiots. Okay, I'm not the sharpest tool in the shed, but I've been doing this for 16 years. I've been doing this since the end of '99. So I've got a lot of screen time. Okay, I've got a lot of screen time. I understand how stocks organically should trade. I understand how they shouldn't trade. I understand what happens, or more important, what should happen. Okay. And most of the charts that I trade a lot of high beta. I trade a lot of high beta. The FANG stocks, your Apples, your Googles, your Amazons, Netflix and Tesla are my two favorite stocks. But on my charts, and I use eSignal, and the funny thing is, I don't use eSignal, the ones that everybody else uses eSignal. I haven't upgraded eSignal in the last, I would say, probably a decade. Okay, so my eSignal is probably completely different than everybody else's eSignal, because technology Jones, I'm not. But what I do is I put in all these moving averages. Okay, my chart looks like a 6-year-old took a crayon and went out of their minds. Okay, so I have the 5, 10, 20, 50, 100, 150, 200-day moving averages, both EMA and SMA. I use Bollinger Bands, and I use the most underutilized supply or demand zone known as the linear regression line, which eSignal, that's what it's called. If you use TC2000. I believe it's called the LR30. So I have all these squiggly lines, okay? Why is it important? Why is it important to have all these squiggly lines that a 6-year-old could have drawn with their crayon? Because again, before you put on a trade, remember, stocks just don't stop by themselves, okay? There's no magical place that a stock is going to stop, okay? It's not random. It's like I say it all the time. It's like the cartoon, the Wile E. Coyote and the Roadrunner, right? The Wile E. Coyote throws an anvil, right? Throws an anvil off of a mountain, and it stops in midair right before it hits the Roadrunner in the head, and it goes right back up and hits the coyote back in the head. Stocks don't stop randomly. All these supply zones, every single moving average supply zone, Bollinger Band, linear regression line that I mentioned, they're points of reference. That's where the bodies are laid. And if you don't know they're there, okay, if you don't know they're there, how are you supposed to exit? How are you supposed to know where the stock is going, okay? How are you supposed to know if the stock has room for 30 cents of upside or 3 cents of upside? Because again, supply zones, when they hit, 9 out of 10 times they're going to go back the other way, and they need to confirm to go higher. And there's never a guarantee that these things will ever go higher. So you need to know where the bodies are placed. So I have all these supply zones on my 60-minute chart. Remember, it's all 60-minute charts. Every chart forms a candle every hour on the hour. So I'm only waiting for 6 candles the whole day. Now, a lot of traders, and you hear this all the time, especially on social media, which obviously you get all your great information from, you got to be patient. You got to stay patient. Most traders don't know what they're patient for. It sounds reasonable. Sure, of course you want to be patient. You want to be patient in a bull market when there's a rabid bull market and they're just throwing money at you left and right. But more important is most traders don't know what they're patient for. What exactly are you waiting for? So if you don't know all these grenades, all these missiles are pointed right at you, how are you supposed to, think about this logically, how are you supposed to navigate through a room full of bombs, landmines, if you don't know where they're placed? Once you have all these lines in front of you, and again, kind of goes back to the Barry Sanders effect, if you don't know where all these defensive ends and middle linebackers and safeties and cornerbacks are ready to tear your head off, right? Because again, technical sellers meet emotional buyers and obviously vice versa. How are you supposed to navigate through the trade? So what I do is when I'm looking at these 60-minute charts, and for example, if I'm trading Tesla, for example, and I say to myself, well, the pivot, the last high on Tesla in the last hour was, let's just use, I don't even know where Tesla closed even today, 208, right? Let's just say 208, okay? But I look at the supplies and I say to myself, well, the next room, right, the next stock, because again, if you believe the theory that stocks go from supply to supply and support to support, the next supply zone, whether it's the 20, the 30, whatever the hell moving average it is, it's only 30, 40 cents higher. Then you say to yourself, is the trade worth taking? Is the trade, a high beta name like Tesla, is it worth taking the trade for 30, 40 cents? And most of the time I'll say no, because again, if I'm trading a high beta name, I want to make sure I have enough room, right? Because again, we want to make sure we don't have one carry for 2 yards. We want to make sure we have the Barry Sanders effect. The big hole opens up and now the stock is trading $1, $2, $3 from supply to supply. So it's a very simplistic way of doing it. It's so important to create organic patience. And I'll sit there literally like a statue waiting for these things to confirm each and previous candles. As long as there's room to the upside of the channel, to the downside of the channel, and it confirms and builds to both sides of the direction of the market, it's a valid trade. And I take the trade and usually works out pretty well. Right.
Okay. Now, I'm sure like any type of chart pattern, there are additional factors that may make this pattern stronger or either weaker. Is there anything else you like to see in combination with a pivot, maybe strong volume on the previous candle or anything along those lines?
Yeah, because basically what I do is I would say I trade, 90% right now. I mean, I've traded different things throughout the years. I'm pretty much regulated to high beta stuff, okay? The most important thing about high beta is, number one, you need to have a point of interest. Like if you're trading Netflix and you see the market like today, for example, Netflix was the weakest stock out there. Matter of fact, all the FANG names, all weak stocks. So you have to say to yourself, well, these are all market sensitive driven securities, right? The market's up 200 points. Netflix is putting in lower highs for 3 consecutive candles. It finally breaks the previous candle. Can I go long, right? Can I go long? Well, it hasn't rallied the whole day. What makes you think it's going to rally now? So there's a lot of moving parts. Obviously, when you're dealing with market-sensitive instruments such as the FANG names, the volume is going to be there. Okay, the volume is going to be there. So you're not really looking at volume from ratio from candle to candle. You're more concentrated on, number one, the direction of the move, whether it's the up and downside. But more important, I try to pay attention to what has the stock done, whatever direction I'm looking at, what has the stock done in relation to the futures? Because again, you can be the greatest technical chartist of all time. You could have read 10,000 books. The greatest thing that you have going for you as a professional trader is the eyeball test, right? It's the eyeball test. So if the futures are up 200 points and Netflix is taking out lower lows, I don't need to have 6 different things on the chart to tell me something's wrong there. Whether there's a seller they're trying to clean up, there's something wrong there. So a lot of times the biggest indication for me is what has the stock done in relation to the last interval of the futures? Because remember, you don't need to win the day, right? You don't need to win the day. You need to win intervals of the chart. Since there's only 6 intervals, you need to win any of those 6 intervals throughout the day. So if you're trading Netflix, you can trade it to the upside, you can trade it to the downside. If you're trading Tesla, the same thing as well. These things give you enough ranges. So a lot of times you're trying to kind of evaluate what have these things done in the last hour in relationship to the futures? Because again, it's common sense. And I try to look at things as common sense. If the futures are exploding and these stocks are taking out lows, there's something wrong. I don't need to know that the stock is weak. That is weak. Okay, it's common sense. It's 30 degrees outside. It's snowing. There's hail coming down. You're not going to take your newborn baby in a tank top and flip-flops and put him outside. It's just common sense. So a lot of the times with all these stocks, it's more common sense. What's happening in relation to the futures? Have they taken out a previous high? How much volume? And again, volume plays a part in it. But again, you have to assume with their market-sensitive instruments, they're going to be providing you a lot of liquidity within interval to interval. But more important is what have they done in relationship to the futures? Do I have room in the chart? Can I validate this trade? What has the stock done in the previous candles when the futures were actually going the wrong way? So all these things you have to do. Because again, if it was as simple as buying and selling and say, all right, look, previous high on Tesla is 208. The futures are going higher. All right, let's buy 208. Should go to 209. It just doesn't work that way. There's so many different variables. You look at the futures. You look at what the other FANGs are doing. You look at the overall market sentiment. What's taking out lows? What's taking out highs? And again, you have to ask yourself all the questions. Is the trade worth it? Right? Remember, is the trade worth it? Because again, at the end of the day, if the futures are exploding and Netflix is taking out the lows of the day, you say to yourself, well, I see Netflix is weak, but is it worth doing? Because again, at the end of the day, eventually sellers get tired, especially a day like today when the market's up 200 points, and you'll have a nasty reversal in the middle of the day from Netflix taking out lows through the whole day and finally exploding towards the latter part of the day. So, a lot of the part is, a lot of the time it's watching what futures are doing. A lot of the time is obviously observing what other FANGs are doing. A lot of time is usually just trusting your eyeballs, just using common sense. And more important is just remember, you don't need to trade every single interval of the day. Some days will give you value and you'll have 10 trades on these things. And some days, for example, like yesterday, I had 2 trades, right? Yesterday I had 2 trades and today I did okay today. I caught Netflix. But more important is, again, how do you feel? How strong is the day going? Which side is the direction of the trade that you're looking to take? More important, how much room is there in the trade? And can you validate it because of the movements in that direction of the futures?
Got it. Now, you've thrown a couple terms out there, one being FANGs and the other high beta. Can you just explain those for listeners? I just want to make sure everyone's on the same page here.
Yeah, so I got to give the credit to Jim Cramer. He gave him the name FANGs. FANGs basically stand for Facebook, Apple, Netflix, and Google. Okay, those are the 4 FANG stocks. But those 4 FANG stocks have friends. Okay, and those friends are Priceline, Baidu, LinkedIn, Tesla. You could even throw in like First Solar. You could throw in, for example, what else you can throw in? You could throw in, VRX, Valiant. I mean, anything that can put in a range, okay? Anything that could put in a range that could be traded on both sides of the ledger because the ranges are so wide. So at any given point in any given day, you can trade these things to the long side and to the short side in the same day, because a lot of times these stocks do represent strength. They do represent weakness, all in the same channel, sometimes all in the same candle. But any stock basically that you can trade without, validating a daily chart. Because again, remember, most traders do trade off daily charts. And, prior to like 2-3 years ago, I used to be kind of a daily chart trader as well. I never used to put in a lot of stock off the intraday stuff. But any stock that can be traded throughout the day, a big range that can be validated on both sides of the market and have enough value is considered a FANG, or a FANG with friends, right? A FANG with friends. It's basically creating volatility. And, obviously volatility, these things are everything to a guy like me.
Okay, cool. Now, obviously you have, some stocks which you might label as your favorites, but prior to the open, do you have a pretty good idea on what stocks you might be trading that day? And if so, how do you identify what stocks may provide opportunity for you?
Well, that's a good question. There's two things I look for. So I go through like 500 charts. I go through like 500 charts a night. I do my watch list, because again, I truly believe no matter what your levels of experience trading 2 weeks or trading 20 years, I think you got to put in the work every single night. You got to put in, you can't just, like I used to, prior to like 6 years ago, I used to just turn on the computer and say, what, my God-given talent is going to make me money, this, that, the other thing. And it got me very complacent. It got me very lazy. And, 6 years ago, I started a live webinar, and, it forced me basically to sit down every single day and knock out, 40, 45 minutes worth of chart work. So I look at two things. Obviously, I don't need to chart the FANG names or the high beta stuff, because again, as long as I know the general direction of where they are on their charts, correlated to what the market's doing, correlated to the market sentiment, I'm kind of fine there. But what I do is I go through, 500 charts on the S&P 500, on the IWM, and I look for stocks on the daily chart that are coming out of a range. I try to put down, 6 to 10 ideas for myself. So I'm kind of prepared for these things in the morning. They could go from, I'm probably the only human being that could look for a dollar stock and a $700 stock all in the same breath. Okay, I'm the only schmuck in the universe that could trade some dollar stock and Google pretty much in the same interval, which is insane to even think about, but it's the reality. It's kind of my reality. But so I make a list. I go through all these charts, and I'm looking for stocks that are coming out of a range on the daily. Remember, this is all on the daily, coming out of a range. Minimum 5 to 7 days. Obviously, the longer the distribution, the better the result will be. Okay. And I'm looking for a stock to come out of that level, close above its supply. Okay. Obviously, the next level of supply needs to be further away, so I can actually validate the trade. And if the trade hits that number the next day, I'm trading it. What I don't do, and I think this is such an important part, especially for new traders, okay? And I want to make this point incredibly clear. The first thing, I used to speak to a lot of traders when I was in the prop industry for years and years and years. And I guess we'll talk about that a little later, because I know a lot of your listeners send you emails regarding that. But when I was in the prop industry, the first thing a lot of new traders would do is open up that pre-market high list. What stock is up 80%? What stock is up 90%? What stock is up 200%? And all they want to do is trade that damn stock for 10 cents, okay? And I would rather take cyanide, okay, drink it, cut off my left thumb, feed it to the local bear, than trade that pre-market high list. What that pre-market high list is the complete opposite of what every new trader should be doing. Everybody wants to drive that fast car, right? Everybody wants to drive that fast car, your Ferraris, your Bentleys. Everybody wants to drive that fast car. The reality is, when you're learning to drive, you want to go slow, because you've never driven that car. And as everybody knows, new drivers are the worst drivers. That's why new drivers' car insurance are through the roof, okay? So when a trader is turning on his computer and they're seeing that ABCD, and by the way, a stock that has 3 million shares in the float, is up 90% pre-market, If that's your focus, you are going to fail. It's just a matter of time. You're going to fail. You might make money once, you might make money twice, but you will fail. Because again, driving a car doesn't start at 150 miles an hour. It starts by putting the key in the ignition, putting on your seatbelt, checking your mirrors, and then slowly, right? Slowly coming out of the driveway. That's why newborn babies, they don't come out of the womb running, right? They come out of the womb crying. Then they eventually they develop holding up their heads, right? Then they eventually crawl, and then they start walking, and then they start running. So that pre-market high list and pre-market low list is the biggest setback to education, to your educational process that any single trader does. So I have no interest, zero interest looking at these stocks, zero. Because again, I'm not going to buy them up 200%. I sure as hell I'm not going to short them up 200% because stocks that go up 200% could go up 400%. And I see so many tragic stories day in, day out. You hear all these stocks going like KBIO blowing people out and all these different stocks that go from 3 to 4. Well, the stock can't go from 4 to 5. There's no way the stock can go from 7 to 8. 12 to 14? Never. Next thing you know, you're sweeping the floors at a local IHOP. So I think the majority of traders, and unfortunately, again, it goes back to the theory why social media is kind of the best and the worst thing for the development of new traders. I think they're more fixated on excitement, the thrill of the chase, the testosterone level. Is it Monday yet, man? Is it Monday? That's a whole different conversation. Trading is supposed to be boring, okay? It's supposed to be boring. It's supposed to be lethargic. It's supposed to be a way that you can validate consolidating your business, that it goes straight and narrow. It's like a restaurant. Restaurants know their busy day is going to be on Wednesday, Thursday, Friday, and Saturday. They know, right? They know Monday is not going to be their busy day, and they accept it and they move on. With trading, it's kind of the opposite. The trading is, we're going to start on Monday and we're going to go all the way through Friday, 100 miles an hour, go, 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 go. And the reality is they can't go. They don't have a process. They're underfunded. They're undereducated. They don't know what they want. They're patient, but for what they still don't know. And the moral of the story is they crash before they actually live out their potential. So what I do is completely different. I go through my charts. I wait for the markets to open up. I wait for the pivots because, again, it forces you, watching 6 candles throughout the whole day, it forces you literally, right? It forces you literally to wait for these candles to form. So the first candle forms 10 a.m. Eastern time. The next candle forms 11 o'clock. So between 10 and 11, you watch to see what Apple is doing, what Facebook is doing, what Solar City is doing. And if they're putting in strong candles into supply, you're going to need another candle to, again, confirm that candle, rinse, repeat, rinse, repeat, rinse, repeat. So my process is a lot different. Yes. Do I see what's upgraded? Yes, because a lot of times if you get Amazon upgrade, I want to trade Amazon. Again, if you see, for example, Solar City get upgrade, yes, you want to trade that. But a lot of times I mostly go through charts. I like the organic moves. They go through stocks that stop at supply. And I know next day, if they confirm the previous day's high or confirm the previous day's low, I want to trade it. I want to do my very, very best not to trade with social media. I don't want to be in the same stocks as them. I don't want to be in the same interval as them. I don't want to be fighting every single guy with a $2,000 account, keeps on getting stopped out every 30 seconds. I want to be an organic, boring, lethargic trades that have natural buyers that clean up sellers and have natural sellers that clean up buyers, and rinse, repeat, rinse, repeat, rinse, repeat. This is not a game for me. This is not a sport. It's not fun. It's nauseating. These are on good days. But when they work very, very well. And when they don't, I try to figure out why, make adjustments, and move on to the next day.
Great. Well, a ton of value in that answer, Dan. Thank you very much for sharing and going into such detail. It's really appreciated. Now, at the end of the day, or however often you do this, how do you reflect on your trades and review or judge your performance?
That's a good question. I do it once a month. I look at my sheets once a month. Okay. I fully expect, and I want to make this. I see this all the time on social media. Stay humble, right? You hear that all the time. Stay humble. Put your head down, smile, and stay humble. Okay, because the market will humble you. That's all true. Okay. Here's something that I completely disagree with. Okay. I think you have to be a good person in life. Okay. I think you have to be a humble person in life. I think when you're a trader, you have to have a God complex. You have to believe that you could walk on water. You believe that the person on the other side of the trade, I will bankrupt your whole lifeline, okay, if you're trading improperly, okay? And I have no problem taking the food out of your kids' mouths, okay? That's on the trading aspect. I believe I'm a good guy. I'm a family man. I love my kids. I'm pretty good in my community, okay? I'm a very nice person. But in trading, you got to be Kobe Bryant. You got to be, you got to be Michael Jordan. You have to be a killer, okay? You have to be the absolute killer. So when I'm looking at my trading, I expect every single trade that I put on, I'm going to make money. Okay, I'm going to make money on every single trade. Obviously, does that happen? Of course not. But you have to believe that. So what I do is every single month, at the end of the month, I'll look at my sheets and I'll look at the days and I say to myself, well, what happened that day, right? And I'll look at the trades and I'll go back on the charts and try to figure things out. And I don't look at the way I trade, whether it's a good thing or a bad thing, on a daily basis, on a weekly basis. I go through my sheets once a month, but I do truly believe as long as you don't prostitute your process, and I don't care what your process is. You could be trading, credit default swaps. You could be trading E-mini, whatever it is, whatever your trading is. I believe that you will have periods of dullness, right? You'll have periods of, you'll go on a monster run, and you'll have periods that, you can't get out of your own way. It's called the buzzsaw. Every single trader, for the exception of social media, every single trader that puts on risk, okay, is going to run into a buzzsaw. It's inevitable. The more screen time you get, okay, the more screen time you have, and the more hands that the market gives you, eventually you're going to run into a buzzsaw. There's been days, and I swear like the day is long, every single thing that I've done for that one day, whatever random day it is throughout my career, it's been wrong. I buy the stock at the top of the channel, I get hit with a reload seller. I short the stock at the bottom of the channel, I get hit with a reload buyer. There's nothing I can do to make money that day, right? And I shake it off. There's nothing you can do. Because again, sometimes you'll get that 2-5 offsuit, and there's no way you could play that hand. The only thing different about that day is instead of me keep on compounding the problem and saying to myself, well, I'm only down X. But you know what? X could turn into XYZ. So you don't want to turn a Band-Aid, right? You don't want to turn a paper cut into a severed head. So what I do every single month, I want to make sure, yes, my losing days, I'll have losing days, but I want to make sure, and this is where the responsibility kicks in, I want to make sure I didn't take that Band-Aid, right? That Band-Aid with all these paper cuts and turn it into a severed head. So if I see a number, okay, if I see a number that jumps at me on my sheets, I know there was something wrong that day. Whether it was something I was holding overnight, obviously there's bad news that comes out all the time. Your stock could get downgraded, FDA. I try not to hold, biotechs overnight, but you never know what comes out overnight. Like a couple of years ago, I was long Intrepid Potash, IPI, and some stupid news came out of the whole sector. The whole group was down 25% the next day. Okay, it's part of the business. So that kind of day would obviously stand out for me. But most important thing, what I do to kind of look back at a trading month, I say to myself, well, if I made money 18 out of 22 days, 19 out of 22 days, whatever the number is, I want to make sure the days that I didn't make money, okay, or caught a buzzsaw, okay, because again, every single trader, no matter who you are, will catch that buzzsaw. I want to make sure first and foremost that, again, I can make back that day, whether it's the next trade, next two trades, the next day. I just don't want to make sure I put myself in a situation being stubborn or pig-headed or just being just an idiot, okay? Because again, Meyer Hoffman used to tell me all the time, the greatest thing you could do is don't trade like a putz. That's it. Don't trade like a putz. The greatest advice he ever gave me. Don't trade like a putz. So as long as I never traded like a putz and those numbers that are down days are manageable, I'm fine with it. Because again, that's the cost of doing business. You can't escape. There's nothing you can do. So I try to make sure those days don't jump off the page. I want to make sure those numbers are not exaggerated to what I normally take on my days to the downside. I try to correct it if there possibly is. If there's just one of those days that, ish happens, right? We say it all the time. Ish happens, right? If it's one of those ish happens days, then you know what? I'm fine with it. Rinse, repeat, go into the next month. Short memory. It's just part of the cost of doing business. Next trade.
Okay, Dan, so while we're on this subject, let's move a little deeper into risk management and position sizing. There were a few questions that actually came through on Twitter about this. So can you talk to us about how you actually measure the size of your positions?
Well, let me say this. I want to actually break this down because it's different how I do it. I've been doing this for 16 years. Okay. Let me tell you what the advice I give to new traders. Okay. Number one, most new traders, again, as we all know, are undercapitalized. Okay. And there's a whole theory out there, so many different ways of kind of doing risk management. This is what I tell my guys. This is what, when I was in the prop business, this is what I used to tell all my traders. If your account size is $25,000, okay, if your account size is $25,000, the maximum fixed risk on every single trade should be 1%, right? 1%. That should be your maximum risk. Now, here's where things get very, very good for you. Okay, here's where it gets good for you. So let's just say, for example, a stock closes, and again, goes back to the 500 charts previous night to get to your homework to the next day. So let's say Solar City, closed at 24.75, right? 24.75. The high for that day was $25. So I know going into the next trading day, if it takes out $25, I want to be long the stock. Okay. So let's say you have a $25,000 account, right? 1% of $25,000 is $250, correct? So that is your max risk. That is your max risk. So, going into the trade, okay, how many shares, what's the biggest bang for my buck that I could put on, still have a fixed cost of $250, okay, and get the biggest bang to the upside if the stock works. So you say to yourself, well, I'm buying the stock at 25, stock closed the previous day at 24.75. So if the stock fails, right, my maximum pain is $250. 25 cents. So I'm buying 1,000 shares, right? So if the stock goes up $1, goes up $2, you're risking $250 to make 1,000, 2,000, etc. For example, if you buy a $5 stock, right? A $5 stock closed at $4.95. You're buying the stock at 5. You have a 5-cent risk max. Your fixed rate, your fixed cost is $250. So you say to yourself, how many shares can I maximize? With, again, the biggest max pain is 1% of my account, which is $250. And your upside is, again, where the chart looks. So you say to yourself, well, 5 cents, $250 risk, I'm buying 5,000 shares. So the closer you are, okay, the closer you are to the entry, okay, the closer you are to the entry from the previous day's closing price, you can tier up or tier down and give yourself the biggest bang for your buck. Because remember, your max pain is always fixed. And what that does, it takes the complete emotional part of the trade out of the way. You don't need to forecast. You don't need to overthink. Oh, there's a buyer, there's a seller, there's a buyer, there's a seller. You can let the trade play out organically. Okay, you can let it out play organically. You don't need to overthink. You already know your max pain. And you're saying to yourself, what's the most amount of shares that I could buy within this interval that if it goes, it's going to work very, very big. And if I'm down, you know what? I'm still down that 1%. So again, you buy the stock at 5, the stock goes to 550 in 2 days. You're up $2,500, and your max pain, again, your fixed max pain is still that $250. You could do that with Google. You could do that with Apple. So again, you have a $25,000 account. Maybe $25,000 account is a little bit of a hard stretch trading Google. But let's just say, you say to yourself, okay, I'm risking Google. The previous day's high was, I just pick a number, 750, whatever it was. 750, the stock closed at 748, right? 748. What is the maximum shares I can buy, okay, and still have my fixed cost, my max pain that I could trade Google, not get shaken out, and still said the same thing? So you say to yourself, well, I could buy roughly 100 shares of the stock. I'm risking 2.5 points. And if the stock goes, and again, everybody knows how Google could run and goes on a multi-day run, you can make 20, 30 points in Google. So the best thing for new traders is stop overthinking. Because remember, there's only 3 parts of a trade. Just think about that. There's only 3 parts of the trade. It's the process, right? Your tier size and the result. There's nothing else. Okay, there's nothing else. But if you can't intelligently, okay, understand your max pain, if you can't intelligently have the proper tier size, your result is already lost because all your emotions are already engulfed in the first two parts of that trade. So if you're buying a stock, right? If you're buying a stock and you can't sit in the trade for 10 cents, you're trading way too much size. Right? Way too much size. Because I hear it all the time. Well, the stock is not going. Well, the stock is down 7 cents against you. Yeah, but the stock is not going. And then 30 minutes later, the stock takes out the highs of the day. So tier size is very, very, very important. But more important than your tier size is having your fixed max pain. So if you go into every single trade and you say to yourself, I'm a new trader, I'm going with that 1%, I'm going for that 1% maximum drawdown per position. Now all I need to do is figure out from the time that I'm entering the trade to my whatever my stop is, whether it's on the 15-minute chart, your maximum drawdown to the downside, or on the daily chart from where the stock previously closed. I already know my max pain, the dollar amount. Now I have to figure out the correlated number of shares, how much to buy, and then I give myself the biggest bang for my buck. Because again, it's all about risk-defined trades. If you're risking $1,000 to make $300, you're wrong. If you're risking $500 to make $200, you're wrong. But if you put aside an allocated percentage, which is a 1% basis, which I always tell new traders to do, you already know your max pain. You can do the numbers very, very quickly in your head. What's the difference between the closing price and the entry in the next previous day? Give yourself the biggest bang for your buck. Let the stock run. Take your cash flow, hold the runner, use break even as your stop. Again, rinse, repeat, rinse, repeat.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Now, this is probably a good point to ask another question which came through on Twitter. If you're an undercapitalized trader, should you wait and save until you do have sufficient capital, or should you consider trying to get into a prop firm? And I know you're a good person to ask about this, considering your background. So, give us your take.
Let me give you the reality. Okay, the prop business that I came from, and where, quote unquote, the prop business now is apples and oranges. Okay. Back in the day in the prop business, okay, you could put up 25 grand and have $3 million worth of intraday buying power. Okay. At certain points in the prop business, hell, you didn't even have to put up any of your own money, and you still had, 80, 90% payout. Okay. The firms made so much money on commissions. We didn't care what we were paying. If you remember the interview Peter from Lucci did with me and Meyer, we used to pay 3 cents a share. 3 cents a share. You used to do millions of shares a month. Think about how much money that is. So these firms didn't care. You could be down 100 grand for the day. If you made $250,000 in commissions, what's the difference, right? They let you keep your account open. The game has changed. Okay, the game has changed years ago. The prop business is dead. There's 4 or 5 major players left. Okay, 4 or 5 major players left. Nobody wants to take risk anymore. Okay, that is for sure. Nobody wants to take any risk anymore. Before, man, they used to say, hey, listen, you want to go in 3 million overnight, do it. You used to go in 1 million overnight, do it. Blah, 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 blah. If you're wrong, you're wrong. You can always make it back. You could go into the firm's money. Now it's more focused on education. Again, I don't want to use any names. A lot of places, and again, you guys kind of know who they are on social media. They realize the money is not in the commission business anymore. It's not. Nobody's doing volume anymore. Okay, guys I know, they used to trade 5-10 million shares a month, are trading 800,000 shares a day, 800,000 shares a month. Because again, there's not enough value throughout the day. Again, the game is completely changed. So the firms realize there's no money left in commissions. That's why, firms like Schoenfeld 3 years ago, like in the summertime fired like 100 traders. All these different firms are getting rid of traders because, again, the talent out there doesn't complement their business model anymore. It doesn't work that way. So they figured out, you know what? There's no money in commission anymore. Yeah, we have our core guys. They're still doing their volume, blah, 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 blah. It's all gravy and stuff. But they realized a long time ago, the money's not in commission. The money right now is in education, right? Think about that. It's the big word right now, education. So they started doing a lot of in-house seminars, talking about daily, weekend events, 2-3 day events. They're selling this, they're selling that, and that's all good. Okay. So for me to turn around to a new trader and say, hey, look, I know you're undercapitalized. You know what? You should go trade prop. Number one, nobody's hiring. Okay. And if they are hiring, and if they are hiring, they're not going to let you take any risk. They're not going to let you take any risk. And yeah, you're probably not going to put up any capital. Okay. Because a lot of the firms, if they're on SIBO, Philex, whatever, again, I'm kind of out of touch with it because I've been out of the prop business for a number of years now. But I used to be in the business for years. For years. So I know kind of everything about it. I know, let's just say that. I know a lot about it. Okay. So for a new trader to get hired, right? To get hired, they're coming out of college, they get hired. Number one, no, the firm is not giving you any risk capital to trade. Okay. They're making you trade 100 share lots. Okay. You're making you 100 share lots. And again, if you're learning on somebody else's dime, that's fine. Okay. But you are not getting the true nature of the beast. You're just not. You're not getting the true nature of the beast, of the physical, actual, proactive part of trading on an every single day basis. So the prop business is dead. It's dead. I'm being completely honest. I have a lot of good friends still in the prop business, all in the New York City area. Everybody knows each other in the New York City area. But the majority of the firms in the New York City area are right now going into the educational space because they can make $500,000, $1 million in revenues a month, opposed to hiring the trader, having them sit there, risk their money, this, that, the other thing, and make $2,000 a month off commissions off them. So the game has changed. What I really believe, if you don't have the 25,000, don't go to one of these offshore quote unquote prop places. They're bookies. They're bookies. If your account is in Bermuda, they're a bookie. They're a bookie. They're not a broker. They're a bookie. Okay. So they're telling you could trade with as little as $1,000. They're a bookie. Okay. I don't even know if you're actually even trading money. They're a bookie. And they're telling you, well, there's no pattern day trading rule. And again, this is the word pattern day trading rule is something new to me. I only learned this phrase 3 years ago. Again, I still don't understand, and I actually do understand why the government thinks that people are not sophisticated enough to trade their own capital under 25,000. Like, what's the difference if you're trading 24,000 and 26,000? Why are you more sophisticated at 26,000 than you are at 24,000? But what I would definitely suggest a new trader to do, if you are under the pattern day trading rule, and I'm not the aficionado of the pattern day trading rule, I know nothing about it, but I do know, I think it's 3-4 day trades a week, something like that. What I would do is if you have $20,000, instead of having one account with 4 trades a week, open up 3 accounts, right? 3 accounts with, then you get 11, 12 day trades a week. And you kind of build it up until you have the 25,000. But people ask me all the time, what's a good amount of money, right? What's a good amount of money to trade? I say a lot, right? A lot. And after you have a lot, add a lot more. There's no magical number. But again, I do feel for the people who are trading under the cap, under the 25,000, the whole prop world, it's dead. It's just dead. It's just a reality. It's dead. I used to have offices in Ascent. I used to have offices in Generic. It's dead money. It's not the same business anymore. And the one tip that I will give to your listeners, and a lot of people don't know this, and now that I'm out of the business, I don't mind sharing with this. You are a commodity, okay? No matter how old of a trader you are, how new or how seasoned of a trader you are a commodity. Because the firms are not doing the numbers they used to do, you, my friend, are Barry Bonds to them, okay? So every single account they have is a commodity. So if you're coming in there and you could negotiate any commission rate you want. Okay. So if Ameritrade tells you, and again, I have no idea what Ameritrade charges, but if Ameritrade charges, say, for example, $7.99 a trade, you could come in there and say, you know what, I want to go negotiate an aggressive rate. Clearance, guys, is virtually free. Okay, clearance is virtually free for the broker dealer. So any number that's coming in over X is very, very profitable. So if you're a trader that's doing 1 million, 2 million shares a month, and you're trading for like $7, you could get your commission rate to like $1.50, man. Most people don't know about it. If you're doing volume, you are a commodity to the firm. So if you're doing 1 million, 2, 3 million shares, and you're paying $3, $4 a share, come into them and say, you know what, I want $1.50. I want $1. Throw in the ECN. So you know what, or I'm going to leave. I bet you if you're pulling in 2, 3 million shares a month, I bet you will get a phone call from that broker dealer, and they will restructure your commission rate. So if you definitely want to get your costs down, that's first and foremost. You definitely want to set up your business. Don't be cheap with your business. Get good chart packages. Get good software. Invest in your business. Invest in yourself. You are the must follow. You see this all the time on social media. That guy's a must follow. Ooh, he's a must. You're the must follow. Okay, you're the superstar. Okay, you're the guy. Okay, you're the girl. Okay, you are the superstar in the making. You just don't know it yet. Okay, you just don't know it yet, because the difference between you and a person who's been doing this for many, many years is screen time. So you have to do whatever needs to be done for you to become that superstar. So don't salivate with some random avatar on social media is trying to get to you. Okay, there's nothing out there that somebody can show you that you can't figure out for yourself very, very quickly. Okay, so you are the rising star. All you need to do is position your business the right way. Because again, a steakhouse, for example, like Old Homestead in Manhattan or Peter Luger's, for example, in Brooklyn, very, very famous steakhouses, they're not going to serve their steaks on paper dishes. Okay, they're not going to prostitute their business. So why should you? Right? Invest in your business. Get a aggressive commission rate. Okay, do what you have to do to get enough capital, okay, that your business runs smoothly. So you don't have to worry about being right on a 1 minute interval. Because again, if you're undercapitalized, that means again, you already have no pain tolerance. You already have no valid process. You already are sweating. The first thing you're asking already is, where's my stop before the trade is even put on? Okay, I don't remember the last time I thought that the trade didn't work out. But again, the difference between me and somebody that's just opening up their first brokerage account on Monday is screen time. The more scenarios you see, the more hands that you're played, the more things that you figure out what not to do. Okay, the value is not learning what to do; it's learning what not to do. Because remember, the value in your account is not the money you make; it's the money you save. So get your ducks in a row. If you have cash flow problems, again, would I go on the route of what I did, borrowing money from a loan shark? Probably not, okay? But again, I did what I had to do at that time, okay? Would I max out credit cards? Probably not, but there's a will and a way. You'll get the capital. You'll build your accounts very, very slowly, organically, boring, right? Like watching molasses, watching paint dry, and eventually, again, with enough screen time, once you get your process, and again, whatever your process is, it could be an option trade, whatever it is, you will be that rising superstar and you will be the must follow.
Awesome advice there, Dan. Now, you mentioned in there platforms and software, and you also mentioned earlier that you do use eSignal. Is there any other platforms or software that you use on a day-to-day basis?
Yeah, no doubt. So in 2003, I was trading in a firm called Spectrum Securities, right? They got bought out by Schoenfeld Securities. In 2003, right after I left, I went to a hedge fund by the name of Gould Capital. I was the absolute worst trader on the planet there. But this guy, Steve Gould, was friends with this guy named Dan Merkin. Okay, Dan Merkin, I'm sure all you listeners know, is the CEO and founder of Trade Ideas, okay? And I started using Trade Ideas. At that, the 2003, I think their company was only a year or two old. He sent me a bunch of T-shirts, Trade Ideas, and I started hanging them out, okay? So I've been using Trade Ideas. I'm sure your followers and listeners know a lot more than I do about their technology, and you should really have Dan Merkin on your show. Great, his platform is the whole artificial intelligence behind the trading and kind of the engine that runs it. But I use Trade Ideas for my intraday real-time filters. Directly, I think I must have given Dan and the whole team at Trade Ideas probably over 300 traders throughout the last, the last 13 years. I don't even know how much it costs. I have no idea how much it costs. I know it's not expensive. I used to tell Dan Merkin all the time, if you would charge $500 a month, it'd be worth it and probably be still cheap. So, you guys, go, you can follow, I think Dan Merkin's Twitter handle is Trade Ideas 1. Good guy. He'll help you out. Greatest technology out there. So I use that. I have been using eSignal for God knows how long. The only bad thing with me, because I am the absolute worst, I don't upgrade anything. Okay. So I've been using the same, I've been literally using the same version of eSignal for like 8 years. I've been using the same version of Trade Ideas since like 2003. So what your listeners use and what I use is like completely two different products, but I love it. I would definitely highly recommend, not necessarily eSignal, because eSignal is good. I'm just used to it. So I can't really say eSignal is better or worse than anything else out there. I'm just kind of a creature of habits. I've been using it for years, but Trade Ideas is dope, man. It's really good. They have a lot of bells and whistles. They're structured for any type of trader. I know Dan for since 2003, and because I was the absolute worst trader in the world in Gadul Capital, that's how I met Dan. Because Steve turned me on to Dan, and he gave me his platform, and I started getting profitable somewhere like around 2000 and middle 2003, 2004. Coincidence? I don't know, but in all sincerity, all honesty, it's a great product. I think your listeners should definitely check it out.
Sure thing. All right, Dan. Well, I think we've pretty much run through everything that I wanted to cover. Is there anything that you want to add, or are we good for now?
Yeah, the only thing I want your listeners to understand, okay, and I'm probably the biggest antichrist when it comes to social media. I've been doing this for 16 years. I've seen everything in this business. Okay, I mean literally, there's nothing that could happen to me in this business that I could ever put out to my worst enemy. Okay, so I've been run through the ringer in this business over and over again. Okay, so every single day that I make money, lose money, that I'm still in the game, I'm very, very fortunate, because I know how long and how desperate it took me and how many desperate years of trial and error it took me to get to where point I am. And that point is being very, very comfortable in my own skin. I don't need to, answer to anybody. I don't need to apologize or show this or show off or anything less. I live a very, very comfortable life. I've been in this business for a very long time. When I see the circus that's going on social media, it's a disgrace that people call themselves traders, that they claim that they do the same thing for a living as I do. And I know that every single day, whether win, lose, or draw, and I've had some really good days, the vomit that's pouring out of all my pores is the reality of trading. So for all your listeners, especially all you aspiring traders, understand this. You got to put in the time. Nobody's entitled to give you anything. Okay, as much as this business, you can surround yourself with good people. It's not a team game. You are Tiger Woods. Okay, you're Tiger Woods. It's you versus the field. We're all smiling dandy. We could all be friends, but if you don't establish your process, if you don't really hone your trading, a guy like me, we could be friends. I will take the money on the side of your trade, on the other side of your trade, with a smile on. So remember, just to kind of end this, first of all, I want to thank you very much for having me on again. It was a real pleasure. But guys, I'm telling you right now, if you want to be a trader, put in the tower, put in the long hours, put in the trial and error. Don't let anything bring you down, man. I'm telling you right now, people will doubt you. Your friends will doubt you. You will doubt yourself. I'm telling you, there's a rainbow out there, man. There's a rainbow out there. And the only thing, again, that's separating you from a guy like me is screen time. So if whatever you can do that's not going to prostitute your process or shoot yourself in the foot in the meantime, that's one step closer that you're going to live out your dreams and be a professional trader. So guys, don't give up. Keep working. Remember, you're the superstar, damn it. Not some random avatar on social media. It's you. You just haven't lived out your potential yet. Okay? Trust yourself and you're going to be great.
Love it. As I knew it would be, Dan, an absolute blast to have you back on, man. So thank you so much.
My pleasure, man.
Where can listeners go to find out more about you?
Well, put it this way: it's the whole social media thing. I do run a live webinar. It's called accesstrader.com. It is a live 7-hour webinar which we trade live. My screen is shared, and I am literally speaking for 7 hours a day. And people ask me in the room all the time, how do you have all this energy to speak for 7 hours a day? 5 days a week, and I tell them a lot of cocaine. But the reality is, we go through a lot of real-time scenarios. We trade live every single day. There's no hidden tapes or recorders or trick photography. It's just right in front of us. It's a very good organic learning webinar. And again, I don't promote it because I don't care. My business was built organically. I make my money clicking a mouse. If I want 50 new subscribers, I click a mouse and I click it in the proper interval. With extreme prejudice, win, lose, or draw, I'll be back the next day. So you can find me on Twitter. It's DanShep55 on StockTwist as well. I'm very accessible. If anybody has any questions, feel free to email me at accesstrader@yahoo.com. And, I'm just a regular guy, just living the dream.
Good stuff, man. Well, I really do appreciate it. Thanks so much for coming back on, Dan, and I'm sure we'll stay in touch.
You got it, brother. All the best.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
How's it going, team? Welcome to episode 67. We have a very special guest on the podcast right now. His name is Jerry Parker, and you're probably already familiar with who he is. But for those who don't know, Jerry is one of the original, widely recognized turtle traders. The turtles were a small, somewhat secretive group of traders who were mentored and trained by Richard Dennis, a big-time commodities trader, and this all took place in the early 80s. It's a really interesting story, and you'll hear all about it in just a moment. Today, Jerry remains the founder of Chesapeake Capital, which is a commodity trading advisor, and he is well and truly stuck to his roots as a die-hard trend follower. We discuss all the above at length, plus I also had a few questions for Jerry around the subject of trading other people's money, which is something you may not have even considered before. And on the other side, some of the questions you should ask a CTA or any money manager before investing. All right, so we're going to jump to the interview right now. I'm your host, Aaron Fifield, and here is this week's guest who I was honored to speak with, Jerry Parker. Hey, Jerry, it's really great to be speaking with you. How you doing?
I'm doing well, Aaron. Thanks for having me.
No trouble whatsoever. It's awesome to have you on. Now, I know you've done many interviews in the past, which I'm mindful of. So I'm going to have a shot at asking you some questions which may not come up quite as frequently, but nevertheless, I do have to ask you about the turtle story and how you got your foot in the door, because it's really an interesting story. So let's start right there. How did you become one of the turtle traders? And even though it's a very publicized and well-known story, for those who don't already know, what were the turtle traders?
So in 1983, a famous commodities trader in Chicago, Richard Dennis, ran an ad in the Wall Street Journal and the New York Times saying that he wanted to hire a few people to come to Chicago and he would teach them how to trade using his methods. No experience necessary. You can probably Google the ad. It's out there somewhere. The same ad that I saw in 1983. And so that's how I found it. I was reading the Wall Street Journal, looking at the want ads. I was working in public accounting in Virginia, and I sent my resume in.
Okay. And can you give us a little background on who was Richard Dennis? I mean, obviously everyone knows his name as he was the guy who came up with the idea for the turtle traders. Tell us a little bit about his background in the industry.
Rich lived in Chicago and worked on the floor, I think initially, and then decided to go off floor and position trade. And so I think he did that for a number of years and made lots of money, supposedly. That's the story, that he turned a few dollars into a few $100 million, and he was very successful. And he had two high school friends that they went into business together and worked together and traded together. And so he was one of the rare people who probably would say that he made more money trading his own account than trading for clients. Sort of rare, and it sort of preceded the explosion in hedge funds and CTAs and things like that. But he's a very, very smart person and very nice person, and very fortunate that he wanted to teach a few people like me how to trade.
Yeah, that's really interesting. And why do you think it was that he did decide to do this? Why did he want to teach others how to trade and share what he knew?
Well, that's hard to say. I think that a lot of people think it's because he wanted to see if trading could be taught. That's the popular idea, but I think also he genuinely wanted to bring together a group of people and teach them his ideas and let them start trading, and then hopefully over time they in turn would come up with some ideas of their own that they then could sort of share with him, and would make the whole trading process and better for everyone. So I think those two probably are close, but he probably wonders why the heck he did it at this point, but I'm sure glad he did.
Awesome. Okay. And I'm curious, where did the name Turtles come from? Like, what's the story behind the name?
So I got the job and I moved to Chicago, and we had our training course. And then January 1984, we started trading with Rich's money. It was 12 of us, all in an office together. And inevitably, we thought highly of ourselves, and we thought it would be a good idea to have a nickname. So we were trying to find some nicknames, and the 12 disciples or the 12 apostles or something like that. So that didn't stick, thankfully. And evidently, Rich went on a trip to Singapore or Asia, and they came across a turtle farm or a place where they were raising turtles, and someone said, "That's just like you. You're raising traders back in Chicago." And like all great nicknames, it was an accidental, and it just stuck. Who can predict nicknames? But it was a great nickname, and everybody sort of knows about it. I remember when in 1988, the program ended, and I sort of went out on my own, started trading, and I went to New York, and I was trying to meet people in Wall Street and trying to find clients, and I called up this gentleman at a very large organization, and I said, "Can I speak to so-and-so?" And they said, "No, he's busy." And I said, "Well, can you tell him it's Jerry Parker and one of the Turtles?" she said, okay, hold on. So she comes back, she's laughing, and she goes, yeah, come on up. So that from the payphone back in the old days. So it does come in handy, and everybody's intrigued by it. And lots of the meetings I'll go to today, 30 years later, people want to know about Chesapeake and how we trade and how it's changed over the years. And then some people are really interested in turtle stories. How was it? What was it like? And it's a very unique situation. And I think the most unique thing about it was these were really genius people who were amazingly smart and had a system and a process that was incredibly good. So it was totally legit, and they were producing people who had some good ideas and good information about what worked in the markets.
Absolutely. And I mean, the name has definitely well and truly stuck, that's for sure. So you mentioned there that there was 12 people that they brought into this group. Did they ever introduce any new members over the 4 years that the Turtle Traders were around?
Yes. So the next year, the fall of '84, they did the process over again. So ads in the Wall Street Journal, the New York Times, send your resume in. I forgot if it was a 2 or 3 week course. And then so all of a sudden in January 1985, there was 8 more people. And so it was about a room of about 20 people. And the second group of turtles were our equals, or probably a little better. Really smart people, nice people. Some of them we still keep in touch with today. So we sort of knew at that point in time that this was a very, very special situation. We were very fortunate. We were learning a lot of stuff, and we were having good markets. And then probably the most important thing was not just getting the information and periodic lessons or contact, but sort of the level of support and the level of encouragement. And it's unlike situations today where clients are not necessarily going to be supportive all the time, but with Rich and his partners, they were always encouraging and supportive as long as we were doing the right thing and not sort of focusing on performance. So it really was a beautiful, strong building block for going forward and being able to withstand the ups and downs of the markets and try to truly believe and absorb the fact that its success is probably going to be determined mostly on if you're able to continue to do the things that are right and sort of try not to focus too much on temporary bad performance or really good performance. Don't get drunk on good performance. That's pretty important.
I like that. That's a really great point that you raised there. Have you ever wondered what if you never got accepted into this trading group? Do you think you still would have pursued trading?
Probably. I remember the interview with Rich, and I said in the interview, I was very, you're in these interviews and you don't know what you're saying and you're young. And in hindsight, I'm not as impressed by a lot of the things that I've said in the past. But I sort of said to him in this interview, like, well, whether you hire me or not, I'll be a trader. And so he was like, wow, okay, cool, you're hired.
So it worked.
So that kind of worked, but I don't know if that's true or not. I mean, I certainly wouldn't be the trader I am today. A lot of decent information is, finally on the internet, I suppose, but whether I would have been able to sort through all the good and the bad, and it's hard to say. I definitely was going to exit the accounting profession and do something in investments. I love trend following. I had heard about and studied trend following shortly before the ad in the Wall Street Journal came out. So I thought trend following was wonderful, long, short, diversification, currencies, commodities. Oh, God, this had to just be so amazing. I thought it was the best thing ever. So when I got to Chicago and figured out that that's exactly how they trade, I was, ready. And I was I was already a believer in all of that. So I think, diversification and going with the trend is very important. I guess the money management piece and how to size the trades and how to create a really diversified portfolio amongst the different sectors and each of the different markets would have been something that I might have gotten right or I might not have gotten right.
Okay.
Yeah.
Okay. Sure. So once you were accepted, to be one of the very first turtles that was introduced, what was the initiation process like? I imagine there would have been fairly intensive training for the first few weeks, seeing as most of you had very limited knowledge about markets at the time. And like you pointed out, that the ad actually specified you don't need any prior experience. So what was that? I think you mentioned it was a 2 to 3 week course that you went through right at the start. What was some of the big things that they tried to drive home during those first few weeks?
Trading is hard. It needs to be hard. It needs to be uncomfortable. Do the right thing. Do the hard thing. Trade small. Don't risk too much, which no one ever paid attention to, but that's what they said. Build systems that can last for a long time. Buy the highs and sell the lows. Buy rallies. Don't ever desire to buy a lower price. Typical trend following things, and sort of this is going to be hard. This is not easy. It shouldn't be easy. And good systems, good trading methodologies have a low win rate. They're infrequently profitable. They have big profits and they give it all back. They have big profits and they give most of it back. It's the exact opposite way that you would want to trade, and that's what works in the markets. I've never really understood fully the degree to which people really believe when they say you should find a trading methodology that fits your personality, because I think I sort of was taught the opposite, and that is to take money out of these markets, you'll be very fortunate, and to take it out in the way that you would like to take it out is impossible. And in fact, the opposite works, the opposite of what you would prefer. What I'd prefer, 1 or 2% a month, a pretty consistent return, and that's just not what we were taught or what we were taught that works in the markets.
That's really interesting, Jerry. That is really interesting. During those first few weeks, I believe that they taught you their actual the system that they wanted you to trade. Like they gave you from what I imagine was probably like an outline or a list of rules on how to trade this system. How black and white were those rules, and did they require any discretion from the individual traders?
They were pretty black and white, but we were encouraged to use our own kind of discretion or flair, but not to deviate too far. But like I said earlier, it was, especially if you're going with the trend, and you had a lot of leeway and a little bit of, as long as you were sticking with the philosophy, which is, buy the highs, sell the lows, add to winners, never add to losers. So the exact specifics is, there's no need to think that there's one set of parameters that's going to work. So we're fairly hoping that we would use a little bit of this discretion more than we actually did, I believe. I think eventually what happened is that all 20 people being in the same room, there was too much, I think people felt too much pressure to deviate. It's better to just be part of the crowd. We're all making money. And I think that if we would have been working in separate offices, we would have had probably more imagination, which is exactly what happened in 1988, when we all went out on our own or left trading for Rich, and people were forced to, over time, to decide how are they going to handle things. You couldn't run to Rich and ask him, and you had to sort of think on your own more so than we did when we were there. That's my opinion. I'm sure other people would disagree with that, and but that's sort of my interpretation.
Yeah, okay. So, I mean, in that case, were you profitable like straight out of the gate? I mean, you're in such a great environment to be learning how to trade. Were you profitable straight away, or did you also experience your fair share of challenges as a newer trader?
Well, so we were sort of told that if you lose 30%, you're going to be in trouble. If you lose 50%, you're going to be in big trouble. You know what that means? So after a few months, everybody was down to about 30%, and some people were down 50%. And so their response was, you guys are doing okay. You're doing what we told you to do. We've had some bad markets. So you're okay. You're fine. You're fine. Keep going. And so that was a tremendous amount of encouragement. The bottom line was, were you following the rules? And pretend. It's a pretend situation, right? Because nobody would do that to you today. And in fact, one of the ideas is if you make money and following the rules, you are going to be in house. You'll probably be okay. That does not exist in the real world because most people don't know anything about trading who give you their money. And so you have to sort of deal with that fact. But, that's the sort of encouragement and mentors we had. And of course, that was the lows. And by the summer, everybody was making money. And that was 1984. And I started slower than most people. But by 85, 86, 87, we were all making about 200% a year.
Okay. Those are really impressive returns. Now, correct me if I'm wrong, but I believe there was a day when you lost approximately 60% of your capital in a single session. Can you share with us what went wrong on that day, and how did Richard Dennis react to this?
I don't remember him reacting. So we come in on, it was an incredibly profitable time. It was 1986 in February, March, and crude was on its way from 40 to 10. And it was probably a lot of other nice moves also. And we were up 200%. And so over the weekend, and then I was feeling very happy, and I think my bonus was like $1 million. I was very excited about that. And then Monday we had sort of a bad day, just a counter trend day after massive profits for a few months. And because we were so highly leveraged, I had a 60% down day, if memory serves me correctly, So I've repeated this story so many times. I hope it's sort of correct. But so I finished the day up 140, and I think I finished the year probably up 160 or 70. So, it's a function of leverage. We were trading way too large for sort of a normal people, but this is what we were instructed to do, and we didn't know any different. This was the environment we were in, the people we worked for, and we loved it. But I don't think, since we didn't do anything wrong, and it was just like a bad counter trend day like we've had recently in the markets with some of the rallies in the commodities and stock rally and things like this, these, lower leverage, you're losing a little bit. Higher leverage, you lose a whole lot more. But in the context of things, that was nothing we did wrong, because, the definition of wrong is not following the system. So if you follow the systems, you don't do anything wrong. Now, it's kind of not always true, because you may sort of sit back and say, oh, my leverage is too high, or my system, I made some mistakes in my system. But by and large, that's sort of the benefit, and one of the problems with this style of trading is that sitting back and watching the systems do their thing and sort of being out of control, and that's kind of a helpless situation, but then sometimes it really works well.
Yeah, and I mean that's an interesting point you bring up, because you said there there's a lot of time where you're just sitting back and you're letting the system do its thing. So what were you doing on like a day-to-day basis while you were there, with the other turtle traders? I mean, were you ever encouraged to research and try to find strategies of your own?
That's a good question. So we only traded like 25 markets, and we didn't trade it overnight, Europe or Asia. And I don't think when there was maybe one or two people who had a computer and had the capability to program it. I guess they wanted us to observe what we were seeing in the markets and give them ideas. I remember one person, our trading systems were very short term, and now that sort of style doesn't work anymore. The turtle way of trading works great, but not those parameters. You can't be nearly that short term anymore, I don't believe. So, but some people launched off into being a little longer term, and I think that caught their attention. Like, what are these people doing? They're not getting out at the 40-day moving average. They're waiting till the 100-day moving average gets breached, and we need to have a talk with them. So I think some of that went on, although that's my memory.
Okay, sure. So after 4 years, the group split up and everyone kind of went their own way. Why did the group split up after 4 years? I mean, was this something that was really just an experiment and it was never meant to be a long-term thing, or what happened there?
I don't know. I think it was planned on being a 5-year, but I think that I think the turtles would have stayed forever. There was no CTA business. No one could foresee how large it was going to become, or the hedge fund business. And we were loyal to Rich, and we loved Rich. We just wanted to please him, and it was a great environment. And then there was no way to know that we were going to raise hundreds of millions of dollars, and trading a few million with Rich was just fine. But I think that they probably got tired of it. I'm not really sure. I don't remember hearing the answer to that question, but it's kind of a hassle to, put up with 20 people, and I don't know. I'm not sure.
Okay. Yeah. So in other interviews that I've listened to you speak, you'd mentioned that if this experiment was to be replicated today, it would probably be much different in the sense that it would be mostly a team of programmers trying to find systems to trade. But it made me wonder, how was the turtle experiment any different from prop trading firms that operate today?
I could just have to guess, but I would say that it's turtle trading is different from all kinds of trading in that it was very mathematical based and systematic based, and no discretion. Not like you have a little discretion on devising your systems, of course, and I like mine to be this parameter, you like yours to be kind of another parameter, but we're still going with the trends. We're taking small losses. We're not cutting our profits short. We're diversifying as much as possible, longs and shorts. And we're going to have probably about the same performance, risk adjusted, leverage adjusted. So that is rare, I think, on prop desk, in that if they are sort of 100% systematic and rule-based, they probably keep it a secret.
Okay, sure. So nowadays you run Chesapeake Capital. Did you start this immediately after your time with Richard Dennis, or was there a step in between there?
I started right after Richard Dennis in February 1988, and I immediately kind of had sense enough to know that I should have a target return a lot less than 200%. And we started strong, and we got involved in the grain markets of 1988. That was a nice year, and we did well. We traded our systems, and we probably made money like 7 or 8 years in a row. Never had a losing year for a while, so that was very nice. People were throwing money at us, whether they should or not, but people are greedy, and we were something sort of new, I guess. And having that 4-year track record was very important. It's almost instant credibility, and even if people didn't realize who Richard Dennis was, they were willing to take a chance on young traders, as they still are today. I think some people have a preoccupation with something new and something, trying to find the next Paul Jones or something.
Yeah, I have a few questions that I'd like to ask you a little bit later, actually, around the money management aspect of it. So we'll definitely dig into that in a little bit. For now, I've got a few questions around your actual trend following approach. So, someone like yourself who is a diehard trend follower, how would you say the trend following game has changed, since the 80s when you started out, to where we're at now, and how is it likely to change, moving forward also?
Interesting. Well, I think, like I said, it was 25 markets, let's say, back in when I started. Now we trade 120 futures markets. Legitimately, they're full positions and not just token. I've heard some people say we trade 300 markets. We can't figure out. We call them up usually when we say that. We say, like, what 300 markets are you trading? Because we only can find 120. We trade 100 single stock futures. That's good. Liquidity's better. Diversification is better. I think the biggest change / only change we've really made over the years, it's material change, has been to trade longer term as the markets became choppier and more trend followers, more computers. You have to sort of have a longer term holding period, and that works well. It's always worked well. But it would be nicer to trade shorter term, but it's still a very profitable way to manage money. I think some of the unfortunate things that have happened, I think I'm not a fan of vol targeting, indiscriminately selling and buying by huge CTAs and money managers when the vol increases. It kind of feeds on itself and creates Dow down 1,000. I think a lot of people blame the CTAs for Dow down 1,000 and constant sort of volatility targeting without any sort of reasonable discretion of taking it easy to get those trades done. It seems like they're sort of just throwing a lot of more than the market can handle. That's unfortunate. A lot of these trends that you're seeing these days are end very violently. And so I would hope that people would stop, exercise more discretion.
Okay. So would you say that the overall returns from trend following have decreased due to increased volatility in markets?
No, I think they've decreased, number one, primarily because people trade smaller and they're trading for institutions. And we're in a zero interest rate environment where 12% is awesome. And you can raise a lot of money, and clients don't like drawdowns. So a lot of large CTAs got onto that very quickly to have a target vol of 10 versus 20, and that helps a lot. I think that because we can fine-tune the volatility and the risk of the portfolio, we can always trade larger or smaller, and so targeting a certain return is sort of under our power, as long as markets are normal and behave, and not every year, but on average, we should be able to. Yeah, I think, like I said, you just have to trade longer term, and then over the years, it's been sort of most CTAs have tried to evolve away from trend following only in order to fully diversify with short-term trading, mean reversion, pattern recognition, the carry trade, etc. And in order to smooth out the returns of trend following and make it easier to justify the incentive fee.
Okay. So as you've gravitated towards more of a longer term time frame, what would you say is perhaps your average holding time for any given position?
Our average would be probably 1 year.
Okay. And I know some people listening, you mentioned earlier that, a lot of really good systems have a low win rate. Could you give us a guide to your win rate? I mean, I think that would be really interesting for listeners to hear about and understand.
Well, I think our win rate is in the low 40s. I've heard other people talk about win rates in the 20s. I think that I don't like that idea because that just means probably they're taking smaller losses, and I try to take sort of an optimal loss, not too tight, not too close to the market, and not too far away. It's gonna the size of your stop loss is gonna be correlated to your win percentage, and then you're trading such a 40% is sort of low to begin with, so I'd like to not have a method that tries to preserve capital and doesn't have such a low win percentage that you're constantly losing money and eating into the client's capital. But I do think that, once again, it's sort of counterintuitive. Everybody knows you have to win 51% of the time and be very consistent. And so, once again, this is sort of counterintuitive that no, low win rates are better. Your average win will be about 2 to 3 times as large as your average loss. 5 to 10% of your trades will make all your money. And so this is very uncomfortable, very unfun, following a system. What if my trailing stop gets hit and doesn't move up quick enough? I'm going to give back all this profit. I've got to stop this. I've got to intercede and, i.e., not follow the system in order to protect these profits. And then you're in trouble.
Yeah, exactly. So how do you decide when the parameters of your system may need adjusting?
Very good question. Well, I like to look at the trades, the large trades that have happened, and my job really is to participate in these trends that may last a year or 2 or 3. But the longer my holding period, then possibly when the market turns around, the more money I'm going to give back. So I want to stay in and not keep getting chopped out and whipsawed in and out because I need to participate in these trends. But then if I have my trailing stop too far away, I'm going to give back half my profit or a material amount of the profit that I built up over a year or 2 before I end up getting out of the trade. So I'm kind of paid to sort of navigate that and figure out to walk that line of long-term enough, but not too long-term. And I think that, so I sort of look at, what does the computer say? What does it look like it takes to stay in these trends? What's sort of the shortest term I want to trade? And what's the longest term I want to trade? And so then I just trade a lot of stuff in between. So maybe it's the 100-day moving average, and then the longest term I want to be is the 300-day moving average. So then I'll trade the 100, 150, 200, 250, 300. So I try to have multiple entries, systems that have multiple entries, multiple exits. And so any one trade is sort of going to be random as to what's the best parameter. But then if I trade lots of these systems, very similar, highly correlated, with different entries and exits, over time they're going to make about the same amount of money, but they'll have different performance, materially different performance possibly on an annual basis.
Okay, that's a great answer, Jerry. Thanks for going into that. Now, one thing we often hear as traders is that simple works best. I'm curious to know, how simple are your systems, or do they vary in complexity? Because I've always wondered, if we could see exactly how guys like yourself trade, would we be shocked at the simplicity of your systems?
Well, when you look at my performance, sometimes you probably wouldn't be too shocked because it can be pretty bad. But I don't know if you'd be shocked. It's hard to say. I think that the most important part about trading is the sample size of your back test. There's nothing more important. No one ever asked me that question. No traders ever talk about it. I don't know. I guess they understand it. We certainly understood it. We certainly taught that from day one. And I think that sort of should be the root of simplicity of this idea, and that is that simple systems, an entry parameter, an exit parameter, and a stop loss parameter is going to give you an opportunity to have a large sample size. So the problem with more parameters, more variables, is the sample size gets smaller and smaller. And in this type of trading, especially in trading that's a non-normal distribution, you need to have an unusually large sample size. So that is sort of the behind-the-scenes reason that simple is powerful, because you can't get too fancy and eliminate trades and only take the good ones. Number one, that doesn't work. And number two is you don't have much of a sample size.
Yeah, that's very important. Yeah, like you mentioned there, that the sample size for sure. And just going further into the subject of robustness, what's your take on single market systems versus those that trade multiple markets?
Oh, if you mean, do you trade the same systems on all the markets?
Yeah, so do you have let's say you're trading oil, do you have a system that trades only oil, or do you have a system that might trade a basket of markets?
I have the same systems that they trade all the markets. So I trade the markets, every market with the same systems. So, and once again, you're back to the same issue of sample size. So if you trade all the markets with the same system, and you trade the longs and the shorts with the same system, then you can count all those trades and all those markets and the longs and the shorts together in order to come up with this sample size. So you've got to trade them. You've got to convince yourself that that's what you should do, and then you do it. And so essentially your parameters are decided by what worked on the preponderance of the markets, of all the markets, on the average trade of all the markets. So you may be liquidating your short crude or going short crude at 90, and some of these parameters may be more heavily influenced and decided for you and for this trade by what happened in the currency markets, not crude. So it's really strange, and it really, I think, I think it goes kind of against human nature. These markets have personalities. Certain things work better than others. You're sort of saying to me they're all the same. The expectation per trade is the same on every single one. But, yen's really profitable and wheat's not profitable. So how could the expectation on wheat and the yen be the same? Well, it is. I'm looking at all these trades together, 5,000 trade sample size, long and shorts, all the markets. They all have the same expectation. The expectation is whatever the average trade is for all the trades. And you can kind of prove that, to a large degree probably, that optimizing a market system for a certain market probably won't work if you sort of do an in-sample, out-of-sample. I doubt that what worked in corn in the 90s was the best system for corn in the 2000s. So I'm pretty sure you can prove that sort of thing doesn't work.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
Okay, and just to bounce another question off this topic, you mentioned earlier that you trade also a lot of equities in addition to futures. Do you use the same systems that you trade futures markets as you do with equities?
I do.
Okay, that's interesting. Now, you've also mentioned that you take short positions. So, from my understanding, many trend followers seem to steer clear of taking short positions. Why do you feel differently about this, and are you just as inclined to go short as you are long?
I am. I think shorts are great. Once again, you got a sample size issue if you don't take include the short trades into your sample of trades. They are historically maybe are not as good as the longs. The average trade is lower than a long trade. I think they add tremendous diversification. You can get a false reading on this, I believe, where if in stocks and bonds you have 20, 30-year bull markets, as we've had, none of the shorts worked in those markets because there was no shorts. Anytime you went short, it was a losing trade because you just had massively sustainable uptrends. I guess 2008, there are periodic decent downtrends. 2008, I take that back. Maybe 2000, was sort of a decent. So sometimes you can get lulled into this idea that shorts don't work, but then really what's happened is you just haven't. It's too short of a time to declare that. My son sent me an email about talking about commodity hedge funds, and a lot of commodity hedge funds going out of business, and the AUM of commodity hedge funds is at this really big low. And I wrote back to him, and I'm like, how could this be during one of the biggest commodity trends in a long, long time? And of course, the answer is because these guys didn't go short. They were long only. And so pulling out a sector from your portfolio, whether it's stocks only, commodities only, interest rates only, currencies only, this is very dangerous, because the return, the risk profile is going to go up dramatically if you're just trading one of those sectors. And then on top of that, to pull out the shorts and do no shorts, then anybody who's sort of seen how these numbers work and how the market's adding these sectors together, adding the shorts to your system, creates this beautiful amount of diversification and way more risk control than you can get just by trading stocks only or anything only. It's tempting to take A+ trades and only take the best ones, and then all of a sudden, I guess I was wrong. Some of these short trades can be good also.
Okay. No, that's really cool to get your take on that, Jerry. Thank you very much. Just moving on to a slightly different subject, have you found that advances in technology have allowed you to create better systems?
Well, we try to stick pretty close to the same strategy: long-term trend following, medium-term trend following, and to keep it straightforward, not too many variables and bells and whistles but definitely when we do our research projects, and we're in the midst of one now that's sort of complicated, it's nice to have that technology and the computers and the programs and smart people doing that for me. I can usually, just by looking at some long-term charts, sort of see what probably works in the markets, and it's nice to have that confirmed and specified by doing the research. And I think that I'm a big fan of good research and doing research and making sure you understand how your system's going to work. But Also, not falling in love with numbers and thinking that the future is going to look a lot like the past. I like to build into my systems some maybe ideas that'll help me preserve profits or preserve capital that looks like maybe have been unnecessary in the past. Some, especially recently, we've tended to see things that we didn't really see in the past data. Now we've got zero interest rates and maybe negative interest rates. So need to think outside of the box a little bit and think above and beyond the past. That's very limited. We need 300 years worth of data, not 30 or 40, and we don't have 300, so we need to be extra careful.
Okay, great answer. Now, I said earlier that I'd like to pick back up on the money management aspect. So let's spend a little time on this. I know many traders might not have actually considered managing other people's money. Do you think it's something they should keep in the back of their mind?
Yes, I think it's a great business, managing other people's money. It's different. It's more rules, more regulations, more overhead, more compliance. It's a different game. It's not as easy as it was when I started. But trading your own money is good. Certainly trading other people's money is good too. It's a sort of a better risk proposition that not all your money's on the line. So if you lose money, it's not all yours. So I think we do both. I trade a lot of my money and I trade clients' money. I think you need to set up a situation where you're not influenced by clients and you fire bad clients and you try to have a meeting of the minds and a good education process so people know what to expect and have them buy into your strategy and like the strategy and believe in it as much as you do. And the choice of leverage is important too.
Yeah, that's actually something I was going to bring up with you. So I imagine that is, a big part of your day is actually managing investors' expectations. What are some of the ways that you do this?
Well, I think you need to let them just be able to describe how you're going to trade. I think we are very good at making sure clients understand what to expect. And we have a sort of an edge with trend and momentum trading is that, things that are trending higher, we're going to be long. If they're trending lower, we're going to be short. And giving them a broad idea about how your risk budget is going to be set up and what they should expect as far as drawdowns and vol. And I definitely am frequently telling clients, you should be able to look at your client statement and understand exactly why we're in the markets that we're in, whether we're long or short, because it shouldn't be too difficult to determine if what's going on, the trend of some of these markets. And so I think selling diversification and risk control and lack of correlation and how managed futures can fit into a portfolio and trying not to focus too much on promising returns is another very good idea. The momentum factor is acknowledged by a lot of smart people and academia as something that is prevalent and hard to explain, in a world of supposedly efficient markets.
Okay, so just further on this subject, as you've taken on more capital over time, has this introduced any challenges to the way that you trade?
I think the most important thing about raising capital, in my opinion, is to make sure that you can maintain the level of diversification that you think is optimal. So for me, it would just be, can I still pretty much have my risk budget in commodities still be 25%, an equal 1/4 of my portfolio? I want it to be commodities. And with the liquidity in the commodity markets or the position limits in commodity markets, that is something that can be challenging if you start raising too much money, because commodities are a great addition to portfolios, especially if you're trend following, especially if you participate on the short side as well as the long side. And it's sort of unique to CTAs to some degree to actively manage commodities and make it sort of 25 to 50% of your portfolio. That's one of the things that CTAs bring to the table.
Okay, so approaching this subject from the other angle, if an individual was to place money with a CTA or a money manager of some sort, what are some of the important questions they should be asking before they even invest?
Oh, we probably talked about every single one of them. Sample size. Do you trade all the markets the same way? Do you trade longs and shorts the same way? Do you take shorts? When do you not take shorts? I think the most important question I guess we haven't touched on this, but I was thinking the other day that nobody ever asked me, like in the midst of losing money, they'll say, "Oh, when are you going to cut back on your stock indices? Or when are you going to cut back on the dollar?" And I'm really concerned. I'm sort of concerned with performance, and I think this is so misplaced because we're not concerned with performance. We're concerned with following the system. So I've never had people come up to me and say, "I know you're having a bad period. I know you're losing money, but I want you to promise me one thing. You're going to always follow this system and never deviate." That's a client I want to meet, because that is the most important thing in the world. Are you going to maintain your discipline? Hey, I'm losing all this money. Do you have? It sounds like you have more faith in these systems than I might. And that's just so counter to what it's all about. I'm fearful of losing money. Cheat if you have to. Don't follow your systems if you think we're going to suffer more drawdowns and losses. So, okay, it's important to come up with good systems, good entries, good exits, diversification and money management. But equally as important, if not more so, even if you have a poor system, you're going to be way ahead if you just follow it and you're disciplined and you never give in, you never give up, you don't abandon it at the wrong time, and because you will if you it's okay to make some changes and subtle improvements, but not if you're succumbing to fear and wanting to get out of the trades and get out of the markets. And so, following these systems, very, very important. They'll eventually turn around. I know, because there's been many times in the early years where I didn't follow the systems, and I'd be much wealthier if I had done that.
Okay. Yeah. And to continue on that path, you've been trading, you've been in the game for well over 30 years now. And you're preaching that you must follow your system. You've got to follow your strategy and stick to your rules. Are you ever affected by making emotional or rational decisions still to this day, or do you now just essentially trade like a robot?
I definitely think it's a huge edge if you can trade like a robot. It's a huge edge. I think that setting the appropriate amount of leverage that you're going to, initially when you first start trading or you start the year or whatever, that's very important. And so if you trade too large and you're too volatile and you can't stick with it, then it's going to be messy to clean that up, and you'll eventually try to override your system. So it's sort of better just to sort of say, look, okay, I made a mistake, or maybe I'm trading too large. This one time I'm going to cut it down and get it to a place where I want it to be. But then let's just start being a robot again and following this system. So you maybe want to have one group of guys and gals who are doing the research and devising the models and the systems, and then another group that creates the trades for the traders to do each day, and then a third group actually does the trades. So no one really has the ability to not do the trades that you're supposed to do. But we're all emotionally influenced, and we all have fundamental opinions and cocktail party talk and politics and economics, and we know it's going to happen, but you just don't want those normal human emotions to impact the trading. Like, you may not feel good, you may feel depressed, and you may know what's coming in the markets, but just don't let it affect the trades. Just be mechanical, be robotic. It's okay to make changes, then make the change, calm, sober, then plan on being robotic for a long period of time.
I like it. Well said, Jerry. Now, my very last question, just to get inside your mind a little bit more. Did you ever anticipate, walking into those doors back in 1984, when you first started out as a turtle trader, that you'd reach the levels of success that you have today?
Well, I thought possibly like intellectually, that I definitely was learning from the very smart people. I didn't realize they'd be so smart in so many different ways and so nice and so kind and such good people and encouraging and such great mentors. But I really did believe, and I still do today, that we had the best training possible. But there's no way I could predict that the markets would grow and that we would have a successful business and that we'd be in business a long time and we'd raise a lot of money. So that business part, I think you can't really expect. But I definitely am not surprised that how we trade and what we trade, how we trade it and what we learned in 1983 still exists. And I've never felt the need to be jealous of anybody else's decision-making processes. Better businessman, yes. Better traders, kind of doubt it, in my opinion. But it's sort of an objective thing too. I'm sure somebody who listens to this podcast is going to blow up my inbox on all the managers who are much better than all the turtles.
No, you've done an awesome job, Jerry. It's been so great to have you on. Where can listeners go to find out more about you?
ChesapeakeCapital.com.
Okay, and your Twitter handle?
RJ Parker Jr. 09.
Okay, awesome.
Big on Twitter. Yes.
Great. All right, well, I'll be sure to include all those links at chatwithtraders.com, of course. Now, Jerry, it was such a huge honor to have you on the podcast, so I do want to say a big thank you, and I really do appreciate you taking the time to do this, so thanks again.
You're very welcome. I've enjoyed it. I thank you for putting time and energy into these questions. I enjoyed it very much. Thank you.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's going on, team? I trust you're doing good. Thank you so much for being here. Now, this week, we have our very first guest from Sweden. Just to keep things interesting, and I know there are quite a few traders who listen to the podcast there, so big shout out to Sweden. For this episode, I spoke with Michael Seeding. Now, Michael was a value investor who spent 15 years in the hedge fund business. And in 2009, he was awarded European Hedge Fund Manager of the Decade before retiring shortly after. During the interview, I asked Michael to share his 3 greatest lessons for traders and investors, how he spotted growth opportunities throughout his career, And I also ask him how his views on money have changed from when he first got started to where he is currently. And we talk about a lot more as well. Now, all of this was really great, but I have to say my favorite part of the conversation was probably the last 10 to 15 minutes, where Michael talks about artificial intelligence and technology becoming one with humans. It's completely off the subject of trading, but it was fascinating. My mind was blown, and I'm sure yours will be too. It's very full on, and I don't say that lightly. All right, guys, that's all for now. I'm Aaron Fifield, and here is Michael Seeding for Chat with Traders, episode 68. Hey, Michael, welcome to the podcast. You're our very first guest from Sweden. How's it going, man?
It's good. Thanks. I'm happy to be on.
Excellent. It's great to have you here, and I appreciate you taking the time to speak with me. So thank you very much. Now, I know there's so much we could talk about. You're an incredibly interesting guy, but let's spend a little time on your earlier years. Then from there, we'll go into how you wound up at a hedge fund. We'll talk about your investing approach, and then we can take it from there. We might get into some discussion about technology and AI, and maybe even the well-being aspect as well. I know you're very big on all those subjects. So how does that sound to you? A good plan?
Yeah, sure. Go ahead.
Great. So from doing a little homework, obviously, before we got on this call, it seems to me that you were always really motivated to succeed and make something of your life from a very young age. Where did this drive and entrepreneurial spirit come from?
I really don't myself see that drive or that it was conscious in any way. But what really happened is that we moved in from another city to a bigger city, and that kind of I guess was the reason I got bullied as a little child, and therefore I turned inward toward mathematics mainly, because that was something that I could understand and control. And once into mathematics, and also when I turned 10, I got a computer as a birthday present. Those two things together made me go deeper and deeper into programming and just being being kind of a lonely child, doing programming and using my whatever math and English I could master to control the computer. So and then once I started programming games, it just came natural to sell computing time for friends and siblings even to pay for using my games that I programmed myself. So I really have no idea where the actual idea came from. I mean, why would I know how to sell things or that was a good thing? More than, I wanted the money, and I thought it natural that if it's my computer and my game, and somebody else wants the time on it, then I'll have to charge for it. So that's not really a drive to succeed or an entrepreneurial spirit, at least not the way I see it. It kind of just happened.
Sure. Okay. So it was almost like a natural instinct. And I did read that you were selling computer games at the age of 11, which I thought was awesome. So moving on from that, what areas did you study in college or university? And perhaps not only study, but what areas did you really excel in?
I wasn't really interested in economics or finance or anything like that. I actually chose the college since I was very tired of school. I kind of lost my interest in mathematics and didn't want to go to an engineering school or a technical school. Just kind of a frenemy of mine suggested this Stockholm School of Economics, and I thought, what the hell? If I go there and study, it seems to be prestigious, and at the same time, it's just economics, which should be very easy. It's very good for me to just walk through with no real intention or ambition. Once there, I was really a really odd guy. They called me the school hippie. I tried to be the odd guy out, I think, because I expected everybody there to be like high-bred and highbrow or whatever you call it, and wearing suits and everything. So I tried to be quite the opposite. And after a while, I realized that I'm kind of getting good grades anyway. So perhaps I should just clean up and try to make something of this. And then I stumbled upon the book American Psycho by Bret Easton Ellis. I just thought it was a weird and cool and like really gross book, but it still kind of talked to me. And so I showed it to my friends, and they realized what he's doing, the American Psycho, and that is he has studied finance, or at least he's working with finance. So now we know what major we should take here. I still didn't get it when it was put that way, but I just tagged along and chose finance as well. And once doing that, I realized that this is actually will take some effort to succeed in, and I've also by that time realized I could get like perfect grades if I just ace a couple of the last courses. So then I, maybe for the first time in my life, really put an effort into school and made sure I got like an incredibly good score on the one test that really mattered. And I was pretty happy when I actually made that, because I didn't think I could. I really needed to get an incredible score on that last test. And I did, and I majored in finance. I think my degree is called Master of Science in Business Administration and Financial Economics, but it's actually so long ago that I can hardly remember.
Right, okay. So now that's really interesting to hear about how you went from having no interest in finance to, developing an interest over the years. So what was your first job actually working within the finance industry? Like, where did you start out?
I started applying for all the big management consultancy firms and investment banks because they came to school and presented themselves, and not least they gave us free food. So all the Goldman Sachs and Anderson Consulting, McKinsey companies, etc., all of those were on my radar, and I applied for all of those. I kind of behaved a bit weirdly on the interviews. I got called to the interviews because of my grades and probably a pretty good cover letter. But once on the interviews, I typically passed maybe the first round of interviews, but then after a while they realized that this is kind of a pretty weird guy. I mean, if you've seen The Big Short and imagine Michael Burry going to an interview and behaving more or less as he did when he interviewed people for a position at his firm, then you kind of get the gist of it. And anyway, in the end, I applied for a broker's assistant position at a very small and newly started broker firm. It was called Scandinavia Fund Commission, and I didn't really know what I was supposed to do there, and I'm not sure I knew that it was kind of a lowly position, but I just thought that I probably should get a job, and there is a crisis here in Sweden between 1991 and 1994. Sweden's economy was in complete tatters. We even had a big debt clock, like Greece should have had, up on one of the most important squares in the middle of city in Stockholm, which basically said that look at this debt clock, how the debt is just ticking up quickly towards doom for Sweden. There's no way around this. That was the general sentiment in economics and financial, all things financial in Sweden in 1994 when I applied for this job. So I really just needed a job. And well, that was in, I think it was April or May 1994. I got the job after quite a surprising number of interviews with all the people at the firm, like the five people driving the firm. Then I got it, and well, I was more or less supposed to just get burgers for those guys in the beginning, and well, do some, well, just be a general resource at the firm. But quite soon they realized that, well, he probably should be more of an analyst guy, and they just put me to the task, said, try looking into these companies and see what you think.
Okay, so you went from being a broker within the same firm to sort of going up a level to becoming an analyst. Was that all within the same firm?
Oh, yeah, sure. So I started there in May 1994, and by October, I released my first research report.
Okay. So what would be interesting to hear about is, what was your actual role as an analyst within, you said you started out as a broker. As an analyst, you must have been with the hedge fund division of the company, if I've got that right. What was your role as an analyst?
Are we talking now about like almost the present time, where I was an analyst and portfolio manager at the hedge fund, or are we talking about what happened at that first job?
Okay, sorry, I thought it was all within the same job. So how did you go on to working with the hedge fund? Maybe I should put it that way.
Oh, all right. After a couple of years at that first job, I got headhunted to another firm, and then as a specialized IT analyst. And at the second job, I stayed on as an IT analyst for like 6 years. And by the end of 1999 and beginning of 2000, I didn't really like what I was seeing in the market anymore. Things were just being ridiculous for IT companies. I thought that you couldn't really buy recommendations for anything, but at the same time, I was more or less forced to have at least some kind of neutral or buy recommendations, and I just couldn't stomach that. So I was about to quit the industry altogether. And right there and then, a friend of mine had found this newly started hedge fund and asked me if I was interested, because they were interested in hiring 2 people specializing in IT and telecom companies. And my friend said that, well, I got a few people that I'm thinking of, but I think you'll be the best suited for this job together with me. So I just presented myself to that firm and went through a couple of interviews, and they thought that, well, this sounds good. Yeah, you can start here. And that was in the beginning of year 2000. Better check. There's one thing here. I didn't stay 6 years at that second firm. There was more like 4 years.
Okay, sure. So what was your role at this new hedge fund? What was your role like? What sort of things were you doing on a day-to-day basis?
I visited companies, mainly technology companies like IT consultancies and software firms. So I visited their top management people, and including chief financial economics and chief financial officers, that is, the CEO, of course, and often some kind of technical guys as well, or sales and marketing guys at those firms. And what I was trying to do was understand the actual business. So it wasn't trying to get any kind of like insider information or trying to get numbers out of the companies in any way. It wasn't really about trying to get at the P&L or balance sheet of the companies better than anybody else. It was more about really understanding what are the business drivers of this company. How are they making money now? Who are their competitors now? Who are the competitors that maybe they don't even know about that I could realize will be their competitors? In what way are they fighting about wallet share at client companies with even with the competitors from another industry? So how is this company fitting into, well, mainly the economy and the industry in general? So and the reason for going into such depth in understanding companies and industries is for the things that happen suddenly in the future. So when there is a sudden shift or sudden change, or somebody making a big acquisition or announcing a new big strategy, that's when all that knowledge is valuable. Up until then, most companies and stocks, they just keep trading in like a normal way, a normal pattern, where you can't really add that much value as an analyst or investor. But it's when things happen quickly that you need to know everything there is to know about a company to realize, okay, what will happen now with this company. So I was visiting a lot of companies, reading through all the material they put out. I mean, of course, the quarterly reports and annual reports, all the press releases, and building models, of course.
Excellent. So I know that a big moment for you, sort of in those early stages of your career, was when you discovered internet tech companies were really undervalued. This could probably lead into somewhat of a technical conversation, but could you share how you noticed this and how you actually made money off discovering this?
First, we have to realize that this was at the broker firm. But the first and the second broker firm. So this was not at the hedge fund. At the hedge fund, it was more the other way around, because the first thing we did there was shorting these companies. It's not that I had a magical insight into things. Maybe it was just being naive. But I just realized that there was a different growth opportunity for these tech companies compared to certain old industrial companies. Actually, talking about this, and seeing myself like 15, 20 years ago, I kind of realized that I was very naive. But I just applied the valuation methods that I brought with me from college, like discounted cash flow models and things like that, and putting growth numbers that I thought were reasonable. I don't think that I did anything more than buy into, more or less drank the Kool-Aid from the tech companies that I were talking to. So I can't really say that I realized things, not in the same way as like Ray Kurzweil or Elon Musk realized things. For me, it was more a question of I was immersed in the world of technology, and therefore I got these amazing growth stories all the time. And the reason I was immersed in it and the reason I exposed myself to all these stories is just that I'd been interested in computers and computing and the promises of technology all my life. So the first time I saw the internet live, I was just blown away. I mean, what is this? It's like I can search for things, and whatever I type into this little box here, there already is a web page for everything. And I realized this back in 1994, and you can imagine how like kind of small the World Wide Web was back then, and still I thought that there's almost nothing I can't type in here that and not get an answer. And I tried showing this for people, and some were amazed, and some just didn't get it. They thought they already had everything they needed, and had no interest at all in some kind of a hyped up yellow pages. Probably I was just like a leaf in the technology wind, but I happened to be in the technology wind.
Yeah, so this raises an interesting point. I mean, how important is it to be a creative thinker in the finance industry? And I know you often call yourself a contrarian. I mean, how important are these two things, within the finance industry?
Depends on where you are in the finance industry. I think mostly you're not supposed to be contrarian. You're not supposed to be creative either. It's better to do all the tried and tested things that everybody else is doing. And it's actually also mostly better to just run with the crowd, because they're mostly right. Even when they're wrong, it's mostly better to run with the crowd. But then there are places where you need to be creative. And well, sometimes it has to do with being creative as a salesman, or more or less making up stories, or finding creative ways of describing companies to make a client buy into them. I don't really particularly like that part of the industry, and I don't really like the corporate finance departments either, where they have to be creative in ways of selling the companies to the general public, or selling stories to make companies merge or spin off or whatever. But when we're talking about analysts and portfolio managers, in particularly regarding stocks, I don't think creativity isn't really that important. I thought it was when I was an IT analyst at Swedbank. I thought that I was creative and visionary and could understand the potential of certain software companies. But now, with hindsight, I actually think I was wrong. I was just drinking their Kool-Aid. So I'm not really sure creativity is important. It can even be dangerous to try to be too creative. And then back to that thing about contrarian, I kind of like the word independent better than contrarian, because independent says that even when you run with the crowd and do everything the same as they do, you can still keep your independent thinking, and because that will be important for those 10% of the time when you're supposed to diverge from the crowd, and that is paramount.
Yeah, no, that's a great answer, Michael. So you've described your approach, maybe just jumping forward to the hedge fund days. You've described your approach as value investing, right? So for the most part, guests that come on this podcast are reasonably active traders. So would you be able to explain for us that the goal of being a value investor?
It mainly has to do with finding the right price for an asset. If you find the right price and start accumulating at that price or below that price, you will make a decent return in the future unless things change dramatically. That's more or less all of it.
Okay, so how do you go about finding the right price? Like, how do you analyze and evaluate a company? Like, how do you know if it's either overbought or oversold? Like, maybe if you could just give us a little bit of an overview from that aspect.
Yeah, I mean, it's a question that can be either answered very shortly or very long-windedly. And I did write a post quite some time back where I was aiming to just put down a couple of, like a handful or maybe 10 points on how to do it. And I ended up writing 50 pretty elaborate step-by-step points on how to go about in that value investing, more or less. And I still didn't really get to the part where you're supposed to how you really do it with a single stock company. I also tried doing this with I tried to write short and simple posts on valuing companies like Amazon or Walmart, and there was some other company as well. And these posts as well turned out to be very long and detailed, and including a lot of Excel work. And I still really didn't get to the point of the actual value investing and what it is you really need to do to find the right value of a company. So I'm quite sure I can't do it now either, if I couldn't do it in many hours of trying to craft good posts on this.
That's fine. What I'll do is I'll link to those posts that you mentioned there in the show notes. So if anyone wants to check those articles out, they can just go to chatwithtraders.com and find your episode, and the links will be there. So I'll grab those links off you after we wrap up this interview.
Yeah, I'll send them to you after this.
Yeah, that'd be great. Now, one question I would like to ask you is, how did you learn to trust your method? Because I think this is something that many traders and investors, of course, probably struggle with.
I think, and I know a lot of people hate this answer, but I think I was lucky. I had the kind of the benefit of making things right a couple of times in the beginning, and that gave me a confidence to keep doing the same thing, even if it looked wrong for a couple of years sometimes. And I also think that I have I'm very patient of nature, which means that I know that some people react when I say like that a certain investment swing I made or a certain investment strategy was wrong for several years, but I never wavered anyway. But I truly think that in the market you can't expect to be right within just a couple of years, because there are so many people involved, and the future it's unknowable, and like pinpointing a trough or a peak, it's just theoretically impossible. Just looking back on any stock chart or any company's history, and it just proves that you can't be right within short periods of time. So you have to be patient. You have to allow yourself to be wrong for very long periods of time, and still trust your method. But back to your question, I just had the luck of being like a bullish IT analyst from the start of, even before Netscape and right up until the peak of the bubble, and then quit the industry. I mean, that was pure luck that I quit at the exact right time. I actually handed in my resignation more or less on the day that Nasdaq peaked, and then joining a hedge fund where I met a lot of unbiased people who were also skeptical towards the IT valuations, and we started shorting IT companies. And when we made a lot of money from that strategy in 2001 and 2002, that must have kind of almost made physical changes in my brain that said that now you can trust yourself. You've made these two incredible swings in your career, being long IT and short IT in the absolute perfect moments over like the last century, and then more or less made two similar swings in one up and one down, even if the up part in 2004 until 2006 perhaps wasn't that great. I think that the first two ones were more or less luck, but after that I just got the confidence and the patience to stick with my calibration of markets. But then again, you have to realize that during 2012 until 2015, I've been completely wrong, since I still have the same calibration of what value and growth and how to look at the stock market and the economy. I still have the same views as I had up until 2012. And that means that between 2012 and 2015, I've been too bearish. Or maybe we'll see if I was or if I wasn't.
I like that. And I also like how you did mention that, there was some aspect of luck, and also like how you mentioned patience. Both are really great points there. So in your answer there, you mentioned that you as a value investor, there are times when you're going to be wrong and you have to be able to ride out a long position for a long amount of time. How did you think about risk in that case? And were you always comfortable with the amount of risk you took?
I was definitely comfortable with the amount of risk. I never took really big risks, and at most I put like 5% of the fund's value in a single stock, and at most 20-25% in a single industry, and shared over like 4 or 5 or 6 different companies. So that didn't feel like a lot of risk. As I say, I always also had the other partners backing. I mean, we all pitched all the stories to each other and made sure that they had some kind of a standard. It didn't really feel risky in the way that you might think.
Sure. Okay. That definitely makes sense. Now, Michael, you've got an ebook which is available on your website, and I'm going to link to it in the show notes also. And in that ebook, it's pretty extensive, and you cover 50 lessons that you learned, over your 15 years as a hedge fund manager. Would you be able to share with us maybe just your top, maybe 2 or 3 tips from that book? Maybe your favorite ones?
Yeah, sure. I've touched upon one of them numerous times already, and that's just being patient. There's never any reason to rush into investing. If you feel rushed, you're probably late already. So just be patient. I mean, one way of thinking of this is that if you're 18 years old today, you've probably never owned a share anyway in your life, and you'll still do good. So you missed out 18 years of investing, but you'll still do good. And if you're newborn today, you probably will miss the next 18 years, and that's fine as well. Opportunities always cycle back, so it's better to wait for a good opportunity than to rush in. So study, wait, then pounce. That's the absolutely most important lesson of all, to just be patient. And that's also a thing that you as an individual investor has as an advantage versus institutional investors, because they often can't wait. They have to be fully invested. They have a lot of clients asking what they're doing with their money. So they can't wait. They can't wait, but you can. So wait. And then never go all in. You always need to keep some powder dry, both in up markets and in down markets. It's more important when things are crashing, because then you can always add on to your positions. But just never put it all on red, because the future really is unknowable. And if you put all the eggs in the same basket, you're almost asking for an elephant to step on it. There's never any reason to go all in. I'm not sure exactly how to elaborate more on that, but just never go all in. You should seek opposite counsel at all times. Whenever you're enamored with your investments, at least if you've done your investment, try to find opposite information. Any kind of information that hurts hearing, that's the one you should listen to.
Okay. So don't get too caught up in your own opinion, your own bias, I guess you could say. Is that right?
Yeah, because we as people, we are biased to find supportive information. Anything we hear that supports our case, it feels good. You feel almost happy and exhilarated whenever you hear somebody say, and it's very high growth in that industry, and I heard he's buying, and that's the things you should not listen to. You should look for anybody having a sell recommendation instead and talk to him and listen carefully.
Yeah, I like that. And I spoke with a trader just the other day on another interview, and he mentioned that, a good systems developer, obviously talking about a slightly different subject here, but a good systems developer will try to find ways to break his system instead of trying to find ways to actually ways to support it and prove that it's right. He'll do everything he can to try and break it and find the flaws in it. So I think that's a really valid point. Thanks for sharing that, Michael. Now, many people who know of you already will know that you were awarded the European Hedge Fund Manager of the Decade in 2009. Now, from what I understand, it was shortly after you received that award, which is very significant, so well done, that you decided to retire from being a hedge fund manager. Why did you decide to retire?
I'd been thinking about quitting the finance industry since 2000, but after that award, and let's say maybe about a year or two after that award, I thought, for one, that I had enough money, so there was no real reason to just get more. Except for just being in the rat race, you think you always need more, and you always think that, if I got this much now, I can live with a certain standard. But then if I get a partner or kids, then I need twice as much or four times as much. So partly that was what kept pushing me forward, just doing one more year all the time. But mainly the reason to quit was to develop other sides of myself. I was more and more feeling that the only thing I do is stare at numbers. I sit in a chair all day, I stare at numbers, and I go over the same quarterly earnings year after year after year for the same companies, more or less. I can almost physically feel my brain shrinking, that and also when meeting new people, it was as if the only thing I could talk about was finance, and I didn't like that about myself. And also, once I kind of just stepped outside myself for a little while and observed myself, I didn't really recognize myself from before, the things that made me smile or laugh when I was younger. So I thought that what I really need to do is I just need to quit this, open up a lot of space and time for myself, and just see what happens.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
And that leads me into a question that I really wanted to ask you about. I think now's a good time to do that. So how have your views on money changed from when you first entered finance to like where you are now and at that point where you actually quit the hedge fund? How have your views on money changed?
If you think back to the story about me programming and selling computer games at 11, it seems I had a natural greed. And I really loved money. I loved counting money when I was little, which is weird as well, I think. And once I started getting some decent bonuses and dividends, it was a great feeling having a lot of money. But I never really analyzed why it felt good. It probably just felt good because I hadn't had any before. But I didn't really seem to use the money for much good. Not even for well, the one thing you really can use money for, it's actually quitting and getting more leisure time, because time is important. But it's very easy to just get caught up in this game of getting more and more money without really understanding why or what you're supposed to do with it. It's like a rat in an experiment, just pushing a button and getting an electrical shock into the pleasure center of the brain. But they don't really have any aim or ambition or reason for doing it. Anyway, so once I got a lot of money, I thought that I wanted sports cars and things like that. So I started buying them, and that felt good as well. Up until after a decent number of years with sports cars, I realized that I'm not really enjoying this one. It's just a hassle keeping the battery fresh, finding places to park it without getting key scratches, which I did get, things like that, and I also realized that, of course, I kind of like the sight of it when I walk up to it, but once I'm in the car, it's more or less just a hassle again. I have to drive it. I can't see it. It doesn't really provide me any extra value. If I want to get anywhere, it's much easier to just take the bus or walk. So there was no pleasure at all in having an expensive sports car, and so I sold that one. Never bought any new car, and once I had gone through that process, I had the kind of tool to analyze the rest of my life, and that's when I more or less completely realized that I'm not interested in things you can buy. So it's really hard analyzing yourself. And it's hard even now imagining that I had a different view on money and riches before as compared to now. It feels like I'm the same person. That's how the brain is supposed to work as well. I mean, it's just keeping a narrative to make me happy anyway. So I realized that you have to go into yourself and find what actually is making you happy, rather than going with kind of the flow of society of what other people say should make you happy.
Yeah, that's a really interesting answer. I like it. So I guess where are you focusing your time and efforts today? I know you're drawn to advances in technology. Are there any specific areas of tech that you're interested in?
I think artificial intelligence is the most exciting area of all. Not that I can make a contribution or do anything other than just watch, but I think that's tremendously interesting. It's going to affect all of our lives.
Yeah, and I agree with you on that one. It is very interesting. And the way you see it, what role will AI play in the near future? Like, what impact will it have on our lives, maybe over the next 10 or 20 years?
I think over the next 10 or 20 years, more than half of all kinds of work will be done by AIs. From all the types of transportation, like if you're a truck driver or a taxi driver or any kind of driver, you will be out of work in the coming 20 years. Maybe not 10, but somewhere between 10 and 20 years, I think it will become illegal for people to drive any kind of vehicle because it's dangerous for themselves and people around them. And you'll have a lot of work like being a paralegal or somebody doing taxes. I don't know, but anything that you can even remotely conceive of being automated will be automated. If you just take a list of professions, I think you can more or less scratch most of them out because they will be taken over by AIs.
Yeah, and I mean, some people freak out at the mention of AI. And I mean, some of those things you just mentioned there could be somewhat concerning to a lot of people. Do you think people should be worried about this type of technology?
No, not really, because I think it's a kind of a binary situation. Either there will be a malevolent AI that will just erase us, and that will happen extremely quickly, instantly, more or less. Once it happens, it will not be like in the Terminator movies where it's like a drawn-out war. They will just do it. It's like imagine a mosquito landing on your forearm. You are the AI, and that's humanity. It's not more of a challenge than that. Once it happens, so there's no real reason worrying about what will happen between the AI and humanity. But then again, in terms of the next, let's say, 10 to 25 years, things could get kind of challenging for anybody who doesn't keep up with technology, because during that period, what's important is being able to use the simple and narrow AIs and all the kinds of tools that technology will bring. It will be important to use that to enhance yourself, to keep up and to stay relevant. So that's the only challenge. But I don't think that's not anything to be worried about, as long as you keep an agile mind and are open to change.
Okay, so you kind of just mentioned that it's nothing to really be too worried about, but you also kind of hinted that it's possible that it might just wipe out the whole human race. Or did I misunderstand that?
No, that is exactly right. But if it wanted to, if that happens, there's nothing we can do about it.
Well, I mean, we could stop developing this type of technology, couldn't we? But
no, I don't think that's possible. I mean, you've got 10 billion people tinkering everywhere. Somebody will do it. So it's better to, I think, to accelerate the development and try. Well, the ones who are involved in this, that they try to make it the best way they can, and hopefully. A benevolent AI will be the first one, and that will keep all the other ones in check. But we can never know. It's completely unknowable. Just make this thought experiment. if you got a big ape and then you get a human, I mean, you think there's a big difference in intelligence. But then if you look into humanity and you've got like the village fool, and then you have Mr. Aaron Fifield, and then you have Einstein. But imagine, okay, Einstein is probably smarter than you are. Imagine somebody who's twice as smart as Einstein. And then you imagine somebody who's like 1 trillion times as smart as Einstein. An intelligence of that order of size, it's just completely unknowable for us to fathom what that thing could do. I mean, even somebody who's just twice as smart as Einstein, and Einstein thought of things 100 years ago that we're still completely awed by. So there's really, well, I think there will be very strong generalized AIs in the order of sizes of thousands and trillions and billions of an ordinary human, and we can just hope that they think that we are interesting pets, or that we merge with them in some kind of the Borgs in Star Trek.
So when you're referring to AIs here, you're talking about AI in the form of a robot or in the form of something else?
I think something else is a more practical way of looking at it. I don't think they need to take a particular physical form, but at the same time, in order to interact with the world, it has to control various machines and things. But it's not really relevant to think of like a Boston Dynamic big dog or some humanoid walking around and being the AI. I mean, the AI will be in redundant servers spread out, probably in a ring round the Earth, rather than down on the ground. Once we get to that point, and in the beginning, it will just be redundant servers spread out all over the planet. So it won't be centralized and staying just in one place, but it will be just a very powerful software program that can also control all physical things connected to the net. So the Internet of Things more or less makes sure that this AI will have control of every physical product there is. Okay.
It's interesting. It's a really interesting subject. I do find it fascinating, and maybe a little bit frightening, but no, it's awesome. We could probably keep going on this for quite some time, but there's one other subject I'd like to bring up with you, and that's the health and well-being aspect. I know this is extremely important to you. So why is it? I mean, it might be a silly question, but why is it so important to you? Because, I mean, us as traders, often we do neglect physical exercise. We're stuck behind computer screens for long hours some days. Why is physical exercise so important in your life?
As always, the answer is kind of the opposite of it's that it's not important for me. It just is. And actually, up until I was 13 or 14, I thought that a modern human, and by modern I meant anybody owning a computer, which everybody should, I thought back then, did not need physical strength at all. I thought it was just silly, like caveman style. You do not need physical exercise. And then I saw Rocky IV, the movie with Sylvester Stallone and Dolph Lundgren, and I thought, a modern human needs muscles in order to get women. So I started working out when I was 14 because of that movie. Nothing more than that. And then I just kept on. It's almost like my whole career. I just can't stop myself. So I started doing martial arts, and I lifted weights. And once I started working, I couldn't keep up with the hours anymore in martial arts. So I just had to stick to weightlifting, and then during a couple of years, I even stopped that completely in order to focus 100% on my job, because I thought that's what you do when you are working. You don't have time for anything else. I even broke up with my girlfriend on day one when I started working. I mean, I still loved her, but I just told her, this is the way it is. Once you get into finance, you don't have a life. You work, nothing else. But then in 1996, when I switched job places, I started working out again, because I just felt weak to my bone. I realized that it can't be good not keeping in shape. I really need to keep in shape, and at that time also the opportunity opened up to work a little less, and I realized that you have to have some kind of a work-life balance. And it's really after 1996, that I started reading things about health, and I also saw the connection between the body and the brain, how the brain really is with thinking is evolved from analyzing motion, both yours and prey motion. So thinking is moving, and moving is thinking. So staying healthy. Well, you kind of phrase it as, why is it important for a trader or an analyst to be healthy? Well, maybe it isn't, but it's important for you as a person anyway. Living is being healthy, and there is a much more important world out there outside of your trading chair. So it's not really about staying alert or keeping your brain fit by keeping your body fit, and thereby being able to trade better. That's really not what I'm getting at. I'm more getting at, you will be a better person in general if you work out as well.
Okay, that's a great answer. That's a really great answer. Now, one last question before we wrap things up here. And I don't even know if I've actually phrased this question right, because I've got to be completely honest, I don't actually understand these terms, but can you share with us insight to the singularity and transhumanist belief or outlook that you have on life?
Yeah, sure. The singularity is the technological singularity. That's a point in time where technology advances in such a fast pace. It's actually, the acceleration is accelerating in such a fast pace that an unenhanced human cannot keep up. So if you just think back through history and look at various technological milestones, they keep happening faster and faster. And so some people maybe think that it's interesting to see how the World Wide Web really started taking off in let's say 1995 when Netscape was IPO'd, and then you have the iPhone in 2007 and Google and Facebook and those things. And there will be more and more important technological milestones happening faster and faster. So at some point in time, you'll see breakthroughs like Google or the iPhone coming along, not every 10 years, but every 5 years, and then every 2 years, and then every 1 year. And you can just keep going with this process. And sooner or later, you'll have technological breakthroughs once a second, and then once every 100th of a second. And once you get to that point, you realize that there is no way anybody can keep up. And the way we get to this point, of course, is that more and more stronger and stronger artificial intelligences are what will be doing the research, and they will use the outcomes of the research as their own tools for improving on themselves and improving the research and coming up with the next point, the next milestone. So will not really be humans doing it, but machines. And then they will use whatever they come up with to improve on their own technology, and thereby also improving on the speed that things are happening. So at the point where it's just impossible for a human to keep up with all the new things happening, that's the technological singularity. And beyond that point, there just isn't any, we just can't analyze what happens beyond that point. It's just unfathomable for us. It's impossible to understand. But the way to kind of keep up as long as possible is being a transhumanist, that is merging as best as possible with technology. So we have already started with having smartphones in our pockets, and pretty soon they won't be smartphones, they will be contact lenses with augmented reality and all the intelligence baked into these wireless contact lenses. And after that, we'll just merge more and more with technology, probably infuse our blood with respiricides, technological blood, red blood cells that are like 1 million times more effective than the current ones. So you could easily just keep your breath for 4 hours while doing a full sprint up a mountain. That could be come in handy. And that's physical, but you could do the same thing with your brain, where you replace one brain cell. Well, you can put in an artificial brain cell in parallel, one at a time, and then when you feel comfortable, start extinguishing the original brain cells and make more place for more artificial brain cells, and then maybe be 1 million or 1 billion times smarter than you are today. Since the signaling in electronics is like 1 million times faster than the signaling in organical processes. So even without a better architecture, you should be at least able to think 1 million times faster with the same architecture. So that's the singularity and transhumanism in kind of one small package.
Wow. That's fascinating and really full on. No, that was great. Okay, Michael. Well, let's wind this down. One last question I have, and that is, where can listeners go to find out more about you?
I have this website. It's called michaelseeding.com. So that's my name.com simply. I'm sure you have somewhere to put that in. It's well, the spelling isn't that easy for a non-Swede.
Yeah, I'll be sure to include that in the show notes. So guys, you'll be able to find that at chatwithtraders.com. Okay, Michael, well, thank you so much for doing this. It was a really great conversation. I'm pleased we could set this up. So yeah, thank you once again for taking the time. I really do appreciate it.
Yeah, sure. It was really good to be on.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. The precision and ready to trade beyond.
Hey there, what's up? How you doing, folks? Welcome to another trader to a slightly lesser extent. He's been trading for around about 25 years now, His typical holding time for any given trade is just a couple of days, and he classifies himself as an aggressive trader, which I think you'll pick up on that pretty quickly also. In this interview, you'll hear I ask John about the multiple boom and bust cycles he endured over the space of about 8 years before gaining any real consistency. I also ask, is a high risk tolerance essential for becoming a successful trader? So you'll get John's take on that as well. Then we get into some talk about options, and John has some really great advice for those who are still trying to find their feet. Additionally, we talk about indicators and technical analysis, and we go step by step through John's $1 million test the trade. So there's a lot packed into this episode. I hope you enjoy it, but more than that, I hope you can take at least just one thing away from this and apply it to your own trading. Okay, let's get to it. Here is my interview with John Carter. Okay, and we're rolling. John, it's good to be speaking with you, buddy. How you doing?
Good, Aaron. Thanks for having me on. It's a pleasure, and hope you're up bright and early out there in Australia. It's evening time over here, so I can probably have a beer and you can't at this time. But
always up nice and early. So thank you very much for being here, John. I really do appreciate you taking the time to do this. I'm sure you have a very busy schedule on your hands, but I'm glad you could fit this in. So as we're recording this, we're just about to close out the first quarter for 2016. I'd like to ask, how has trading been for you this year so far?
You know, it's been really good. I'll tell you specifically about the account that I like to use. Which is rare. I was 100% flat as of December 31st. I just didn't understand the markets, and I was a little upset at myself because as a trader, I love the short side, and so I wake up the first trading day of the year, and the markets are just getting hammered. And when they're getting hammered, it's hard to get in. And so the first week, I literally just watched the markets collapse. And it was a little painful. I mean, on the one hand, at least I wasn't long. But on the other hand, as a trader, you don't like missing moves like that. And so it took me a little while to get into a groove. And I would say that then when I started trading, it was a little hit or miss. And then so the account that I use, I have this, I start every year back at about $180,000, and it's my model account. This is the one that everybody in our trading room can see. And I'm pretty transparent. It's just like, hey, these are my winning trades. These are my losing trades. I show my P&L. So as of today's close, that $185,000 account's at $307,000. So I think that's up about 60 some odd percent. I mean, I'm a very aggressive trader, but the goal is, and this has been mostly options trades with some futures trades, but my goal with this account is to turn it into $1 million by the end of the year. So I'm either going to do great or I'm going to fall flat on my face, and then everybody gets to watch me.
Okay, well, it sounds like you're off to a good start. That's for sure. That's you're doing really well. So props to you. And you said something really interesting right at the start there about how the market sort of took off, and you were upset that you weren't in it. Like, how do you deal with that? Do you just realize that you've potentially missed the move and you know that you have to sit on your hands now, or do you jump into it with a smaller position size? Like, how do you manage those sorts of situations? Because I know it can be very frustrating when you see a move which you were kind of anticipating, but it just takes off without you and you're not on it. How do you deal with that?
It's one of those things you would think, and I've been trading, I would say actively now for almost 25 years, which isn't crazy because it seems like it was just yesterday. But with experience comes patience, and that was one of my mentors. And it didn't sink in when they taught me this. One of my mentors, after about 6 years of trading, sat me down and said, "Look, this guy had been trading for like 30 years." He said, look, the difference between traders who can do this for a living and those who can't is patience. Patience to wait for the right opportunity, patience to sit in a winning trade. And he's like, otherwise, it's game over. And I didn't appreciate that at the time. But what I've learned, and also my father who kind of got me into trading, every once in a while, I remember when I first started, I'd say, oh, God, I can't believe I missed this move. And he just laughed. He's like, look, I promise you the markets are going to be open tomorrow and there's going to be another opportunity. And so what happened was I sat there for a week doing nothing. And it was so painful because at least the U.S. markets, the Dow was down 300 points a day. And had I been positioned correctly, I just could have made a lot of money. And it's frustrating, but what I've learned in doing this over time is that when you get emotional and you chase, you get yourself in a mindset where you actually miss what's really going on. And you get yourself in a mindset that when a real opportunity comes along, you're just not ready because you're chasing, you're emotionally vested in something that, it wasn't really a setup. You just felt like you were being left out. And that's just something that comes with experience. I mean, at some point you can kind of snap your fingers and say, okay, I'm not going to chase stuff anymore. But after a while, what happens is you just learn the opportunity cost of doing that. First of all, you're usually getting, the last one to get in. And then secondly, your brain's all messed up because, it's a purely emotional trade, and emotional trades just over the long run just aren't consistent. So, and that's how I've learned to kind of deal with it.
Sure. Okay. No, I think you answered that really well. There's a lot of really great insight in that answer. We're off to a good start. So I'd like to ask you, you've already kind of mentioned that there's some market blood that runs in the family. Tell us about how you actually first got into trading.
So when I was 18, I was working at a mall at a cookie store, which was a thankless job. You made like $4 an hour. And making cookie dough and then selling cookies to kids that came up, with their moms at the mall. And over the course of a summer, I'd saved up about $1,000. And I came home towards the end of the summer. It was a Sunday night. My dad and his friends, they're sitting around the table. They got copies of Investor's Business Daily. And as I'm walking by, I just hear someone say, well, gosh, I could, I'd probably make $1,000 on that trade. And and in my mind, I'm going like, well, I've got $1,000 in my bank account now. So so I just kind of asked, what are you guys talking about? So the short version is, I had no idea what they were talking about, but they were going to buy some call options on Intel that week. And I didn't know what Intel was. I didn't know what a call option was, but I said, look, I'm 18. I got nothing to lose. I was like, can I open an account and do this trade? And they're like, well, you're not going to have time to open an account and fill out all the paperwork, but we'll spot you. Give us $1,000. I'll buy 10 contracts for you. And if it loses money, you're SOL, shit out of luck. But if it makes money, we'll give it to you. Like, done. So what happened is that these options that they bought at $1, they sold it at $1.80. So I had worked for 3 months, 8 hours a day, 5 days a week to make $1,000. And now in the course of 5 days doing absolutely nothing, I made $800. And at that point I was hooked. And it was, I just kind of realized how the power of having your own money work for you instead of, doing physical labor. I mean, not that there's anything wrong with physical labor. It's good to get out and work, but it was just, we're worth so much more than what somebody's willing to pay us per hour is really what it came down to.
No doubt. And I think that's what, a lot of traders realize and what's got them, pursuing this. So yeah, no, I totally understand where you're coming from. Now, in past interviews, I've heard you talk about when you did start getting into trading, you went through several boom and bust cycles. I'd love to ask you, what did those boom and bust cycles actually look like?
So I've always been a pretty decent risk taker for whatever reason. I mean, I think everybody's just wired, you're kind of born with inherent things. And when I started trading, I was very good at making a lot of money, and then I would lose it. So there was 3 times over the course of my college and my working career where I'd have, say, $10,000, and then over the course of about a year, I would run it up to like $100,000. And I was taking crazy risks in terms of position sizing. It's like, wow, I like this, so I'm just going to put my entire account into this trade. And if it worked, great. And if it didn't work, so what would typically happen is I'd have $10,000, it would jump to 20, drop back to 13, jump up to 27, drop back to, 18. But what would happen is when I'd get to about $110,000, $120,000, I would step back and go, wow, I just went from 10 to like 100. So now I'm going to go from 100 to like 1,000,000. And what happened was, and it just took me forever to figure this out. But what I finally figured out is that I started focusing on the $1 million. Before, I was just trading. I didn't have a goal. I was just like, here's a trade. Let's take it. I want to make some money. But when I started focusing on, I'm going to make $1 million, I changed my trading approach. And what would happen is if I had a losing trade, whereas before I would just get out, I'm like, this isn't working, get me out of this. What happened is that I would say, gosh, I'm trying to make $1 million, so I can't take this loss. I've got to at least get out at break even. So I started doing stupid things. And so that happened to me 3 times where I would, make this money, blow it up. And after the 3rd time, I went through kind of a very kind of a gut wrenching learning cycle and kind of, conversation with myself going like, do I want to keep putting myself through this? And at the time I was just about to get married. It's like, if I'm going to get married and have kids, am I going to put my family through this? And I just had to come to terms with what was it that I was doing? And so that's what I kind of figured out. I mean, I ran across Mark Douglas's book, The Disciplined Trader, at that point, and then Trading in the Zone. That helped a lot. Talked to some traders, and then I just said, all right, if I'm going to do this, let's act like a professional. Don't try to quote unquote, make $1 million, and let's do this. And that changed things. It didn't mean that I never had obviously losing trades or drawdowns, but I never blew up an account after that.
Okay, sure. So a couple things I'd like to ask you, just to bounce off your response there. You obviously, by nature, have quite a big appetite for risk. You're very comfortable in many ways taking large amounts of risk. Do you think that's a necessary trait to be a successful trader?
So there's a fine line. You can take too much risk, but I think I don't know what is worse. If it's, if you have an appetite for too much risk or if you're too conservative. And I've seen both. And obviously too much risk opens up the door of you're going to make a lot of money and then you're just going to blow up. I mean, that's the too much risk scenario. If you have too much fear though, I mean, the good news is with too much fear, you're not going to lose a lot, but you're not going to make a living as a trader either. And I think that's one of the things that, people kind of confuse is that, let's say, you've got whatever amount of money that you have to trade with, $50,000, $10,000, whatever it is. But I think one of the goals of a lot of people, and this was certainly my goal for a while, was, okay, I'm working at this job, I'm getting this check. And when I was working in the corporate world, at one point I was making right up at around $100,000 a year. So I was like, all right, if I'm going to quit my job, I need to make, $8,500 a month trading. And what happens is that if you're too aggressive in that situation, your account's making swings that don't make sense with your goals. But if you're too fearful, you're going to not make nearly enough money to meet your goals. The biggest problem with being too fearful is that you wait, as a trader, you wait for confirmation. And the problem with waiting for confirmation in trading is that by the time something is confirmed and all the indicators are aligned that this is a buy signal, that's usually the time that you should be taking profits. Like, everybody's looking at the same charts. And if everybody thinks that something looks good and everybody's long, no one's left to buy. And at that point, it rolls over. And so that's why sometimes it feels like, if you're in a pattern where you're buying something and as soon as you buy something, it goes down. Well, usually it's because there's 27 indicators that someone's been watching and now they're finally all lined up. So you feel quote unquote safe to take the trade. But, at that point, it's like, now it's so obvious that everybody's getting out.
Right. Okay. And we might get into that a little bit more in just a bit. The other thing I was going to ask you was, you mentioned Mark Douglas's book, Trading in the Zone. I've heard you speak about this in the past also. What was it about this book that was such a huge help in getting you to the point where you could achieve consistency? Like, what was it about this book that really clicked with you?
One of the things, and when I first read the books, I didn't know Mark. I eventually got to know him, and we became friends. And he recently passed in August, which was was a complete surprise. But his knowledge of the markets, and B, the human mind, and then C, how the two interacted, is unparalleled. And anybody who's making their own trade decisions, i.e., they're not just turning it over to a computer. Anyone who's making their own trade decisions without having read Mark Douglas's books is at a disadvantage, because he's just learned, and he's got an intuitive sense of how the markets like prey on people. And it does. I mean, it sucks people in at the wrong time. It's just all these weird things. And it's just, you just learn that the main thing that you learn from reading Mark's books is that to trade successfully, you've got to understand what your mind should be thinking while you're in a trade. And how your mind should be thinking while you're in a trade is about probabilities. And you need to have a probabilistic mindset, meaning that, hey, you know what? Anything can happen. Just because I'm long doesn't mean the stock's going to go up. Anything can happen. And if you realize that anything can happen, then you kind of get a little bit more relaxed. You focus more on risk. You don't take small profits, because if anything could happen, it could turn into a big winner. And when I got my arms wrapped around that, I mean, my trading just changed. It's one of those like, wow, my winners are bigger now and my losses are smaller. This is amazing.
Okay. So just so we can put this into perspective, so from the point where you got started, you came into trading, you went through these boom and bust cycles 3 times over, until the point where you achieved some sort of consistency, how long was that time frame?
Gosh, that's a good question. Okay, so I traded. I would say that my learning curve for trading was probably longer than most people's, and the reason for that is because I stuck with it longer than I should have. A lot of people I know, they try trading for 2 years, it doesn't work, and they give up. So, and I'll back up here a little bit. And there's a reason. The reason I was able to last longer, I guess, is that when I had those 3 boom and bust cycles, and I would take 10,000 and turn it into 130,000, and then think okay, I'm going to make $1 million. The one smart thing I would do is that I would say, all right, I'm going to take 30,000 out. I'm going to put it into real estate. I'm going to put down payments on 2 houses, and I'm going to rent them out. And so what happened is that there's two things that happen there. One, by the time I busted my 3rd account, I actually had some real estate. So when I finally was like, I'm going to take this for real, I could sell that real estate, and raise another stake. So that was semi-important. But, the idea that you can always get a stake. I mean, you can, if you have trading skills, you could trade somebody else's account. I mean, there's always ways to get a stake if you're determined. But the thing is that now I just went off on a tangent, so I kind of forgot the question. So what was the question?
I was asking you about how long it took you from when you first started out up until the point where you achieved some form of consistency. Like, how long was that time frame?
Okay, so at this point, when I finally read Mark Douglas's book and I went through all that, it was 8 years, and it was and I put my fiance through hell. I mean, there was a couple of times where, we were going to buy a house and couldn't buy the house because I blew up an account. I mean, that kind of stuff. And we're still married to this day and have kids. So, she's a keeper. But, part of my mission, I mean, I love trading. At the end of the day, my life would be a lot easier if I just traded. But I don't think it needs to be 8 years of frustration to learn how to trade. I think you got to put in the time. I mean, nobody's going to learn on day one, but I like to compress the learning curve with other folks. For me, it took 8 years. I think for the average trader that has the right tools, it can be 2 years. And the reason I say that is that people have to figure out, they have to see different market conditions. And the one thing that's unknown is how people react. If you've got money on the line and the market starts going against you or it gaps against you, how are you going to react? Are you going to freak out? Are you going to be deer in the headlights? Are you going to be able to calmly take action? And that's a little different for everyone. The sooner that you can get to the point where that you just focus on probabilities and you let go of any emotional attachment to the outcome, the sooner you're going to be consistent.
Okay. All right, John, well, let's focus in now a little more on how you trade today. So how would you describe your method and your overall approach to markets?
So the main thing with that is I think it's good for every trader to find their sweet spot. So for some people, it's going to be, there's this idea of you need to kind of match your trading to your personality. Now, I am not what I would call, so to me, there's 4 types of trading. There's scalping / day trading, there's swing trading, there's position trading, there's investing. My sweet spot is a swing trader. I don't really have a lot of interest in buying, watching a 1-minute chart, buying something and then selling it, 3 minutes later. Now, it seems like that's safe and it does create a lot of adrenaline. What a lot of people don't realize is that you generate so much commissions that it's almost impossible to make money. If you have a $20,000 account and you're day trading, it is very likely that you are spending $20,000 a year in commissions. So it's like you have to make 100% a year just to pay your broker. And people you just don't realize that until you start tracking it. So to me, the sweet spot though is, within 5 minutes, that's not worth it. Over the course of 3 months, I think it's just hard to predict. But, 2 days to 2 weeks, that's kind of my sweet spot. And so that's what I'm interested in. So I'm not looking at 5-minute charts during the day. And by the way, one of the best things I ever did was just took my 5-minute charts and just threw them away. I look at 30-minute charts, basically kind of hourly charts, then daily and weekly charts. And I'm just looking for setups that I want to be in something. If I'm buying something on Tuesday, I'm like, I want to be, the earliest I would sell it is Thursday unless I'm stopped out. And that to me is a nice sweet spot. You can get aggressive. You can catch nice little pops. And the markets tend to do that. They tend to move in little pops and then consolidate. And so that's what I kind of look for. And that for me works really well.
Okay. And what markets or products are you most actively trading?
I cut my teeth on the stock index futures. So I like the stock indexes in the US. So the, E-mini S&Ps, E-mini NASDAQ. But I'm also a big options trader on individual stocks. So, and the two are very complementary. So, if I'm bullish on the ES, then great. What are the strongest stocks? Tesla, Google, Amazon. Then I could buy some call options on those. And so to me, those all work together. I'm also big on correlations. It's like, okay, if the yen futures are going higher, is that going to mean, weakness for stocks and things like that? So I do like to look at kind of those leverage instruments. And I'm a big believer that, and I watch the Australian dollar too. And, the fact that, when oil and gold were coming off and, Australia, here's a funny story. In 2008, I actually flew out to Australia to give a talk. And I'm a big fan of buying the country that you're going to, buy the currency before you go there, just in case you need it. So I bought it about a month before I went, and I bought it when the ratio of Aussie dollar to USD was 1-to-1. And then by the time I got there in October of 2008, it had fallen in half. So that was that was a really bad trade because I bought them for $1 and they were worth only half that by the time I got there. But that was, the markets, the world economies are all tied in together. And here's the thing is that you don't need to know that. You do not need to know that if the yen goes higher, stocks might go lower. All you have to do is have a handful of good setups. And the traders that I've learned, that have mentored me and have been doing this for 30 plus years, they all have like, oh, I've got 3 setups and I watch 4 markets and that's it. They don't care what's going on. They don't watch the news. They're not looking for the latest tips. They just have their niche and they kind of, grind it out and make some money. And I'm a big believer in that. I actually think the less information you have, the better you'll do, because otherwise you just get distracted.
Okay. Yeah. No, I think that's a great point you raise. Now, something you said a little earlier about, traders might see some sort of consistency after putting in 2 years of good work. And the reason for that was because over that time, they'll experience different market conditions, and we'll go through different regimes. How did your trading change depending on what type of market we're going through at the time?
That's a good question, because one of the things that it took me a long time to learn is that you don't do the same trades all the time. Is it a bullish market? Is it a bearish market? And so what I think the art of trading has come down to a couple things. One of them is knowing that there are 3 positions that you can have. You can be long, you can be short, or you can be flat. And the longer I do this, the more I realize that flat is one of the best positions, because when you're flat, your mind is neutral. You're not, there's a saying that I heard by a friend of mine, a trader in London, and he's like, don't piddle away your chips, which is like, in the US, we'd say, don't piss away your capital. And if there's nothing to do and you're bored, just go do something else. Wait, be patient. And right now, the markets are kind of interesting because we had this, super bearish sentiment in January. And then in February, all the signals that I've gotten have been long, but my brain was screaming to be short, which was interesting. And so I've learned to just trust the signals. Like, hey, this is a bullish signal, buy it. And the main thing that I've learned is that, there's first of all, no trading day is alike, but there are kind of cycles. And if it's a bullish cycle, great. If you're in at the beginning of the bullish cycle and you've got some signals that are going in there, load the boat and ride it out. But like right now, we've had this fantastic rally since the beginning of February to now. This is not the time to load the boat on longs, but it's not the time to load the boat on shorts either, because there's no short signals. I'm playing it pretty light. I'm just kind of in hurry up and wait mode. And what I've found in trading is that if you can be patient over the course of a trading year, there's going to be 1 or 2 days a month where if you're focused and you've got a neutral state of mind, you can dive in, have a larger than normal position, and make a killing, and then get out and go flat again. And that's really what it's all about. As a trader, it's hard to do that because you think you should always be trading. But what I found is that for people who get bored and they trade to alleviate their boredom, they just piss away their capital, so that by the time a big trading opportunity comes along, they're just kind of getting back to where they were. And I think that's one of the toughest things to do, but it's one of the most important things to do, is just, if you're looking at the markets and there's nothing to do, don't do anything. You get to the point where it's like, if you look back on your trades and say, wow, God, that trade worked out really well, go back and look at it. What came together? Wait for that to happen again. Go for a larger than average position. Otherwise, stop. Don't piss away your capital. And I think it's just something you just don't know at the beginning, but over time you learn, and it's just a huge lesson.
Yeah, absolutely. Now, just going to the other end of the trade, what's your thought process for deciding when or where to get out of a trade? Like, how do you form an exit plan?
It's a good question. I mean, here at the end of the day, entries are a dime a dozen. To become a good trader, you've got to become a master of exits. And that means, of course, stop losses, but also, targets. And you have to have an idea of what, and this is actually kind of easy in the options world, because options are priced with what's called an expected move. But this also works with futures and stuff like that too. But what I mean by an expected move is that market makers actually study all this stuff. And in options, implied volatility and all this kind of stuff, you can say, oh, wow, okay, the option makers, so Netflix is a $100 stock, and the market makers have priced in an $8 move over the next 2 weeks. Well, guess what? If you've got Netflix as a stock, or if you bought options on it, and it's up $8 from your entry, and that's what the move that was expected by the market makers, get out. I mean, the odds of it going much higher than that are not very high. The other thing I'm a huge fan of is Fibonacci extensions. So whether it's a 5-minute chart or a 30-minute chart or a daily chart or whatever, if a stock makes a new swing high and it gets up to the 1272 extension of that move, from the swing low, at that point, I mean, that's 90% of the time you're going to hit that target, but the odds of it going much past that are low. So, maybe 50% that you'll get to the 1618 extension. So you want to know where the low-hanging fruit is. And I love the idea of like, wow, here's a great setup. I'm gonna get 10 contracts. Okay, let's say it's futures. I'm gonna get 10 S&P futures contracts, and if we get to the 1272 extension, I'm gonna sell 7 of them. Like, let's take the bulk of the risk off the table here, and then if we get to the 1618, great. But I'm gonna move my stop to break even here. So I'm gonna get aggressive about taking off a large part of my position at those low-hanging fruit targets. I'm not gonna hope that the thing's just gonna keep moving in my favor forever.
Okay, I like that, the low-hanging fruit. Very good.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
So let's talk a little more about options now that you bring it up. So, I know options are one of your main focuses right now, but, over your 20 years, I believe you've traded pretty much every market at some point during your career. What is it about options that you find really attractive?
So for options versus futures, futures, it is, if I look at something like, say, gold, like, okay, I'm bullish on gold. What do? Do I go out and buy some gold futures, or do I buy call options on a stock or ETF like GLD, which mimics gold? Here's the thing. It is harder to hold on to a futures contract. Futures move all the time, and they could blow through your stops. I mean, sometimes gold futures aren't that liquid. What I like about options is that there's two things. One, in this example, I could say, like, you know what? I'm willing to risk $5,000 on this. So I could buy some gold call options, $5,000 worth, 60 days out, and just forget about it. Now, gold futures, I might get stopped out on that very easily, but with those gold options, it could come down, and something that would have stopped me out on the futures could turn around and rally strongly, and I end up making a bunch of money on the options. And so what I like about the options is you can just say, like, you know what, I just want to risk $5,000. I'm done. And the gold market could actually have huge fluctuations and you'd be fine. With gold futures, you don't have that luxury, because gold, if you get down to a certain point, you have to get out. It's like, oh, I'm down $5,000. So that's, if you haven't traded options before, that might not make sense. But with options, if you're long an option, it's a fixed amount of risk. And then the other thing is that options are depreciating assets, which are kind of fun, meaning that, so let's, a popular stock in the U.S. markets is Apple. So if Apple's at $105, you could buy a $120 call option for like $1. And you're making this bet that, like, wow, Apple's this amazing stock and it's going to rally up to 120. Well, it's probably not. So you can actually take the opposite side of that trade and just sell it. You sell it for $1, it expires worthless, and then you keep all the money. So with options, there's a lot of fun things you can do in terms of selling them, keeping that money, and that's kind of, you're taking the opposite side of other people who are like buying options that go to zero. So there's a lot of fun things you can do with options.
Okay. Now listen to your interview on the Option Alpha podcast with Kirk Duplessis, who was actually on episode number 2.
Okay. Yeah, Kurt, he's got a great site.
Yeah. So one of the things you were speaking to him about is with options, you find that they've helped you see more consistency in your results, kind of minimize the drawdowns, less volatility in your actual account. Did I understand that right? Is that something relevant to your choice of, or your decision of trading options?
Well, yeah, and it depends on your goals. If you are looking for a steadier equity curve, meaning like you don't want the up and down, the like all these crazy ups and crazy downs, you can structure trades in a way with options that makes it really consistent. Now, consistency also means you're limiting profit potential, okay? But that's not a bad thing for most people. You can sit there and say, as an example that, I could buy a call option on Tesla at $8, and it's either going to go to 16 or go to 0. Or you could sell, let's say, a put credit spread on Tesla that's out of the money, and the odds of that going, you making a profit on that trade are like 90%. So that's, everybody, the nice thing about options is that you can sit there and just say like, okay, just be honest with yourself. What kind of risk do you want to take? What kind of equity curve do you want? And when I mean that, I just mean that the job of a trader is to have an equity curve that goes from the lower left of the screen to the upper right? It's going higher. It's not about being right. It's about, managing that equity curve. Now, I'm an aggressive trader, so my equity curve is going to have a little bit more zigzag in there. But some people don't like that. They don't want to sit there and go like, oh God, I just had some losses here. They want it to be more consistent. And what's nice about options is that you can kind of construct your trades in such a way so that, you're never going to have any big blow up surprises, but you're not going to have any upside excitement either. You're just steadily cranking out the money. And that's great. And I think that's a very great thing with options, because you can structure your trades in a way that just kind of matches your personality and your own trading goals, which obviously at the end of the day, all that matters here is that everybody's able to meet, figure out their trading goals and then find the right instrument to actually execute those trading goals.
Mm-hmm. Okay. And another thing you mentioned on that podcast was you used the term financing a trade. Now, I didn't quite understand this, but I think it was somewhat interesting. Would you mind expanding on what you mean when you're referring to financing a trade using options?
Sure, and there's a couple of ways to do it. So one way to do it is, and since we were talking about gold earlier, I'll use that again, but we could say like, okay, GLD, I think it's going to go higher, over the next 3 months. So I'm going to buy a call option 3 months out. Well, let's say it's at $120. Well, what I could do is, even though my call option is 3 months out, I could sell the $125 options that are 30 days out against those. And in a perfect world, they expire worthless. Okay, and that's kind of like having a rental property. And that's the trade is called a diagonal. So you buy something that's longer term, and then you sell shorter term stuff against it. And if the stock moves up methodically, or down methodically, if it's a bearish play, you can do it in such a way that you end up selling enough options against it that it actually pays for itself, which is kind of fun. The other thing in that scenario is you can buy the options. So you could buy, like, say, 10 call options and then sell, a 30 contract put credit spread that ends up expiring worthless, and that could actually pay for the entire trade. So now you got a free trade. So the nice thing with options is that there are things like that you can do. Obviously, on anything like that, it's like, okay, what's the risk here? But the fun thing is you can actually, it's called financing a trade, and once it's financed, you can just kind of let it go and see what it can do.
Okay, so it sounds like something which is a little bit more advanced, but very interesting. Just before we move off the topic of options, is there any advice you'd like to give to, novice options traders that would be really helpful? Maybe some advice that would have been helpful for you when you started getting into options.
I'd say the first thing is that if you're a novice and you're getting into options, usually what you're going to do is if you think the stock's going to go higher, you're going to buy a call. If you think it's going to go lower, you're going to buy a put. I mean, that's just kind of the basics there. The mistake that most novice traders make is they look for cheap options. So if you're looking at a stock like, let's use Apple as an example. It's $100 stock. And you'll look at it and say, wow, here's a $100 stock. The $95 calls are $7, but the $110 calls are only $1. So I'm going to buy the $110 calls because they're cheaper. And that's the biggest mistake you can make. Essentially with options, those out-of-the-money options are designed to expire worthless. They're designed to suck people into them. So if you buy an in-the-money option, even though it's quote-unquote more expensive, all you got to think of it is this. Instead of buying Apple for $100, you're buying an option for $7. So you, for a much cheaper price than actually owning Apple, you're going to be able to participate in the price movement of Apple and do it that way. So I would just say, focus on in-the-money options. And if you graduate from that, start considering spreads, selling put credit spreads or call credit spreads. But you don't really need to go. I remember the first time I went to an options seminar and I started hearing about butterflies and all this kind of stuff. You really don't need to go down that road. If you're bullish on something, buy an in-the-money call, sell a put credit spread, you're done. If you're bearish on something, buy an in-the-money put and sell a call credit spread, you're done. And that's all you need to do.
Okay, and when you say you don't need to go down that road, are you talking about sort of in the early days, or is it not necessary at any point? Is that something you get into these days?
No, I actually don't think it's necessary at any point. I mean, the thing about options that can get, because there's so much math and, they call it the Greeks, Vega, Delta, Gamma. I mean, at least for the kind of trading that I do, it's a distraction. And I know a lot of people get involved in that. And if you talk to market makers, they think it's really important. But it depends on your style of trading. I mean, I look at a chart and I get an opinion based on a setup that this thing's going higher. Well, that's very simple. It's like if I think it's going to go higher, then I need to buy the right call. And then if I sell a put credit spread and it expires worthless, that's a win. What happens is that it's and I'm not knocking these strategies because I actually know traders who love this stuff where it's like, okay, the odds of it going here are X. So I'm going to buy a butterfly and do this diagonal around it. And people really get into it. I just don't. And I don't think it's necessary. And I think that one of the things with options is don't be intimidated by all these crazy different things that you'll see because you don't need to do them. If you think something's going higher, buy an in-the-money call. That's all you need to do. I think it's a good idea to learn what a put credit spread means because that's a benefit, and then you're done. If you want to do more than that, that's fine, but you don't need to.
Okay. Good advice. All right, well, let's talk a little about technical analysis and indicators. So starting with technical analysis, how do you use technical analysis in your trading? Is there anything key that you look for on a chart?
Well, my favorite setup is something called a squeeze. All that is that when the Bollinger Bands are trading inside the Keltner channels, it just means that the standard deviation of a stock or a market is now trading inside of its average true range. And it may sound kind of complicated, but it's just it's one of those things where if you think of it this way, if an Olympic athlete has just ran a 100-yard dash, they're not going to go run a 100-yard dash immediately after that. They're going to rest. They're going to drink some Gatorade. They're going to get ready for their next event. And it's the same thing with a stock. It's going to have a move, and then it's got to rest and relax and kind of get ready for the next one. What I found is that when the Bollinger Bands contract to the point that they're trading inside of the Keltner channels, and by the way, these are all default settings, are available on most platforms, that's telling you hey, heads up, this is getting ready to go again. We've got an indicator that we created called the squeeze that kind of makes that a scannable kind of a feature. But that's my main thing. I feel very, very comfortable if I see a stock or a market. It's like, wow, this has a squeeze. This is about, this is ready to do something. And if it's in an uptrend, this is saying like, wow, there's an 87% chance that this uptrend is going to continue. I can work with that, and vice versa if it's in a downtrend. So I keep it fairly simple. There's a lot of other indicators I use, but I always start with that.
Okay. Do you have like a video or an article about where we can actually see that on a chart? Like any visualizations that I could maybe link to in the show notes?
Yeah, we've got a couple, and if you want, if you have some show notes or something like that, we can send you a link that says, "Hey, here's a good example of that."
Yeah, no, that'd be really cool. So, I'll be sure to include that in the show notes. I think that'd be cool if people can actually visualize something like that. They might want to check that out.
Sure.
Now, don't mean to keep going back to the interview with Option Alpha. I'll also link to that in the show notes too. It was a good interview. One of the things you said which really struck me was that you don't look at a chart for more than a split second. I'd love it if you could share your reasoning for this with the listeners.
Yeah, this is another hard lesson I learned. So the good setups, they are right there in front of your face. And if you're looking at a chart for more than a split second, it means that you're trying to force something onto that. I mean, literally the best setups, in half a second, you're like, oh my gosh, that's amazing. Everything's coming together. If it's not like that, then you're going to keep staring at it, and you're going to you're going to try to force something into that that's not actually there. It's not a good setup. The best setups, you can identify them, just like that. And if you can't, move on to the next chart. The toughest thing with that is somebody, you read something in the news. Oh my gosh, Google, this amazing article came out. So you go look at the chart, and the chart looks like crap. But you're like, in your mind, you're like, it should be bullish. So you keep looking at it and all these things and trying to force it into that. Well, your mind's going to see whatever it is. And, if you have a concept in your mind of this stock is bullish, you are going to find something on that chart that says it's bullish, even though it has nothing to do with whatever you've looked at in the past. And that's going to take some time to figure that out. So the answer to that is, like, if you're looking at a chart and if in like a split second you don't see anything, you don't have anything. So it's just the easiest way to do that.
Okay. And do you think that you can identify setups that quickly because you have 20 plus years of market experience and years looking at charts, or is that something you would say that newer traders should also try to apply to their own trading?
No, I think it's a little combination of both. What happens is, after doing this for 20 plus years, you start learning the setups that give you the best results. So, that's, to be fair, it's like, oh, okay, gosh, anytime that happens, I'm definitely going to, take a position. As a newer trader, what happens is, I call it, there's the natural inclination to search for that holy grail and continue tweaking a chart, adding more indicators, all that kind of fun stuff. But what happens is that, as a newer trader, is that there's this idea of, okay, I want to get long this stock. So you'll keep looking at the stock until you find a reason to go long. Even if it's the most bearish setup on the planet, you can find a reason to go long if you really want to. So what the moral of the story is, have a setup that you like, keep it simple. And I've found that if you have a setup that you can't explain to a 12-year-old, it's too complicated. So, keep it simple. And from there, because you don't actually need a lot of indicators. I mean, you really actually shouldn't have more than like 3. So here's your price, here's 3 indicators, and you're done. If you've got more than that, you've got too many indicators on your chart. And, identify that setup. If you end up using something like a squeeze, great. Moving average crossover, it actually really doesn't matter. Just identify what the setup is and then track it. And the secret to that is, whenever you find a setup, just do 25 trades in a row. And at the end of 25 trades, did you make money or lose money? Because, wins and losses, even on a 75% probability, are going to be randomly distributed. Just because you do 4 trades doesn't mean 3 of them are going to be winners. You might have 4 losers in a row. But at the end of 25 trades, you're going to have a good sample set. And if you made money on that, you're going to have more confidence just to say, okay, every time I see that setup, I'm going to take a trade. And that's what you do, and that's where you get to the habit of, in a split second, it's like, oh, that's a setup, great, I'm taking it.
Absolutely, yeah. No, that's a really great point that you highlight there, John. Now, you have mentioned indicators a few times. When do indicators serve a purpose, and when are they unnecessary noise?
So I know traders that only look at price action, and there are times when that makes sense when you're looking at price action and say trend lines. But at the end of the day, anytime you're looking at, the most classic one I remember as a newer trader was, okay, the market's rallying, but it's overbought because my stochastic is over 80. So I can't buy it. And the market goes up like forever after that. And what happens is that indicator, that overbought indicator, becomes noise against the actual price action. So at the end of the day, it's the price action that matters. Indicators, all they are is a derivative in interpretation of price action. There's no magic involved in indicators. It's just math. And you don't want to let the indicators get in the way of what's actually happening on the screen. So the first thing that's most important is price. And then you kind of look at like, okay, I've got a couple of indicators here, what's going on? But it's easy to get lost in a bunch of different indicators when all that matters is that, the market's either going up or it's going down, and the price is the most important thing. The indicators are merely an interpretation of that.
Okay. That's well said. I like that. Now, one of the things I'm really keen to ask you about, and anyone who follows you is probably aware that you banked I think it was about $1.4 million on a trade. I'm not sure exactly when it was, but could you please share the story with us? Like, walk us through it step by step. I think it would be really interesting.
Sure. No, I remember that trade. I mean, it was like, so I've had a couple of big trades before, but not in one day like that. So I remember, so it was either, so this was in January of 2014. And so it was either January 14th, 15th, or 16th. It was one of those days. But on that day, it was interesting, as I remember on that day that I woke up and I had two trades that weren't doing well, and I got stopped out of both of them. And in that account, I was trading it was $1.5 million account. So it was a pretty decent sized account. I'd lost like $100,000. I was like, all right, that's not what I wanted, but I've been doing this a long time. So I'm like, all right. And as I'm sitting there and I'm now flat, I got stopped out of my positions. And I had noticed that earlier on the day, Tesla was down $10. And then I suddenly noticed that it was up $5. I'm like, what is going on? I mean, Tesla was down $10 and now it's up $5. So, I check on Twitter and it's like Elon Musk said some kind of announcement, like I think it was an earnings, or I don't even know what it was. And then I checked the short interest, and I do like to track the short interest on a stock. And the reason is and Tesla was like 40% at the time, is that if there's a lot of people who are short, typically over 20%, then if you get some kind of surprise announcement to the upside, they're forced to cover. Plus, there's going to be new buyers, so you can generally get like these huge moves. So I'm looking at that going like, all right, Tesla was down 10, it's up 5. I'm looking at the chart. There's no real resistance, and the prices were like, I think it was at maybe $150 at this point. And there's no resistance till like 170. So I buy 100 call options, and it continues to do well, and I'm buying them like at $6. So, in a $1.5 million account, that's a small position. And I keep adding as it goes in my favor. And I get to the point where I have 1,000 call options, which is, that's a pretty sizable position. I even bought a bunch of stock. And it was interesting because there was one point that made the difference for me in that trade, is that at one point I was up, so I'd lost $100,000 on that day. And at one point I was up about $300,000. I was like, okay, this is an amazing trade. I was excited. This is great. I've been doing this a long time. I would be completely happy taking the profit there. But I'm looking at this going like, I think this this is not showing any signs of stopping. The volume is pouring into this, but obviously no stock goes up or down in a straight line. So it started pulling back. And I'm watching my profit that was up $300,000, over the course of like 10 minutes drops to like up $200,000. I'm like, now we're at that moment in time of every trader is like, I don't want this to turn into a losing trade, but oh my God, I think I see a lot of potential here. So I stepped away from the computer and I took a shower. And it was just like, I had to get away. I stopped thinking objectively. So I went and took a shower and I came back. Tesla had gone a little bit lower than it stabilized. So I was back to where I was up like 300,000. It's like, okay, looks good. I was at home and I needed to get to the office, and the office was about 20 minutes away. So I hopped in my car, started to drive, and I got there. And by the time I got to the office, then I was up 600,000. So now it broke out again. It started taking off. And it just kind of rallied into the close. And I sold half of the close. I held half overnight. It gapped up 10 points the next morning. It was an amazing trade. And, there were things that, and it's interesting looking at it because it's like, in a perfect world, I could have done a lot better, but, and it was down 10. I didn't buy it until it was up 5. That's a 15-point turnaround. But, the consistently high volume, the ability to sit on a winner is hard. That's training, and that's just something where it's like you recognize like, wow, this thing's moving. There's volume pouring in. Every pullback is being bought. Where is this going to end? And that was just one of those things where like, there's these moments in time in trading where all of your training comes together. And that was one of those times. And obviously, now I haven't had another $1 million day trade since then. I've had plenty of pretty decent trades. There's been some I've had that it could have been that, but I didn't do as big of a position. So, it's always like, well, why did I think Tesla, would have been a much bigger winner? Well, part of it was the short interest and things like that too. But, so it's interesting. So, I think there's always moments in time where, as you do this, you're just like, wow, this is one of those special times where you just hold on, and you've got to have the guts to do it. It's hard. It is hard to hold on to those things. But I love the idea of having concentrated positions on something that's working, and just watching that basket. And, it worked out really well. And, those are things I still continue to look at.
Yeah. And the part I find really fascinating about that is that you kind of almost knew to push harder on that trade. Like you said, when the trade started working out, you just kept adding to your position. I don't know. How did you know how to push harder on this particular trade?
A big part of that is just recognizing what I would just call a special situation. We've seen those days where, a stock starts off down 5 and then suddenly it's down 30, and a lot of it's volume. That's an easy thing. It's kind of like, this is a special move. the volume is just exploding on this. So that helps. But it's also just understanding. That's the easiest way I can describe it is just a special situation. So, when a stock, breaks it, especially when something that everybody thinks should happen isn't happening. And I remember that because Tesla had fallen. Everybody thought it was overvalued. People were writing articles that it was dead. And then all of a sudden it's like, wow, it's having this huge reversal. So all these people, and by the way, the biggest moves happen when a lot of people are wrong. So big moves don't happen when a lot of people are right. When a lot of people are wrong and they have to get out of that position, that's what causes big moves. So with Tesla, you had this reversal. You had a lot of people who are wrong who were forced to get out of that position. And so you kind of recognize that, and you're just like, wow, these people's pain is it's for my benefit. And we've all been in positions where we keep holding on to the pain. And if you can get on the opposite side of that, people are stubborn. They're going to keep holding on. And but that's how the markets work. When there's a lot of people on the wrong side of a position and they all realize they need to get out, that's when big moves happen. And that's what happened with Tesla. And, you kind of look for those kind of opportunities.
Okay. So I'd like to ask you, was there anything about this particular trade that changed the way you traded moving forward? Or is there anything about it that you've specifically tried to replicate?
No, I wouldn't. It's interesting. I guess maybe the main thing that probably kind of tweaked how I traded going forward was it's very rare these days that I'll have, say, 18 different positions on. I actually prefer to wait. And it's like, all right, I would rather have 3 or 4 larger positions on than 18 smaller ones. Now, conventional wisdom will say, well, if you've got 18 smaller positions, you're diversified. But I forgot who said this, and maybe it was even Warren Buffett, who just said, essentially diversification is for people who, don't know what they're doing. If you're diversified, then your account's not going to change because you got some bullish positions, you got some bearish positions. If you see something that you like, then get in and focus on it. And so it really just kind of changed my outlook to want to focus. Instead of shotgunning and hoping for the best, it's like, you know what, let's be patient. Let's miss on things. But when this comes together, let's press it and, let's focus. And it doesn't mean, buying 1,000 contracts every time. But, we just closed out a Facebook trade where we had 300 contracts on it. It was a nice, like an $80,000 trade. Great. It's not a Tesla trade, but it's not having 18 different positions. Some are up, some are down. And so your account value doesn't change. It's focus. And I think that's the key.
Okay. That's a great point. That's a really great point. All right, John, well, let's do one last question here to take us out. I'd like to ask you, after 20 years, I'm keen to hear how have your goals and outlook on trading changed in the market, as opposed to your earlier years?
Yeah, in the early years, I felt a big pressure to make a big trade. I've got to make a big trade. That's freedom. I can quit my job. And I think, the main difference now is after doing this for a while, you start getting confidence in your skills. So it's not like, well, you know what, I didn't make money today. That's fine. The markets will be here tomorrow. And it's just this confidence of, if at the end of the day, I lost everything and could scrape together, sell a house or something like that could scrape together $50,000. I'm like, the idea that it's like, okay, I can make a couple $1,000s a month trading as opposed to having to go wait tables or something like that. It's like I've got that confidence where it's just like, okay, I can always do that. And that just comes from skill set. And that's just it's interesting with the markets because I admire anybody who wants to try this to do trading for a living, because this is the only profession on the planet where you have to develop confidence in a situation where the result is always uncertain. Okay, there's no other profession in the world that's like that. And so if you can get to the point where you master that and you feel comfortable being uncomfortable, that's a good life lesson too. And that's just something where that's just kind of the overall idea. And so I look at trading as kind of obviously it's a monetary thing, but it's also a philosophical approach, and just kind of attack it from that vantage point.
Awesome. Okay, John, well, do you want to share with listeners where they can go to find out more about you?
Sure. So we've got our hub website is www.simplertrading.com. And if you go there, you'll see different sections. There's options, futures, stocks, and Forex. I primarily trade options and futures. We've also got other traders that we work together with. Probably our most popular thing is that if you go to Simpler Options and enter our gold room, the gold membership trial, in that room, we've got about 1,000 members. We trade options and futures, and it's a lot of fun. So we're committed to helping each other make money, teaching, and it's great. I mean, I can't imagine doing anything else. Awesome.
And you're also on Twitter as well. Do you want to share your handle?
Yeah, it's just, the @ symbol, then John F. Carter. And, I'm not I'm not posting 20 things a day. It's more kind of every once in a while I'll do like a market observation, but, I like to post kind of market turning points and things like that as well.
Okay, good stuff. Well, I'll be sure to include all those links at chatwithtraders.com in the show notes. So, John, once again, thank you very much for doing this. It's been a lot of fun speaking with you. Thank you very much.
Absolutely, Aaron. Thanks for having me on the show.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Okay, what's happening, team? I'm thrilled to have you tuned in for what is a really interesting episode ahead with Jeff Davis. Jeff is a day trader who specializes in the S&P futures, and he predominantly trades a mean reversion strategy which is built upon real data and statistical probabilities. Across his 20-year trading career, Jeff has also been heavily involved in the process of developing and deploying algorithmic strategies, but to a slightly lesser extent these days. In this interview, we talk about Jeff's prop days, the risks of being a one-man business, automated trading, specializing, statistics, and a whole lot more as well. From this conversation, I think you'll pick up on the underlying theme, which is really all about building confidence in your strategy and then being able to size up when you have edge. Lastly, Jeff has kindly offered to answer any trading questions that you might have, or if you'd like a little more depth around any of the topics that we hit on, all you got to do is go to chatwithtraders.com/70 and leave a question in the comments area at the bottom of the page. Very straightforward. I think you know the drill by now. Take advantage of that, guys. I really do encourage that. All right, so here we are. Please enjoy episode 70 with Jeff Davis. Hey, Jeff, what's going on? How are you?
Hi, Aaron. I'm fine today. Thank you for having me on. Nice to chat with you again.
Likewise. It's awesome to have you on. Thank you very much for doing this. I know it's Sunday evening where you are, so nice commitment from your side. But first of all, let's start right at the very beginning. I think we're going back probably close to 20 years now. How did you get started in trading? Tell us about what you were doing at the time and, what led you into financial markets?
Well, I took, my path to trading wasn't what I would call conventional. I grew up in farm country about 2.5 hours north of New York City. But then after I graduated high school, I ended up moving down about an hour outside of the city. It was about when I was 30 years old. I was already married, had a mortgage, had a baby, another baby on the way. And I had a lot of responsibilities, and I was working in the U.S. Postal Service. And I worked in a processing center. And the processing center, being in that environment, allowed me to have access to virtually every magazine and newspaper that came through the mail, to be able to see it and read it. So I was a voracious reader, and that's when I kind of discovered my interest in stock trading, and the internet kind of was coming around at the same time. So that kind of enabled where you didn't have to be in the city in order to be a stock trader. And everything just kind of, started to go from there. I never knew what I wanted to do or be in high school. So it didn't make sense for me to go to college. So I went into the post office. I had no finance or economics background of any type. And I just became attracted to the puzzle of picking stocks. And then when day trading came around, that really struck a chord with me. I liked the fact that I could possibly make a living from it while being my own boss. That really appealed to me. So I just kind of dove right in and proceeded to make every possible mistake one could make. But I wanted to get there, so I just kept at it.
Excellent, excellent. Okay, well, let's talk about some of those mistakes. So maybe walk us through your first 1 or 2 years when you decided that you were going to start trading.
Well, the first foray was just, small personal account, not day trading at all, wasn't really available, no leverage or anything in that. Made a little bit and was able to save up. And then when, the prop firms started to come about with the LLCs and that, I was able to be able to join one. And $25,000 account at that time minimum, and joined it. And used to get my quotes over the internet and have to call in my orders. So it was very interesting. And just, I'd read a lot, and like most people out there starting out, you just have all this enthusiasm and you read something and you think that's really going to be it and do it, and just turns out to not be that way. There's guys out there that have been doing it, and they're just going to, you're going to learn your lessons. And so I proceeded to learn my lessons. One of the big ones I learned right away was about risk. And it was because where I opened my account, the firm went under because a trader blew up the whole LLC. That was in 1999, Harbor Securities. So luckily for me, it wasn't that big of a monetary loss because I was fabulously good at that point at burning up my own account. So by the time somebody else actually blew up the firm, I didn't have too much left. I was well on my way to doing it on my own. So, but I did learn a lesson in risk from that. So
how does that work? How does a single trader blow up a whole prop firm?
That time, I guess the risk controls weren't that good, and everything was levered. There wasn't much money behind the firm, really. So I think he made a bet on Apple earnings, I believe it was, in a very big way. And when he was wrong, that was it. The whole pie went down.
Wow. Okay. Well, I don't imagine he was too popular.
No. Well, I don't think anybody was that was related. In that firm. Had that firm that started it. So then from there, I went, proceeded to just learn that lesson, saved up again. And from there, I went to Bright Trading. And I did a little more research and knew they had the financial wherewithal in that, and went to them and needed to get a Series 7. So I studied for 2 weeks, took the Series 7 test, passed that with a 91. Put 25,000 up with Bright and started heading to the city. Then I decided they didn't allow remote, which was very good for me at that point, and went down and got to sit on a desk and be surrounded by lots of different traders, lots of different strategies. And that was the start of like my prop trading career back then, mainly all because of leverage. You could get the leverage. So if you were going to make a daily or a monthly check, I didn't leave my job. I worked a night shift. So I actually worked overnight, left in the morning, pretty much went straight to the train station, slept on an 1.5-hour train ride, and got up and traded all day and slept on the train back and did that day after day. That's how bad I wanted to learn.
Okay, so when did you fit sleep in? Like, when did you get a decent sleep? I know you said you had an 1.5 hours in the morning, but when did you catch up?
Sometimes I didn't trade the whole day. I'd leave in the afternoons or something like that early to get in. But I could go. I was younger then. You could go a couple days with, without a lot of sleep. So you just did it. I had no other choice. That was the way. I had bills to pay. I couldn't just walk away yet. And that was it. No other options. Do it.
Okay, so before joining Bright, were you a profitable trader at the time, or did you learn to become profitable while you were at the firm?
More so at Bright, but more at Bright, I never really became super profitable. I was always more break even then, I would say. I didn't know I hadn't settled on a strategy yet. Just the market changed immensely. When I decided to go full time, it was in March of 2000, the top of the NASDAQ tech bubble in the markets. So, I had a lot of strategies worked out, I imagine as most people did, and they all turned out to just be bull market strategies. And when the market started going down and that volatility really cranked up, nothing that I had thought I was going to be able to do was going to work. So it became really clear then I had to learn to adapt. And that was, that was the big lesson that I learned there, is it was all about adapting at that point, just surviving. And they were changing rules at that time too in the markets. That's when we went from fractions to decimals. There was just all sorts of changes, in the market structure and that also. So I really learned that you can never just depend on anything to stay status quo for very long.
Okay, so how were you affected by the crash? Did you lose much money during that time, or were you okay?
No, because since I was new at Bright, they had some controls on me, which was a good thing. And then I managed to survive. I didn't really make money. I wasn't taking a check from there. I was still working. But I learned how not to lose money in that environment, where I learned how to short. I had no clue really how to short before, but in that market, you had to learn how to short. I really got a taste of volatility right away. Very interesting. Got exposed to a lot of different types of strategies in that also. When you went into Bright, the first thing you kind of were taught was to go in and you were going to tape read. And you were a tape reader and you were going to pick one stock and you were going to specialize in that stock, to the point where if you got good enough, you could tell when the specialist that was trading the stock on the stock exchange floor went to lunch, because you saw his little tricks. That was the whole thing. You knew all the rules of the specialist. You tried to trade. Your whole object was to try and trade on the side of the specialist, trade along with him, not against him.
Okay, and is that something that you picked up and actually adapted for yourself at that point in time?
Slow learner.
Okay.
Slow learner here. Didn't come right away, and started to get it. And most of my problems were mainly me, not really strategy wise or anything. I would tend to get over exuberant and trade too much, and lots of the beginning stuff in that. I would make money in the morning and then proceed to give back a good chunk of it in the afternoon, and just never did anything at that point to stop it right away.
Okay. So how long were you with the firm for until you went out on your own and began trading independently?
I was going down to Bright's offices daily until 9/11/2001, when we couldn't get to the office anymore. It was right next to the trade centers.
Okay.
So then they had to allow us to trade remotely, and I traded remote with them for a while, and then ended up, there was lots more competition and ended up moving on to, trading from home and just doing my own accounts and that. There was other ways of getting leverage.
Okay. And did you experience any challenges when you made that switch from going from trading within a prop firm where you're surrounded by traders to now being at home where it's just pretty much you?
Oh, yes. Yeah. Trading remotely was, lonely, hard, but great at the same time. You just, it takes getting used to. On the floor, though, in the office, you got exposure to different strategies, but never really did I experience where it's like this big team thing where everybody's sharing everything. I mean, when the market was open, guys were trading. They were worried about making their money, and that they weren't telling you. You could sit next to somebody, but he wasn't telling you what he was thinking every moment, and that he was focused. Guys wanted to make money. That's one thing I learned right away. The guys that had focus were the ones that made money. The guys that did the same thing every day, learned their strategy. The other guys came and went. The desk went from, 50 people down to 15 at one point. Saw so many people come and go. So you really learn that the markets change and you got to adapt with it. Saw guys that could make money for years that all of a sudden couldn't make a dime. Gone.
Interesting. Okay. So I'm not sure where this fits in on your timeline, but at some point you went from being a discretionary trader to actually quantifying your approach. When did that happen, and how did that happen, more importantly?
When did that happen? Years later. Mainly after I got Lyme disease. And I got Lyme disease and I got sick, and for a couple years was too medicated to be able to trade. And I realized then that being a one-man business was great, but there was downsides to it. And when I came back, one of my first goals was then to try to figure out a way where some things could be getting done if I wasn't able to physically trade all the time. And that was a big thing. That was a big realization that I think a lot of traders, a lot of your listeners that are starting out, they don't take into account. Things happen in life. Life happens, and you're a one-man business. If you can't make it to the keyboard, or you're highly medicated for something, you're not going to perform the same. You're not going to make money most likely. And you have to take that into account. So when everything is good and you feel you have edge in that, you have to really make sure you push it and you make money. You can't be just fiddling along for a long period of time because you don't know when life is going to happen. Hopefully for most people, nothing like that will happen.
Yeah, I think that's a really valid point that you brought up there. And this is something you mentioned to me when we last spoke, which I thought was awesome, is that, when you're trading, in most cases, you're a one-man band. And if something happens to you, then, you're out of business pretty much. So, no, I really like that point. So what was the first step you took towards actually being able to quantify your strategy? Like, how did that begin to happen? Like, how did you set those wheels in motion?
Well, the first thing was I developed a tool. It was supposed to be a tool, and it was tape reading stocks. And I ended up getting that programmed with somebody that I was working with that I was mentoring, and he was a programmer. So we exchanged my mentoring for his programming and ended up, coming up with a really good product, really cool, really different. And we just continued working on that and ended up at some point, I just saw it and said, wow, this can be built into a strategy. And that's when I went down that road of really, learning about and trying to build a system. Now, I had tried to, I always had dabbled in it a little bit. Back in 2005, when I was trading, one of the days of the year that I used to look forward to was the Russell rebalance. And starting out on the Russell rebalance, I had identified certain types of stocks that tended to have big closing moves. There were big moves on the close with the MOCs on the Russell rebalance in stocks. So I had identified that. So for a couple of years, I was trading them discretionarily and did very well on those days. So then I wanted to take that to where I could really, not miss any opportunities. So I actually, my brother was a programmer. I had him program a program for me that would narrow everything down for me, filter it, because the filtering systems back in that day weren't that good. I gave him all the parameters I wanted. They were custom. And then it spit out the stocks, and in the last 4 minutes you were buying or selling, and you were, it was a 4-minute trade. That's it. You were out on the close. And so that was my first foray into, at that time nobody had the word algorithm. It wasn't in use. There was no algorithmic trading or anything. But that trade kind of all went away when computers came to everybody. Russell imbalances now are not that big of a deal anymore. They were, there was a lot of edge in them, and now the edge has pretty much been arbed out. So that was my first foray. Then developed the tape reading tool. That went back to my bright roots, just what's a strong stock, what's a weak stock. And, that algorithm pretty much is reading a whole bunch of different stocks, and then it takes all those metrics that, it's determining buying and selling strength across the whole range of stocks. And then that spits out some metrics. And then a second algorithm then would take those metrics and allow us to take those levels and turn them into some sort of a trading system. We could back test, and we could, test strategies, and we could optimize. And that's still working to this day. And still the work on that is still going on as we speak.
Cool. Okay, well, let's break that down a little further. So just going back to the tool that you started out developing, was that a tool just for personal use, or was that available publicly?
No, it wasn't available publicly. It was going to be available publicly, and that lasted for about 3 days. And then I decided, no, it's going to be a trading strategy, and pulled everything right back. And then it's, there was probably out on the web, there's some screenshots and that of it from way back in the beginning on some accounts I had in Twitter or something, but it's changed so much since then. So not really too worried about that. But that was, it was mainly designed as I was mentoring people to be able to say to them, why are you taking this trade? You're trying to short the strongest stock, or you're trying to buy the weakest stock, or, that's kind of what it was, to make things very visual for people. I always found the more visual stuff you can make in trading, the easier people can pick up on it most of the time.
Yeah, no doubt. Now, one of the things I find really interesting about you, Jeff, is that you're essentially an algorithmic trader, yet you don't know how to program yourself. Did this come with any challenges, by having to rely on someone else to do the programming for you?
I imagine it would for most people, but I was very lucky and blessed, either way you want to put it, in finding guys that could program that were also traders. So a lot of the language implementation in that most people I hear talk about when you're trying to have a non-trader program for you, they just don't understand. I never really went through that. So with me, it was just finding people that I trusted and that were hard workers, because we put in a lot of hours. And yes, I don't program, but I learned a lot about programming and back testing and that. I spent countless hours, going through stuff and that. So just not easy, but can be done. And once again, the internet makes it possible. And my initial idea when I was able to show it with people, I didn't have to do much selling. They wanted in. So that made it a little bit easier too. What I had come up with was different and interesting, and they just they decided to, they wanted to come on board. They came on board, and we put a lot of time in.
Okay, so if you had your time over again, would you have made a conscious decision to learn how to program right when you were starting to go down this path, or would you have done it much the same as you have?
I would have done it in high school when it was Fortran and that and COBOL, back when I was in high school, if I knew we was going down this road. But no, I don't really, I don't know. I think I got to where I am because of, my pattern recognition with my mind, seeing stuff in that. And I don't know if me being a programmer was going to help that. It probably would have taken away from my screen time. And screen time is so important. So to me, I had the screen time and kind of had these patterns and that in my mind, and it was just getting somebody to help me build them out. And we did that and, got a really nice product out of it. And just going forward, it's still, it's good. I don't regret not programming. I don't, at this age now where I am, early 50s, I don't even want to think about it. That's the truth of the matter.
Okay, so I guess for some younger guys who might be listening who, are trading by hand at this stage, but may be interested in getting into algorithmic trading, would you suggest teaming up with a programmer who has trading knowledge versus learning how to program for themselves?
Without a doubt. I just think any way that you can go where you can get some part of your strategy automated or more mechanical is going to help you in these markets. These markets, you're trading against algorithms left and right. The bulk of the trading is that. So any help you get in that, if you're in your early 20s, definitely learn something. I would, I'm saying me 30 years later, 30 years advanced from that, it's a different story. But somebody in their 20s, no, learn. And if you can't wait, then find somebody that can program, work with them. Yeah. Get your ideas going. Just, avoid the rabbit holes.
Well, that was going to be my next question, is how did you avoid the rabbit holes? Because I know when you start going down this path, obviously firsthand, as many listeners will know already that this is something I've been pursuing. How do you avoid the rabbit holes? Because it's very easy to get stuck and go off on random tangents. How did you stay very focused while you were getting to a point where you could automate your strategy?
Didn't avoid all the rabbit holes, to be honest. Got better at avoiding rabbit holes because you realized where they sapped you and how much programming time went to nowhere and that, and you were just going to end up scrapping it, or, you never scrapped it like, oh, we'll put it on the shelf, maybe we can use it later, but you kind of knew in the back of your mind you weren't going to get there most likely, but you just didn't want to say that you wasted a lot of time. So you get better at it with experience. My one partner, that was, Chris Hargarten's his name. He was very good at determining rabbit holes and, not going down them. He had done lots of programming work and running teams of programmers and at Microsoft for years. So he was instrumental in me coming to that effect a lot. And I always wanted to just be day trading. So, kind of knowing exactly what we were looking for kept us out of the rabbit holes. If you're searching for edge, you're probably going to run into some rabbit holes. And it's just, if stuff, you have to know when to throw in the towel a little bit on an idea if it isn't panning out. Otherwise you're most likely going to curve fit. You're going to go down a whole bad path when it comes to, trying to back test a strategy and that and make a strategy that's going to work. You have to really understand, what the foundation of your strategy is, where your edge is, and how it's going to, how that's going to play out in the real markets, not just in some back testing. I mean, nobody has ever seen a back test that looked bad, do you? Nobody ever comes to you and says, hey, look at my back test that lost money. It's like, because everybody can sit there and they'll take out the bad stuff and only leave in the good stuff. And here's your back test. But in reality, that's not going to work going forward at all. There's virtually no chance of working.
Yeah, and I think that's really key. What you said there is that you've got to have a pretty good idea on what you're actually looking for before you go into this. So, no, I like that.
That's where the screen time, Aaron, that's where screen time and that comes in, and really understanding, just do your homework on systems. I mean, they just have to listen to your other podcasts. There's plenty of guys, I've listened to most of them, that, talk about it, like trend following, the big rage for the last 25 years and that. Well, you're going to do a trend following strategy. You're probably only going to have a win rate of 30 to 40%. Are you going to stick with that strategy when the 60 and 70% is, you're in a drawdown period? Most people don't. You just have to understand what your strategy is and how you're going to make money out of it, how you're going to consistently, and then you have to understand how often it's going to trade. How are you going to get to size in that? So there's a lot that goes into it. You're not just going to pop something out of the box. I mean, there's a lot of sites out there now that, tell you they'll help you be an algo trader, and it's like kind of out of the can stuff. I don't think anything out of the can is really going to work that easy for anybody, truthfully. It's my opinion. I'm not expert, but I would say if it's generally available to the public as general knowledge, there's probably not much edge in it. If you're going to make money from it, it's because of you. Seriously, that's, what it comes down to is trading. My whole path to trading only got better when I took myself out of the equation, when I finally stopped hurting myself, always acted in my best interest. So it's everybody starting out there thinking it's a strategy. I need this, I need another pattern, I need another trade. No, you don't. You need to make sure that your psychological effect on your trades is not what's causing the problems. That has to be right. And then when you design a strategy, the strategy that you're going to employ better fit your personality, your trading personality. I like day trading. I like coming to the screens during the day. I'm not an action junkie, but I enjoy coming to the screen during the day. I would not do good trading a system that only traded once a week or 3 times a month. Would not suit me. I trade way less now than I did before, but the market's changed. I just feel that's the most prudent thing to do. And I've focused and narrowed strategies down. Everything is getting towards mature simplicity, I like to call it. Just, as a Ron Meyer, a basketball coach, Bruce Lee has quotes out there about, simplify. It's not what you add, it's what you take away. That's where I think all traders need to try to get to. And it's not by doing more, it's by doing less, and what you do less of, do better. And in the trading world, do it bigger. Find something where you can get to size on it, especially if you're a one-man business. If you don't have other streams of income coming in that, why mess around with something? You're in a risk business. You can't go into a risk business to just make what people doing a salary job. You need to go into a risk business and make more. And that comes with being able to get size on, have confidence, and know your edge, and then be able to size up. And, that's what's kind of led me to where I am today. Some parts are automated. I have tools that I've designed that I use, that I trust. And then I may be the guy now that pushes the button, but it's all only pushing the button at spots that have really shown edge to me, through my work, through the hard hours, long hours of work I put in to, understand this is where I want to trade.
Brilliant answer, Jeff. I really like that.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Now, just before we get into more of the specifics about how you are trading now, because I know it's slightly different from how you have been trading in some ways. Just before we get to that, what did the team project lead to? Like the programmers you were working with, how are you still involved with them? Where do they fit into the picture today?
It is getting ready to start trading. It's been trading for a hedge fund. And that's it. The strategy, the algorithm is being used, and they're developing strategies off of it at the hedge fund. I no longer have the day-to-day in it. It just 5 years of kind of not doing my style of trading. Just, I got burned out a little bit. I spent a lot of hours, be at the market during the day and then all night long, and that I got burned out. And so what was developed, they're using, and they're building onto it. I'm in touch with them, but I don't have day-to-day anymore. They're more, they've taken it to another quant level, but it's trading actively for a hedge fund. And it's been looked at by, quite a few other firms. They're raising money around it. And it's trading in the S&P futures, which I started out as a stock trader. So just that alone has, where I came to really specialize in it. Where I started, I ended up being back to, and just specializing in the one product. And, I started at Bright. You picked one stock, you traded every day. Well, now for me, it's the S&P futures. And that's what the algorithm is trading also, the S&P futures.
All right, Jeff, well, let's dig into more about how you are trading now. So you said you've gone back to specializing. And I know a very big part of that for you is actually building your strategy around statistical probabilities. Can you just maybe give us a little more insight to how you are trading today?
Okay, as I stated, I'm trading S&P futures. Everything is designed around mean reversion strategy. The reason I settle on mean reversion is I like to be active. There's more chances at mean reversion in the one product. Index products are really not trending products. They do trend, everything trends, but they don't trend the majority of the time. Your S&P, trend days in the S&P happen on average over the last 10 years, anywhere between 10 and 15% of trading days are what people could label as some sort of a trend day. Open near lows, close on highs, open near highs, close on lows, something like that. I mean, everybody's different definition may be a little different with range, but most days are range days. And in a range day, there's certain things that happen in a range day that tend to happen time and time again. And that's where I focus everything that I do. Everything is pretty much with range in mind.
Okay, so a big part of that for you is actually knowing the statistics within those ranges. Like if something happens, then there's a X% chance that this is going to happen. How have you actually built your strategy around that, and how do you get those statistics? Because, I mean, I personally feel as though there is such a great edge in knowing your numbers to that extent. Like once you have them, you can then begin to actually build your strategy around those statistics. So I guess what I'm asking here is, how do you actually get those statistics?
Believe it or not, a lot of them are available out there on the internet, but the average trader just doesn't look at them as they have any sort of use. When I'm looking for statistics, I'll read something, I'll see something, and then I go and maybe back test it out for myself, see if it's true. Other things, there's just numbers out there from real reputable people, and you can find them. They're there. You have to know what you're looking for. I use, when I say, high probability statistics, let's take, for instance, I'm looking at a certain amount of range is done in the morning. I've built a range prediction algorithm also. And a certain amount of range is done in this certain time period in the morning. And that will tell me that, 80% of the days, we're only going to do this much range that day. So now if we start to near that level, that's where I would then tend to come in and fade. If everything looks copacetic on the buying and selling levels, if it's not, if news hasn't come into the market, news can always change anything. So without news coming into the market, those probabilities hold up. I'll use spikes. When we just went through this past period in January and February, we were getting spikes of, 26 handles in less than an hour, sometimes 30 and 35 minutes. I have the data. I know what over the last 15 years, when you get that kind of a spike, what the odds are for some reversion on it and what, that reversion could be. And that's where I build the trades off of. So you're waiting for those to set up. And then I steal, I forget, somebody had a quote about that, stealing good ideas. Well, I steal from all sorts of different disciplines. I'm not a fib trader. I don't really believe in pivot points. I don't ascribe to any of that. But every one of those has probabilities of certain points in those domains being hit. Let's say the pivot for the pivot point traders. Well, the pivot is traded on 70% of all days. So, depending where we open, where we close, that can, come into there. Everybody kind of knows yesterday's high and yesterday's low. Well, yesterday's high and yesterday's low over time has been traded at 88% of the time. One of them is hit. That's the kind of thing. So I put those big high probability targets along with my range stuff. And that's what gives me where I'll get my entries. And I use a lot of stuff with VWAP now. So many traders are looking at VWAP and they're using VWAP to enter trades. Well, VWAP is the target on most of my trades. When we get away from VWAP in one direction or the other, that's where I get interested. Because I get interested in this algorithmic environment that we're in, your HFTs, which are now your specialists, are not trend traders. They're mean reversion. Everything they do is causes mean reversion to come in more often than not. So VWAP is more often than not, instead of trending away from VWAP, it's always reverting back to VWAP. So I use levels like that. Certain levels I come up to proprietarily with my back testing. And that's it. I track range. You don't read a lot about range out there. And I always thought one of the reasons why is because a lot of people that are using range, it's working for them and they don't want it to go away. So you don't read a lot of stuff about range. And so I got into range way back reading Jeff Cooper, Tony Crable, Linda Bradford Ratchke, and that. And it's stuck with me ever since. It's consistent. It's always expanding and contracting. Those are the regimes I look at. And there's different trades, different setups in those regimes. And, when you're developing a strategy or any kind of trading system, whether it be discretionary or anything, nothing is going to work in every regime. It's good. Every system most likely is going to have a period of time where it really makes money, a period of time where it treads water, and probably a drawdown period of time. That's it. I like to know where we are in all those different things, and I can then adjust, how I trade, how often I trade, and that all to the regime, or whether or not I trade at all. And that's it. And I didn't go down the rabbit hole looking for turns. I just listened to your podcast with Dr. Steenbarger, and he was talking about learn from your losses. Well, I know we're getting close to turns when one part of my strategy starts to take on losses. I know we're going to the next regime, most likely. Why? Because I was just going through a period of really, having big time performance, and now it's sputtering a little bit. Guess what? Regime is most likely changing. Do I try to find something? I went down that rabbit hole. To pick the turns is the holy grail. Don't try to pick the turns in the regimes. Just let your trades go out. And when you're you're at the time frames where probability is that the regime could be running out, maybe you lower your size or something, but you don't just try to, go against it. I don't try to predict in that way. That's it. And then everything for me now, remember, everything is on a day trading time frame also, but these regimes still play in. When you're in high volatility, most people try to, talk about it as a volatility regime. I never settled on that because of all the hedging that goes on, because the VIX and everything just has days where it just isn't going with the market because of the hedging. Hedges being put on, hedges being taken off, and it has that decoupling. So I just use, everything I do is off of average true range. What is the market moving? How much is it moved? How far will it likely go? And there we go. So I do everything off of that. And I track everything off of, a certain ATR and percentage-wise. Keep apples to apples and everything. I can tell you right now, 40% of the ATR, 14-day ATR is done on 94% of the days. If I'm going to do most mean reversion trades without some other good reason to do it, I need to see 40% done, because 95 out of 100 days, you're going to do more than that. So why am I trying to fade something before that unless there's some other big level or something comes in? That's the way everything is put together with that. I know, there's just like the spikes. I'll give you one. A 22 handle spike in less than an hour has a 70% chance approximately of reverting approximately 5 handles. Does that happen in low volatility? No, they don't happen. In high volatility, you can get 5 of them in a day. So you have to know what part of your system in what regime is going to be active and where you're going to be trading it. That's it. And everything I do is, off a range, and I got my algo running, which shows me it's tape reading, all these stocks in the S&P 500, and that's given me buying and selling levels where I have a look that nobody else has. I don't use any of the technical indicators out there. It's pretty much built my own indicator that I'm looking at for buying and selling levels. And if they match up, sometimes they just make me hold up a little bit. Then it's just design your system to where you can execute it. That's where lots of people fail. They try to design a system that is going to look good on paper or they think is going to play out, but they can't stick with it. Everybody's goal, they think I'm a day trader. I'm going to trade with these very tight stops, and I'm going to have 4-to-1 risk reward on my wins and that. You're trying to design an automated system. That's probably not going to work out too well for you. You're just going to get stopped so many times. You're going to have periods where you get stopped, and then what are you going to do? You're going to fiddle in it, and you're going to change it. And what are you going to change it to? To what's just happened recently, most likely. Recency bias is just so huge among, newer traders. The older traders were boring. We're bored. We just execute. We come in the same day and every day, and we do the same thing over and over. That's what we look to do. We don't care about excitement. We're not chasing, I like to call it, on social media, Twitter and that stock flavor of the day. We're looking at our strategy. That's it. And we're executing it regardlessly. You just execute relentlessly. Sets up. It's never just one trade. It's the whole series of trades that's going to play out. That's it. You execute. And that's how you get good at the execution. That's how you get good with your psychology to be able to stay in the trade. How many times have you had to stop and let's say you take a 3-point stop. The price of the product you're trading now moves to 2 points against you. It's 1 point from the stop, and you're sitting there and you're feeling like, oh, this isn't feeling good. It's not looking good. What the heck? Let me just take it here rather than letting it hit the 3-point stop. I'll save the point. Boom, you exit, and what's it immediately do? Goes right back in your favor and goes on to what would have made money. That's bad enough. But what most of us would do, I did it in the past, now you get a revenge trade because now I was right and I'm out of it. Now you chase in and you're in at a worse spot than you were in previously. And now you try to trade that with the 3-point stop and you're offsides and you're stopped out. And that's where, until you know your personality and you are convinced you're not going to do the stuff that's going to hurt your account. And it's just, that's what patience is. Patience is just saying, I can take this pain. I mean, I was just looking today and I read a quote that I had from Jeff Cooper, who I don't know if a lot of people know who he is. He's been around a long time. He's got books out there. And at Jeff Cooper Live, I believe, is his Twitter handle for anybody you want to look him up in that. And I was reading this today, and it says, trading is more about knowing when not to trade than it is about trading. Trading is timing. Waiting is painful. Pain brings wisdom. Wisdom brings balance. Trading can be excruciatingly exciting when done wrong and tauntingly tedious when done right. And that's the truth. When you're doing it right, it's boring, and it's not all this excitement and jumping from one thing to the next. It's finding something, getting in it, and coming in here day after day and executing it. And that takes a little time. You're going to have to get some screen time. You have to think outside the box maybe a little bit, and you have to throw away what the crowd is doing. There's so many trading wisdoms now that don't apply on the shorter time frames that may still be applicable for the long time frames, but in my opinion, on the shorter time frames, they just don't even apply anymore. And, that's just trading. Trading is always changing. And all these kind of wisdoms, like, the trend is your friend. I know good trend traders in that on the day trading time frame in an index product, it trends like 15% of the time. If you're going to aspire to the trend as your friend and try to always trade that on the trend, you're not going to get very far. You're going to be the hamster on the wheel, most likely. You have to know your product. You have to know the regimes. You have to know when the probability of trending is higher rather than lower. And that's the truth of the matter. None of those old trading wisdoms you can just take point blank and think that's going to, be your holy grail for trading, your path to profitability. It's not going to be. You have to know what fits for you. And that's the one thing, like with the guys I work with, always harping on them. It has to fit your personality. You have to understand your system so you can stick with it. You have to know where it's likely to draw down. You have to know what regime it's going to make money in. That's when you can maybe do size, just those are the things. It's so much with psychological, I can't stress that enough, and I go back to tape reading all the time, and, in my strategies, it starts from tape reading, and you don't really read the tape anymore with these level 2s and that, with the algorithms, the HFT, that's kind of gone. But it's just, to me, tape reading is knowing your strategy and just sticking to it and executing it all the time. That's it. In the old days, there was a book written 1920s or something on tape reading. And one of the things he said in it was, averaging does not come within the province of the tape reader. Averaging is groping for the top or bottom. So when I go into a trade, I'm in. That's it. That's part of my strategy. Maybe other people can find scaling in that. I'm on a day trade time frame. Time is against me. I have to go in with my size and do it. And you have to have confidence to do that. That's the truth of the matter. You just have to know, you have to see it, know it, and then execute it. And that's to me, that all comes from us first. Just, knowing yourself and knowing where you're supposed to push the button to get into that trade and not letting anything else take you into it. I mean, just this past week came within ticks of a spot I wanted to get in, but in the type of tape we're in the regime we're in, I've learned I have to wait. It has to get to my level for me to trade. Gets within 2 ticks, turns, and goes all the way the other way. I'm not in the trade. I can't get upset. I don't chase. Nope, it didn't get to where I needed to be. That's the thing. This month in March, I was just looking at my numbers before. In March, only traded of the, I think it was approximately 20 trading days in March, only traded 13 of them. And I'm a day trader. But sometimes we had really tight days here, no movement really, nothing sets up. Don't push the button. Come back the next day.
That was really interesting to hear about how, out of, 20 trading days, you've only traded 13 days and you're a day trader. I think that was really awesome that you could share that with listeners. It's a great point.
One of the analogies I'm always giving to my guys that I work with is this. Picture a pool, in-ground pool filled with sharks. Well, that's what you're jumping into to get your money. I want to jump into there when there's the most money at the bottom. In-ground pools, the water's generally pretty clear. You can see, I can see what's there. I want to jump in when it's worth going in there for. I don't want to jump in and take a chance on getting bit when there isn't that much going for. And that's the one thing through the years, that's where the mature simplicity comes in. It just, everything is the maturity of a trader is going to be to where less is more, less is more. And the sooner guys start to pick on that and pick that up and just stick with that, the better off they are on their trading paths, that less is more. And I don't want to be jumping in that pool all the time with all the sharks now. And over trading, in my experience, I've had access to lots of different prop firms. I know the guys at SMB, and that over trading is the downfall of most of your failing traders. And over trading comes from not being confident in what you're doing, your psychological trading, your mental capital is just depleted, and you're just operating on tilt. You're jumping from strategy to strategy. Somewhere you have to draw the line and say, listen, this is what suits me. I need to be active, but how can I be active in a prudent way? Or I have a slower personality. I can sit and wait and only trade twice a week. Look for a strategy that's going to set up with. That's the main thing. Understand so that you can always execute it. That's the problem. Too many times. How many times have traders sat there, they've identified a level, price gets to that level, and they do nothing? Because at that point now they say, oh, well, what about this or what about that? That's where the probabilities come in. That's where I don't struggle with. It hits my level, I know what my probabilities are, and I'm going in the trade. That's it. My risk is taken care of. I know what I'm risking. The trade is structured. I do the same thing on every single trade. There's virtually no difference in the trades, the steps that happen once I get into a trade. Do I have any control over the trade once a minute? I can't control anything. That's it. All I can control is how much I lose. That's it. How much I make or how much I lose. I don't have any sway on whether that's going to happen. And that's what I focus on.
Yeah. So, the reason why why you're so, how do I say this? Why you can trade with such confidence and be so clear on your probabilities is because you specialize in trading one product, and that's the SPY. I think that's kind of rare amongst most traders, is that they actually just specialize in trading a single product. Is that something that you would suggest other traders who are coming up today perhaps consider? Because it's very difficult. We had this discussion a couple of weeks back when we were talking, is that it's very hard to be crystal clear on your probabilities and know your statistics when you're trading a whole basket of stocks or basket of futures markets or whatever it may be. What would you say to other traders who are who are trading a whole range of different stocks, what should they consider? Like, should they think about maybe specializing in a single product?
Yes. In one word, yes. I will say, do I demand or do I think you have to narrow it to one product? Maybe not. I choose to do that. I like the futures now. I trade that. You know, the leverage is there. It's just a good product. You don't have slippage on your stops. That fits me very well. And I can get stats going back. You know, the stuff holds up. That's the market, the S&P. I don't have to worry about anything else. I'm trading the market. I don't have to worry about, you know, sectors and stuff like that. But I would think that it's fine to specialize in some niche. You know, when I was at Bright Trading, there were guys that traded opening orders only. That's what they specialized in. You know, there were guys that traded, back then you had the AOL Time Warner merger, and there were guys that were just scalping against the spread on the ARB of the takeover. And that's what they did every day for however long. That thing took like over a year to close or something like that. Came in every day and just scalped against, you know, that spread. And they specialized in that. There was other guys that specialized in trading only the high-priced stocks. You know, you have to specialize. When I was going to Bright, I rode in a train car. And in the last car on the train, tell you about traders, how much they take. These were all pro traders. Want to know how much they cared about risk? They sat in the last car in the train. I used to joke with them, why are you guys all back here? Some of them had been riding the train a lot longer than me going to the city. You know what they said? Have you ever seen a derailment? If there's any cars left on the track, it's the last ones when the train runs off the track. They were taking care of the risk on their train ride to work. They didn't sit in the front car. They were in the back car in case the train derailed. I mean, they specialized. I saw these guys. I met execution block traders. The car was filled with like the specialist clerks from SLK, the clearing firm that Spear leads Kellogg. And that I used to see the runs from the specialist post at the end of the day. These guys said the thing you learned was obvious right away was low volume stocks. The specialist never lost money. Only chance he had of losing money was in his high volume stock where news could come in and the whole market could go one way and he had to be the guy taking the other side of it. You know, I saw there were NYMEX traders on there. These were the locals in the commodity pits in New York. And that, you know, their whole game was on specializing. You talk to them, they didn't say, oh, I trade this, I trade that, I trade that. They traded, you know, one guy was a spread trader. He traded spreads. Another guy traded the crack spread in just oil, you know. And time again, when I looked, the guys that were making real money and real livings somehow specialized in either an area or a type of product, but they did not try to be a jack of all trades. They were a master in one trade. And to me, you know, I choose to do just one product because with the statistical probabilities I do, it's just, that's where they are. I can know my product intimately. And so I can get to that confidence place sooner to get to bigger size. And to me, that's what matters. It's all about, you know, if you're trading and your strategy isn't allowing you to be able to raise your size and get to size, then what's the sense? You know, why? Because everything's changing. It's not going to last forever, whatever your edge is. You have to, when you have the edge, you got to be able to start to push the pedal. And, you know, most guys, you know, when their focus is spread wide, I don't see them get there. That's just the truth of the matter. That's what I've seen. The best traders I see, they focus, they know, they specialize. It may not be one product, but it's one niche, one type of trade, one pattern, you know, however you're going to break it down, but they are good at it. They don't trade, you know, guys that trade high dollar stocks don't trade single digit midget stocks. You know, that's just the way it is for the most part. You know, you trade what you're comfortable in, where you get that confidence, and you get that confidence by specializing. Would you go, to your doctor for, heart surgery? That's your GP, that's your general practitioner? No. Well, in trading, it's the same thing. You need to specialize in some way. I mean, I've heard other guests of yours say it. Morad, I know Morad. I've had conversations with him. Future Trader 71. Specialized. Dr. Steenberger, I've had conversations with him and email conversations and that for the last couple of years, and that his whole thing has come around focus on what you do best, where you can do it. Nobody that I know is talking about trying to trade this wide spectrum of things. It's figure out what fits your personality in the product and then dive in and put your focus there. That's just what I see. That's what I believe.
Okay. No, that's really good. That's really, really good. Now, one of the things I'd just like to pick up on there is you've emphasized this a couple times throughout our conversation here is you've got to get, when the time's right, you've got to be able to put size on it. Can you elaborate on what you mean by this a little more? Do you mean like taking much higher risk than you normally would? Like, it sounds like you're really ramping up how much you're risking on each trade when you're talking about you've got to get size on it. Can you just walk us through that a little bit?
Okay. Strategy I'm currently trading. We'll just start right with that. It gets developed. I start trading it. I'm trading it at one size, kind of feeling it out, because no matter what you do, when you're developing a strategy, you're in a certain mindset and you think you're going to cover everything that's going to come up, but you don't. So you go in and you start to trade it, and now the regime changes and you say, oh, I thought I had all the rules covered for that regime, but then maybe you haven't been in that regime for 6 months. Now you're into this new regime and you say, oh, I forgot about that. So I always allow for that. So it's going to take me a little time I like to see the strategy trade in, the regimes that I have labeled. I use it's expansion and contraction. There's two different flows of the market in those regimes to me, and the rules vary slightly in those different regimes. Once I've traded both regimes in it and everything is panning out, then the whole goal of the thing is to start to raise the size. Now I use a fixed stop amount pretty much all the time. Now it's not fixed by an exact, let's say in the S&P futures. In a certain regime, it may be 6 points, it could be 8 points a week later where I'm risking. The reason is I'm using what I've settled on to tell me what to risk is, and I track the 1 minute average bar change in the S&P futures. And then I know my stop I want to be approximately 3 times that or more in order to have a decent stop. I need to be outside of that range. I need to be outside of the noise. So I track that 1 minute range all the time, the average of it as we go through the day. And my stop can actually change during the day. For the most part, that stop is always goes against what everything I thought when I first started trading. I thought as a day trader, I would be trying to design a system where I would have the 3-point stop to make 6 points. No, that's not where I ended up. All my work has led me to taking me a place where I will have this 6-point stop with a first scale at 3 points and a second scale maybe at 7 to 9 points someplace or further. But the wider stop. Why the wider stop? Because it allows me to get on the size. When I am comfortable, I tell the guys I work with all the time, so many people set a stop and they say that's what they're willing to risk to lose. But in actuality, when they're sitting at the screen, they're not. They're not. So my stop is set wide to protect me from myself since I'm sitting here and I'm watching the action. I have it at 6 to 8 points. Let's say I enter on a short. Price runs through me. 3 points. If I had a 4-point stop, Aaron, I'm getting into that zone where now I'm starting to think I'm wrong. They just ran right through me, right? I got in, I didn't get profitable for even a minute. I thought I had a good level. They came right through me 3 points. There's my stop sitting at 4. The urge is very strong then to come in and say, just take it off here and save yourself the point, because it is real money in that. By me having it at 6 and sitting there and saying, I know that the 6 doesn't get hit that often. I know the percent. I know my percent of the time that I take the full stop. That's what I call my full stop. It's almost like a catastrophic, but it's in there. When I know that percentage, I can sit there. They run 3 points through me now. I'm not tempted to fiddle on anything. That's it. Now, the process may change. Now, my target, my initial first scale may come back. It may come back to break even. They went 3 points by me. Everything is I'm looking for a 6-point reversion. Well, my expected value now in this trade just diminished. And I'm, so you have to understand that it just diminished. I'm looking for a 6-point mean reversion. They ran 3 points through my entry. So now my stats are all saying I can get 3 points in the money. We start to drift back towards break even. I may decide to reduce half my risk right then and keep on the other half looking for that 3-point reversion. And now also it makes it more comfortable. If I'm wrong, they're going to go back. And even if they get the 6-point stop, it's really only a 3 now, because I cut my risk in half. And that's the whole thing. I don't want to fiddle. When you're building any sort of strategy, you have to figure out ways that you can trade it and execute it without the urge to fiddle in it. That's the truth of the matter. So like me, I very rarely will say they ran through me and now they're coming back towards my entry point. Most of the time, I'll just execute half. I'll have the guys I work with saying to me, why aren't you taking off the whole thing? Listen, I got the trade in. There's still opportunity here. I don't want to fiddle that much. I'm going to leave on the half. My risk is cut in half. What am I worried about? If I truly had accepted taking the loss on full size at the 6 points, why am I worried about taking the loss on the 3 points? It's all just psychologically being content and understanding I can take that risk. So I designed the strategy, whereas now I can size up. I can just start doing more contracts each time. Get comfortable with that number at that 6-point stop. That's my worst case scenario. Once if I'm truly comfortable with that and I'm comfortable with the strategy, it start to raise the size. Why? This edge could go away in a year and a half. It's about pushing that size up to make more in those same trades. But you have to build a comfort level with your strategy under live conditions before you can start to do that. But once you start to get that comfort level, you have to go. And that's the thing. And the main part of it is being comfortable with your stop. And for me in day trading, any system you employ where you employ stops, the returns are going to come down as soon as you put stops in. You have to put stops most likely, unless you're sitting there and you can always execute. But I like to have a stop in. My stop, I consider it, it's 6 to 8 points in these markets most of the time in the futures. My first scale on the profit side will come out at 3 or 4. That's where I take it off. That now allows me to sit with that second piece in that normal bouncing back and forth. I don't get antsy at all. That's it. My stop is now moved. I got a first piece in my pocket. That's money in my pocket. Now I determine my risk on that second half to how much money they can take away, or do I get to keep all that money in my pocket? It just makes it very simple, very easy to stick with. The whole strategy is just designed where your mental capital stays in play and your capital in your trading account grows. And that's, what it is. Like the numbers for March, they're not astounding, but my average, let me just pull it up. Every trade I trade in 2 scales. I mean, if you read my blogs on medium.com, you can see I talk about scales. I trade in 2 scales. I'll just put that right out there. And my losses overall, all the losses are averaging just a little over 1 point in the futures. Meanwhile, each trade is averaging almost 4.5. My first scale is only getting me about 2.5 points on average. because it depends on what the volatility is. If price is having a hard time moving, I'm getting that first scale off to relieve the pressure on my mental side. That's all it is, to not fidget. I have some money in my pocket and I can let the second part go. I don't have to worry about it. I can let that play out, because slow moving markets, everything takes longer. I got a fast personality. I had to design a way where when I don't get that instant gratification, I could sit with the trade. That's what most day traders are like. We like that instant gratification. You get into a trade, you want to see it starting to work. How many times have you gotten into a trade, it doesn't work right away, and then you're looking to take it off just because you're bored. It isn't doing what you wanted it to do, and that's it. So I had to combat all that in the strategy. The second scale is averaging almost 7 points with a 2-to-1 win rate. That's what mean reversion can get you. You trade on the trend side of the ledger, it's going to be a little different. Win rate's not going to be as high. You have to figure that out on your own. Me, I like a higher win rate. A higher win rate where the mean reversion comes in. I can find that higher win rate. I am day trading. I have a stop. And it just allows me to be able to keep my personality in check, trade my personality, be active, and put on size. I hope that makes sense to you.
Absolutely. No, I mean, guys listening, if that didn't make sense, I would suggest actually rewinding a little bit and listening back through that twice, because that was really interesting, Jeff. I appreciate you really going into good detail on that and sharing that with us. Very insightful. Well, we should probably wind things down now. We've been going for just over an hour, so I've really appreciated having you on, Jeff. It's been good. Where can listeners go to find out more about you?
Well, I'm on Twitter at Shack48 Trading. I mean, you could pretty much just Google Shack48 Trading. I've been writing blogs for years. I don't always keep up with it and that. Lately, I wrote some on Medium in the past couple months. I had other ones I used to write for SMB Capital. I wrote for Minionville for a little while. But I get in a phase where I want to write something, and then I kind of fall out of it a little bit. And so you can find me there. My email is readily available out there, shack48@gmail. If anybody wants to contact me, it's fairly easy. I mean, on Twitter, you can just reach out to me if you want to send me a direct message, and I don't follow you because I don't follow a lot of people. I haven't been as active on social media because of the focus. I've always followed a lot of smart people that are talking more macro stuff in that, but I've really cut that down a lot. I don't want to even have anything come in. I just day trade, stick to that, and only what matters to that. And I've really cut down a lot on my social media interaction. A lot. I used to post a lot more. I don't do it as much, but I'm available to anybody. If somebody'd like to come in during the day, I run a call, hit me up. I'll let you join in for a day or two. You can take a listen. You can see, live what I do. I think you'll find some really interesting stuff. It's the S&P futures that I'm trading now, and you'll just it's pretty interesting. I'll say. But I'm easy. I'm accessible. I'm out there to help people. I don't mind helping, but I love helping guys, Aaron. Let me just say this. I love helping the guy that's been kicking around for a couple years and they haven't figured out how to really make the money. They're not losing money, but they can't find that way to flip the switch. Those are the guys that I really I delve into. I love helping those guys. Why? They've showed the persistence. I don't really like at this stage in my trading career, if I write something for the newer guys, if I'll do something like this for the newer guys, that's fine. But my one-on-one time and my stuff like that, I really like a guy that has shown he's not giving up right away at the first little, storm that comes along. Because I've come across so many guys in my career where, they all tell you, oh, this is my passion, this and that. The first little storm comes along and they're gone. They're out. I like the guys that have been kicking around, and I love working with businessmen because they understand that this is a business. Guys transitioning out of business and that, because I put a lot of stuff in those terms. That's the difference. This is not a hobby. This is not a place to come to markets to get your action junkie side out. This is a business. You got to run it like a business, especially if you're a one-person business, and you have to have a goal of really making something of it because there's nobody else to back you up. if something happens with you. So you have to take it serious and you have to have that focus and do it. So those are the type of guys, any of them out there like that, hit me up. I'd love to talk to you. Yeah, and as you can tell, I'm not shy when it comes to talking.
Nailed it, Jeff. Absolutely brilliant answer to take us out. Thank you very much. One thing I was just going to add in there is maybe, guys, if you have any questions for Jeff, just leave a comment in the show notes at the bottom of this page. I take it you'd be cool answering any questions that come through, Jeff?
Yes, no problem, Aaron.
Awesome. Okay, guys, so just go to chatwithtraders.com, scroll to the bottom of the page. First, go to chatwithtraders.com and find this episode. I'm not sure what episode number it'll be just yet, but scroll to the bottom of the show notes page and leave your question in the comments area at the bottom, and both Jeff and I will be monitoring that. So, if you've got any questions, that's the place to leave them.
Can I just say one more thing, Aaron?
Go for it.
I think what you're doing is fantastic for the trading community. I listened to most of your podcasts that you've done. I tried to get through and listen to all of them. I've actually discovered some new guys that I follow on Twitter a little bit and that, but I think there's lots of good information out there for, you're really providing a good service to the trading community, and I just got to commend you on that. And I look forward to all the podcasts that you put out.
Well, thank you very much. I appreciate that. It means a lot coming from yourself, Jeff. So good stuff. All right, guys, let's close this out here. And once again, Jeff, thanks a lot for coming on.
Thank you for having me, Aaron.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, traders? Welcome to episode number 71. Thank you very much for tuning in. A big guest on the podcast this week, a man who for many won't need any introduction, and that is Eric Scott Hunsader. Eric started out as an algorithmic trader in the early 80s, soon after became a self-taught programmer, and since then he's written many software applications for financial data. But today, Eric is the founder of Nanex, a whole market streaming data feed which transmits 20 billion data points every day. Well known for speaking out against the many issues that surround high-frequency trading, Eric will tell you straight: HFT firms are stealing money, exchanges have rigged the market, and the regulators that allow this type of activity to continue are corrupt individuals. So as you can imagine, this makes for some really interesting conversation. Additionally, we talk about quote stuffing, many flash crashes that are occurring on a daily basis, and why Eric recently received a $750,000 whistleblower award from the SEC. Now, this interview is a real eye-opener, and I'm excited to share it with you. I'm Aaron Fifield, and here is Eric Hunsader. Eric, it's incredible to be speaking with you. How's it going, man?
It's going fine, mate.
I like it. Well, thank you very much for being here. Let's get right into it because I certainly have a lot of questions for you, mostly around market microstructure and, of course, HFT. But before we get too deep into that, I'm keen to know how you got to where you are now. So let's start from where you began programming, because you've been labelled as one of the most gifted programmers in the United States by The Guardian. Where did you learn from and how did you get into programming?
Well, I started in '84, and they weren't really teaching programming languages in college. It wasn't mainstream at all. So I taught myself. Got a book called C Primer Plus, written by Stephen Waite, who, by the way, later became a customer of mine about 15 years later, but that's beside the point. Anyway, I bought his book. Really went through the entire C language, and I devoured it. I mean, I read through the whole thing in just a couple days, and really enjoyed writing code. And actually, the reason I wanted to learn computer programming languages because I had my own algorithm in a Lotus 1-2-3 spreadsheet calculating 30-minute oscillators for the S&P 500 futures, which I would then call in down on the floor when the signals went off. And that wasn't fast enough to run optimization, so I turned to see how I could do it faster, and that led me to I need to program, and C seemed to be the best language. And I started that in '84, and I have not stopped.
That's very cool. Now, do you still use C for the most part to this day?
Yes, yeah.
Okay, excellent. Now, so you mentioned that you had some interest in trading as you'd already created an algorithm before '84. Where did that interest in trading and finance come from?
The Wall Street Journal. Just fascinated by that whole world. How you could be independent and create a living with not having to hire a lot of people. It was a way to kind of get to do something on your own that was exciting.
Yeah, no doubt. And I think that's what, obviously attracts a lot of people to trading. And, it really sort of draws on that entrepreneurial streak that many of us have. So what was your experience like, in those first few years trading? From what I understand, you're not an active trader still to this day. So how long did that last for?
It lasted about 2.5 years. And it was during that time that it was actually quite profitable. And, enough to make a living off of, and enough to buy more computers. And it was also during this time that I really developed a love, if you will, for writing software, and not so much of a love for following the system, because I would always second guess it. Writing software will always do what you tell it to do day in and day out, whereas trading, there's a lot of unknowns that you can't account for. And I just decided that I was going to learn how to write or get better at writing code, and I would come back to trading one day. And I never did. And so it was at the same time I was developing the system, I was also archiving the data that I was using in the system, which was, the futures data from the CME, which, by the way, I was able to archive on a 360K floppy disk. The entire exchange was trading for the day. And started selling that data to other people who wanted to develop algos, and, created a bulletin board system and sold the data online. This was quite a bit before the internet, where people had to dial up. And, that business was actually taking off and bringing in income. And so it was a pretty easy decision to say, hey, you know what, I'll come back to trading later in life.
Sure. So is that how Nanex came to be today, or did you have any other roles in the finance world or even?
Oh, no, Nanex didn't come along until the year 2000. So so around '89, one of my customers who was buying data from me was a man by the name of Tom Joseph, who runs Trading Techniques in Ohio, and him and I really got along, and he wanted me to write software for his company, and I thought that was a great opportunity, and so I took it, and I went to work for him, and we did great things. But we had. I remember we were riding around in his Cadillac with an old compact computer hooked up to a cell phone modem thing. It was a big brick, but we had real-time streaming charts, mobile. It was the S&P 500 futures, and so I wrote a lot of software back in those days. That a lot of it. We were doing Windows kind of stuff before Windows even came along. So that when the next iteration of software came down the pike, it was, we were always iterative and learning on top of the knowledge base that we had built up before. So then it was a few years doing that. A company called CQG, which is still a company around today, they bought Tom Software and wanted me to come along with it. So I did, because Windows had just come out and they wanted to port their software over to CQG for Windows. And I thought that was interesting, and so I went to do that. And then about 3 years into that, that's when the internet came along. And people who had been writing software for a while then, we just knew the internet was going to be huge. I mean, it was within a few days of really seeing how things were connected, it was so obvious that this was going to be one of those revolutionary things. And I went to the CEO of CQG, Tim Mather, and I said, "Hey, Tim, I want to do this. This is what we need to do. And if you guys don't want to do it, I want you to, I want to go and do it on my own." And he was cool with that. And so I left and started my own company, and in a very short period of time had written a real-time streaming Java applet that, somebody could type in a symbol and they would get the streaming chart and time and sales. And that was called, we called it Live Charts. And then we had a desktop application that went with it called Q Charts. And Quote.com came along and saw it, and we kind of merged together. They gave me a bunch of stock in return for the software. And so we partnered together, and in the space of 18 months or 2 years, we went from 0 to 10,000 paying customers. And so,
Wow.
Which was a novel thing back then, because everybody was giving things away for free. And really the only sites making any money were the dating sites and us. And it was fascinating watching, interacting with people who for the first time ever saw that stock prices actually changed during the day. I mean, so many people had this notion that, that the numbers they see in the Wall Street Journal, those closing prints, is the only price for that stock for the day. And so that brought on a whole group of people, day traders who wanted to participate. And this was the, big internet bull market, of course, which made it all the more wild and crazy. And so winding up, Lycos came along and wanted to buy Quote.com out. And actually, what really goes on, that whole IPO business is, the venture capitalists, they want to cash out. I mean, that was what they're always looking at. And it was the term is a liquidity event, where we can turn our worthless stock paper into money. And I was fine with that, and so we got cashed out, and I got a chunk of Lycos stock, and knowing how the markets were and how crazy that bubble was, I had it all sold in about 2 weeks. which, at the time, a lot of people were telling me I was being an idiot, but, that was in December of 99. And I guess it was one of my better trades. And that's when I founded Nanex, the company.
Okay, sure. So tell us a little bit about Nanex and what you're actually doing today. And by the way, that was really cool to get your backstory. So yeah, give us a little insight to what Nanex does today and, what you're doing on a day-to-day basis.
So, one of the things that I've always been developing over the years, in fact, the code name for what I call Encore now, the data feed, is I called it Generation 5 because it was the fifth time that I was going to start with a blank sheet of paper and design the ideal ticker plant that so that you could build things on top of it and not have to worry about all of the difficulties that go into putting together a ticker plant. Which involves maintenance and databasing and normalization and duplication and then have a nice API on top of it so that writing software for it would be a joy. And so that's what I set out to do in 2000. And I logged the hours, and it was about 25,000 hours later. I had it in a stage where I was comfortable releasing it to my first customer, and that was in 2004. And remembering the crazy times of going from 0 to 10,000 paying subscribers, I wanted to do this one a little bit slower and more manageable. So I never advertised it was available. I partnered with a company, by the way, called Data. At the time, it's called Data Transmission Network. Now I think they're owned by Schneider, but they're still my partner, and they do all of the non-software related things. They manage the networks, they deal with the exchanges, which is a big part of the equation, the contracts with customers, the billing, everything that's not really related to processing the real-time stream. So by not advertising or wanting to push it, and I wasn't out to conquer the world and be the king of real time. I just wanted kind of like build a solid niche that that was proud of, that I could write software on top of. And so by never advertising it, we got a very wide variety of customers using it because they weren't targeted.
Right. Okay. So who are you said you've got a wide variety of customers using Encore. Who are those types of customers? Like, are they big institutional funds who utilize your data, or are they,
yes.
Independent guys?
Yes. Yeah. Name me a group and I'll say yes. We have representation from all groups, including high frequency trading firms who want to, do back testing on it. We have a very unique data set. We pride ourselves in really, drilling down to the issues. In fact, we help the exchanges actually debug some of their issues that they had with the various trade conditions, for example, and whether it sets the higher or lower, or crazy rules that they have. Whenever something didn't match up, we would track it all the way down to the source to find out exactly why this condition is doing X when you have a document doing it Y. And so it's that attention to detail, and also just the joy of working with the API. It really is out of the box. For somebody to work with a data feed, usually there's a long process in understanding all the different ways to parse that data. But with Encore, it's a really unique experience where an experienced programmer can come along who's written for other data feeds, and within one day will totally get it, and will be actually getting down to writing what he wants to instead of working with the API, with the actual nuts and bolts of the feed.
Okay. So just so we understand, why is the data that you provide so unique from other data providers that exist to this day?
Well, one, we don't exclude anything. A lot of other data providers will squeeze out the information that they don't feel is necessary. They'll normalize it way before it's supposed to be normalized, and I don't believe in that at all. The other thing is I've developed a real-time compression that drops the size of the information to a 20th of its original size. One of the things that I've specialized over the years in working in software is data compression, data transmission, and graphical interface. So the compression part, I sat down and tried to figure out a way where I could not sacrifice speed, but get the tightest compression possible. And I had been stabbing at it for many, many years in the past. And I finally got a breakthrough that allowed the compression to drop lower and lower than I had expected in the beginning. And as an added bonus, was very fast. And it was so fast that it actually ended up being, back in the day, faster to compress it and transmit it than not to compress it at all because of the serial latency cost on networks. So the data is tiny, but it's rich with all the information within. It's very easy. It's hard to describe, but it has things in it that when programmers see it and use it for the first time, realize the huge advantage that they get. For example, one of the more expensive tasks in dealing with the ticker is taking that symbol and associating it with a memory pointer, where you're actually going to start doing some work with it. That association there is usually a pretty expensive process. With our feed, we've cut that cost down to zero. It's literally no cost to have that instant. You're working with that data immediately, and we save you these important steps along the way. It just makes it easier. Unless you're a software guy and you've used it, you won't. It's impossible for me to explain. But the guys who have used it, there's that light bulb moment when they get it. And, usually it's like, oh, that's brilliant. That's just awesome. And that's the last we hear of them because they don't need our help anymore. I mean, they're off and going.
That's awesome. Yeah, that's really interesting. Now, your flagship product here, Encore, I understand it collects around about 6 billion data points each and every day, which is huge.
Well, we're up to 20 billion-ish.
Wow. Okay.
Starting at the beginning of the year, they keep adding options exchanges and they keep developing new option products. And I mean, there's a million different option contracts out there, and there's 15 exchanges, and 15 times a million times 1 quote per second gets you to 15 million a second.
Wow. Okay, so 20 billion data points per day.
Yep.
Can you give us some idea about the infrastructure and server space required to support this data?
Well, it's about a petabyte raw now. But
okay, so what's
again,
that?
A petabyte, so you have gigabyte, and then 1,000 gigabytes is a terabyte, and then 1,000 terabytes is a petabyte.
Okay, right. And is all that stored locally, or do you use like sort of a cloud system?
We do have some of it in the cloud, some of the more recent data in the cloud, but we have it in triplicate in different locations. It's an onslaught of data that's coming at us every day. It could be a terabyte a day that has to go through the system, and it's automated to check it, to test it, to look for errors and correct those errors. And it's not something you'd be able to develop right away. It's after a lot of experience, you learn the best way to make that flow automatically.
Sure.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
So let's just change topics here. Let's dive into the subject of high-frequency trading. So one of the questions I want to start out with is asking you, when did you first begin to notice HFT activity in the data you were collecting?
Well, I remember looking at, just checking on how the compression was doing, and seeing quotes from, certain, I think it was ARCA was the first one I really noticed it on, where it was an obvious pattern where the quote would step up a penny and then down two and then up two, a pattern like that over and over again over a short period of time. And I thought that was interesting, but it wasn't enough for me to really sound the alarm, or it just looked like somebody's testing some system, and it's not something that will happen all the time. And then it wasn't until the flash crash came along and, just overwhelmed the data systems throughout Wall Street. The SIP just got crushed that afternoon. And we, my colleague Jeff and I, we saw the SEC wasn't getting anywhere with even assembling the data to start processing and seeing what happened. And, the beauty of the Encore is you can go back to any day and replay that day just like it happened in real time. I mean, where you can see what the options were doing, what the futures were doing, what the ETFs were doing, and the underlyings, all of that, as if you were there on that day. So you can go through scenarios and you can see what the relationships are. And so I remarked to Jeff Donovan, my programmer out in California, I said, you know what? Why don't we spend a week just seeing if we can find anything unusual in the data set? And, oh God, do I regret that. That was going down a rabbit hole that just keeps on going. So it was a very short period of time. We discovered, oh my gosh, look, NYC was 30 seconds late updating the SIP quotes, and we published the first thing that we've ever written, and it got picked up on Zero Hedge, and boom, overnight, people were calling us. Andrei Krylenko from the CFTC, for example, saw it, and he was like, "Oh, you got to come out to Washington. We want to talk to you." And that's kind of where the rabbit hole got deeper.
Okay. So, and you do a really great job of explaining that 30-second delay that occurred during the flash crash in the documentary Money and Speed. So I'll make sure to link to that documentary in the show notes. Just want to ask you to explain the SIP, if you could, please.
Well, the SIP is a consolidated feed, man. So what's really unique about the U.S. stock market that I don't think is replicated anywhere else, and God, I hope nobody does, replicates that model, but they sell two data feeds. And one of them is faster than the other, but by law, it's not supposed to be. And so the SIP was supposed to be the only source of real-time information. I mean, written and referenced everywhere in the in Reg NMS, which is the regulation that really ushered in high-frequency trading in the U.S. stock market. And so the SIP was being used by a lot of firms for the real-time data, including Goldman Sachs' Sigma X dark pool. Many dark pools were using it. Many exchanges were using it. In fact, the NYC still uses it to this day for knowing where the prices are at the other exchanges. And so the SIP is a consolidated feed, which should be the only feed, but the exchanges also sell direct feeds independently.
Okay, got it. So just before I fire off some more questions about HFT, I think it might be a good idea to ask you, what's your interpretation of HFT? Because I know many people have, slightly different understandings of, the phrase HFT and high frequency trading. So when you speak about HFT, what are you referring to?
Okay, I'm going to make this really simple. HFT is all about electronic trading. I like to use this phrase. Electronic trading brought down costs. High-frequency trading brought down ethics. High-frequency trading is a form of trading that takes zero risk. It results in perfect trading days. It's where you have the sell side already executing at the same time as the buy side is executing. It's risk-free arbitrage, and it can only work if you have collusion with the exchanges. The exchanges are fully aware of what's going on, and because they sell these high-priced data feeds, it's just what's driving all of their income. And so it's this symbiotic relationship between the high-frequency firms and the exchanges. High-frequency trading requires special access. It requires special wink, nudge deals with the regulator, so they don't get fined into oblivion. It requires lobbyists. It doesn't. It's not so much the code. It's so much the infrastructure that you have to build around it, and then hope to God you don't suffer a regulatory breakdown. So I'm all for electronic trading. I would prefer no rules at all, as long as it was equal for everyone. I believe that the smartest guy should win, and the smartest guy shouldn't have to worry about hiring a lobbyist to win. I have a big problem when the rules are not transparent, when the rules clearly say X is illegal, but X is going on all the time. It's hard for smart people to operate in that environment. It's hard for me as a businessman to decide I'm going to support that kind of product, even though I know that is illegal and it should not be. One day, if somebody with ethics ever got into a position of power, the regulator would shut it down. I'm not going to do that. I'm not going to. When the biggest risk is regulatory risk and not market risk, and or the traditional types of risk in this industry, smart people are going to say no.
Okay. So what? Just so we really understand this issue. I know it's a very complex issue, and maybe to get a complete understanding of it might be slightly beyond the scope of this podcast. But what is the big issue? Like, what's the problem with HFT? If you had to kind of put your finger on it.
Well, okay. So I want to say HFT for the most part is something that exists within the U.S. stock market more than anywhere else. In fact, compared to a central limit order book that you'll find in many other places, including like the CME is a central limit order book, 99% of the issues don't exist. The high-frequency trading in the U.S. stock market exists because the laws of physics and the distances between exchanges and the lack of regulatory oversight and the exchanges allowing or giving these guys faster data feeds. Essentially, Reg NMS was supposed to tie together 10 stock exchanges so that the liquidity would pool together. So before, if you had one exchange trading one stock, all the liquidity would be at that exchange, the central limit order book. They wanted competition, so instead of having one exchange, will have multiple exchanges, let's say 10. And the idea was if we tie them all together with the SIP, the consolidated feed, and Reg NMS, which has this trade through rule, which if one of those other exchanges has a better price, you can't trade outside of that other exchange. You have to go access that liquidity by those pieces in Reg NMS. The thought was we'll have competition and we'll still have the pooling of all that liquidity together. What HFT does in the U.S. stock market is it guarantees that that liquidity is not all pooled together. And once they see executions going off at one of those exchanges, they have faster connections and the ability to race ahead of that executing market order and cancel their orders at the other exchanges and even go in the same direction ahead of those orders, depending on what their statistical models say. So they're in effect destroying that liquidity concentration. So that when traders see, there's 20,000 shares of forward offered at the market, even though the 20,000 is 5,000 at NYSE and 6,000 at NASDAQ and 4,000 over at BATS, they're never going to get 20,000. They're going to get a piece of that.
Okay, so one of the counter arguments that you often hear from those who are in favor of HFT, they often say that HFT provides participants with tighter spreads. Is that at all true?
No, it's not true. That's not true. Spreads change within. So, first question I always ask, and I never get an answer, by the way, is how are you measuring your spreads? Are you measuring the widest in a second, the narrowest in a second? Are you aggregating over longer periods of time? Because I can show you thousands and thousands of examples where a stock will move 1% within a second, yet maintain a 1 cent spread during that second. So from one point of view, it's a 1% spread, and another way to measure it, it's a 1 cent spread. And I can guarantee you who's going to actually participate in the benefit of the 1 cent spread, and who's going to get reamed on that 1% spread. And it's not going to be the retail investor.
Okay, so are there any other, that's probably the wrong phrasing, are there any benefits that come from HFTs being active in the marketplace?
Yeah, they push the envelope for transmitting information from point A to point B. In other words, they're providing an incentive for the millimeter microwave dishes to improve, to drop latency, for FPGA cards to be more efficient. I mean, Wall Street has always played a strong role in being on the cutting edge of technology and kind of supported the early engineering efforts at Intel and Dell and Cisco, who might not have developed really high tech bleeding edge kind of things, and so that's one benefit they provide. They certainly do not provide any benefit to somebody trading on the other side of them.
So a term that you often hear associated with HFT is quote stuffing. I know you've mentioned this in the past also, and I think you might have been almost hinting to it a little bit earlier on. Could you explain what is quote stuffing, and has this not always existed on some level?
Well, actually, that's a term that I coined. When we saw, one of the reasons that the SIP got so delayed back in the day was because of the excess traffic on it. Noisy quote spam. And I remember when Jeff and I were trying to come up with a name for it, I wanted something that was going to be easily Googleable to know that, hey, we created that. And so I don't remember whether it was him or I that came up with it, but quote stuffing is the term we used, and now it's being used everywhere. Quote stuffing is a tool to allow you to slow down another data feed on demand Like if you want back in the day, if you wanted the NYSE's direct feed to be a little slower, it was a matter of putting X amount of quotes in this inactive symbol, which also was processing the symbols that you were interested in. It was just more network traffic. It was effectively tiny denial of service kind of thing going on. And when you are an internalizer or a wholesaler who is buying and selling on direct feeds, and you're giving the retail customer prices based on the SIP, well, whenever those two are out of sync, it's free money. You buy and sell off the direct feed, you pick out whatever number you think you can get away with giving the retailer as a price for their order. And if those two are out of sync, it's instant money. Because, the regulatory requirement was that you had to be within what the SIP price was showing, and regardless if the SIP was slower or not. So I remember having a discussion with somebody at a big bank, one of these firms, and telling them when I first discovered, hey, you know what? I can tell you exactly how you can slow down any one of these feeds. And the reply came back, yeah, we know. We've got these latency tables, dude. I was just like, well, yeah, of course then I just sheepishly, grinned to myself. Yeah, you would. It makes total sense. But so, all the things that we discovered and published, they all knew this was going on, and whatever they called it to slow systems down, I don't know, but that's what quote stuffing is all about. And it only really works if you got something that has two data feeds pricing the same thing. So it doesn't. Well, actually, you can actually affect the central limit order books as well, like the CMEs, because you got to remember one machine is going to process more than just one symbol, except for SPY. I mean, the E-mini probably is only processed by one, but there probably are systems there that process like the 10-year note and the 5-year. And so if you put a load on the 10 or the 5, it's also going to put a load on the other contracts in there. And, it could cause an arbitrage situation with the cash market. So it's just putting noise in the system in order to slow it down. And so one of the things you have to do all the time, because of that, you have to combat that too, because others are going to do it. You got to maintain your latency tables. You got to know what those limits are. So if the exchange upgrades a network or a machine, all of a sudden that number is different. So you got to know when that changes. And so you're always pinging and testing to see what that limit is. And there's no cost for sending bogus quotes through the system, so why not? And so a lot of the noise that we see is that.
Interesting. Okay, that's a really great answer there, Eric. Thank you very much for digging into that. In various documentaries you've featured in, you've actually described HFT activity as stealing and rigging the market. Do you actually believe that is the case, in a literal sense?
Oh, I have no doubt. No doubt. Anybody who disbelieves, I welcome you to come to my office. I guarantee you, after 2 or 3 hours, you will leave changed. In fact, Nate, who works here in the office next to me, always says, every time somebody comes here, when they leave, their mouth is like on the floor, and they're just like you can tell it was information overload. I can show you. I can show you exactly what's happening. I can show you documentation of the proposals that exchanges have made. I can show you, fines that have come out years later, years after they were denying this stuff ever existed. It's totally rigged.
Okay. Well, I'd love to come by your office sometime if I'm ever in the States there. So I'll keep that in mind. Now, let's get to the bottom of this. So who is the real victim here of HFT? Is it retail traders? Is it longer-term investors? Who's really affected by this?
Everyone. And it's not, the thing is, there's no busload of children going over a cliff. it's just a billion paper cuts suffered by everyone. It's something in the system that doesn't need to be in there. And one of the real damaging effects it has is it kills the diversity of participants, where if everything is based on speed and even a little bit of intelligence that takes too long to work out, or you don't have that regulatory advantage, you kind of get sidelined. And so you end up with a market that is just filled with lemming machines that don't have a diversity of opinion and might not, at the moment, do something, when the market is crashing, do something what might look stupid and jump in there and buy. They're not going to do that because they're faster than the other ones, and you end up getting these microstructure gapes in reality, when all of a sudden a large cap stock will just suddenly evaporate 5% and then suddenly recover. And lots of times you look on a chart and you'll see a little spike down, and you'll think, oh, it's a bad price. And then when you actually dig into it, you see there was 1,000 trades, and a penny all the way down got executed a penny all the way up in a half a second. And then you see that this happens dozens of times a day. And then you see that it's in really big cap stocks. And then you see the SEC, saying, well, people shouldn't use stop orders anymore. And then you think, wait a minute, that's never been a problem in the past. And so it changes the whole way the market is set up to be not really assisting the retail trader. For example, what kind of orders do you have available to you as a retail trader? Buy, sell, market, but I'm not supposed to use those anymore, limit, and stop. And I'm not supposed to use those anymore either. Where's the order that says, I want to buy whenever the market drops, suddenly this much percent at any one of these exchanges, or I want to trade at 9:45 in the morning. Oh, look, I've got surgery scheduled in the morning. I'm not going to be watching the market, and I sure don't want to get eaten alive at the open, but I want to buy at 9:45. a.m., 15 minutes after it opens. And where's that order? Well, I mean, nobody's catering to, the group that's actually getting eaten alive.
Okay. So if this really is such a big issue in the market structure, why have regulators not stepped in and put a complete stop to it? I know there's been fines handed out, here and there, but there's not been a complete stop put in place. Why is this the case?
They're corrupt. And I don't say that lightly. I say that after years of banging my head on it and talking with them and reading documents and calling them out on it and being right. Everything I've published that used to be called a conspiracy nut for has been proven true. I mean, the SEC just gave me $750K whistleblower fine for the discovery I made at the very top of the rabbit hole. These guys they're looking for their next job, and they get wined and dined by these firms. The whole thing with the IEX, for example, them coming in and really promising them their future employment. Why would they stick their necks out when they don't have to? There's no bonus check in it for them for doing the right thing.
So in that case, on the other hand, to what extent are the exchanges also responsible for this type of activity that goes on?
They're totally responsible because they're selling these data feeds and they're ensuring that they're faster. It's not. So the law is really clear that you can't provide core data faster on your direct feeds than you provide it to the SIP. And that is what the NYSE got fined $5 million for. And that is what the NYSE swore to me. The CTO of NYSE on stage, I was next to him on stage. We were both invited to speak at the TD annual event in Toronto. And it was Larry Leibowitz, who's actually the brother of Jon Stewart. And he has the gift of talking like his brother does. And he was there on stage painting me as a conspiracy person because I was saying that their feed was slow. And what was really funny about that interaction was I had done the study in July 21st of 2010. This is after the flash crash. And Larry was saying that, there were some system issues, but we got them fixed and everything is fine now. And I was asking him, I said, how long did it take you to fix them? And we had to fix right away. We saw it and fixed it right away. And I said to him, so it would have been fixed in June. And yeah, of course, he looks at me like I don't know what I'm talking about. I said, yes. And then I said, well, the study was done in July, and it shows the same thing happening. And that's par for the course. I had a long discussion with the now disgraced Bill O'Brien, the guy who had a little fight or spat with Brad Katsuyama on CNBC, who, he argued things with me. He spent the whole afternoon, arguing his point. But it wasn't based on anything concrete or reproducible. It was just based on what he was saying. I mean, they're very smooth talkers, so that talking to a reporter, it's so easy to bamboozle them because it's a very technical thing, and they're, in a position of authority. And I think how this all got this way is in the United States, we give the exchanges, they're self-regulating organizations, SROs, which means that they have legal immunity, which, over the years, if you have legal immunity, which means you can't be sued for, even if you egregiously do something wrong. Well, I know human nature a little bit, and you mix that in with capitalism and having shareholders, legal immunity is just a downward path to the place that we're at today. And that is why.
Yeah, and you make some really great points in there, Eric. And I imagine you'd be a very difficult man to argue with because you have the data. And I mean, at the end of the day, the data does not lie.
I've never lost a debate when it comes to data. And I never talk about anything I don't have data on. I mean, if it's not a subject I'm comfortable with, or I don't have a data to support it, I'm not going to say anything about it. And so at the end of the day, I never. But the thing is, it doesn't work for sound bites. It's not a news story, and I can't cut reporters off, access off, where the NYSE can or NASDAQ can, and that's a big deal.
Mm-hmm. Yeah. Yeah, because, I mean, there's such a big difference between fact and opinion. I mean, they're two very different things. So, I mean, just moving on, is HFT here to stay? Like, should we just accept that it's not going anywhere and this is the new market, or not so fast?
Well, so I'll ask you this. Should we accept that a person of integrity and will never get into a position of power at the CFTC or the SEC? Somebody who's very knowledgeable and has integrity. If you're telling me that person will never get in a position of power, then I will tell you that HFT is here to stay. But the day somebody like me gets in there, their days are numbered, because you don't have to create any new laws. You don't even have to, try to set precedent. You just go and say, well, we find that person that much for doing X. You did the same thing for a longer period of time. You get the same punishment. Like, for example, Sarah, who's, facing a lifetime in prison, which, by the way, I think is just a travesty. He's not doing anything different than these guys are doing. And why is he being singled out? I mean, it's wrong. And so if somebody ever gets in a position of power like that, they're in a heap of trouble. So you tell me, is that how society is going to be going forward? Is that what the new thing?
Yeah, well, you do raise an interesting point. I mean, is that something that you would like to step up to if the position was ever available and offered to you?
I've offered doing it for free. Yep, as long as I've got authority, and I'm not going to, like I said, I'm not going to create any new rules. I'm not going to try to set any new precedents. I'm just going to go through the existing laws and what's already been done and apply them equally and transparently.
Okay. And what sort of response did you get when you offered to do it for free?
Always dead silence. Dead silence.
Right. Okay, Eric, so I just have a couple questions left here, and these questions are mainly based around mini flash crashes. So I think for the most part, listeners are probably familiar with the flash crash that occurred in 2010. I want to ask you about these mini flash crashes that seem to occur more frequently. So I guess, first of all, what is a mini flash crash, and how frequently are you seeing these occur?
Well, we define it as something that happens within a second that involves more than 500 trades, that involves price move of several percent. And it always reverses. So there's the crash and then there's the recovery, and the crash involves a frenzy of trading activity, and the recovery involves a lot of activity, though not as quite as much as on the way down. They also happen in reverse equally. So you'll get a frenzy to the upside, and then the recovery, and this will all happen easily within a second, and often involves 1,000 trades, and will often involve all 10 exchanges and many dark pools to boot. So this is a phenomenon that did not exist before 2007. After 2007, they started appearing more and more frequently, and we still have them to this day in big cap stocks, like just today, HOT, large cap stock for hotel. I'm not sure what the name of it is, but the symbol is HOT. It's a hotel and properties company. Just out of the blue, ripped higher and then right back down again. And what's going on is somebody's trying to access the liquidity, gets discovered by one of these high-frequency firms that maybe be a little bit more predatory, sees it and races ahead to trade in the same direction, knowing that algorithm that they're using is going to keep going and buying more. And they know that they're the fastest. And so other firms who may not be the fastest, but they know that there are plenty of people slower than them, are going to jump on, and so on, until you've got, the guys at the very end of it who are, the ultimate suckers who are going to end up getting dumped on when the whole thing reverses and comes back the other way. And so what these kinds of events have caused, how it hurts everybody, all the participants, is you really can't have a flat stop order in the market anymore because you're going to get taken out by one of these. And you can't really participate in these because they don't always execute at all exchanges. So in other words, if you were to wanted to place an order to get executed whenever a stock dropped below X amount, they don't always go off at all the 10 exchanges. Sometimes they're confined to a few, especially at that last part of it. And so you're never going to get filled. You can't really participate in them in a way that you can benefit from them, which would in turn prevent them from happening or be as severe. And you're going to end up getting stopped out by them, which means, people are less likely to use stops. So the way that the SEC came around to fixing this was creating this thing called limit up, limit down, which is a very complicated, essentially moving average based on all the trades in the last 5 minutes, and in updates in certain way. It doesn't update all the time. There's rules, this, that, with the other rules about them, but they're basically about 5% away from the last price. And so now that those have been rolled out and put in place, we see a lot of these little flash crashes will go within a penny of them and reverse. That's the point, that they reverse in price. So they've ended up becoming magnets, so to speak, whereas before the stock might drop 2% on one of these. Now they're pretty much guaranteed to go the full 5% and back.
Okay, that's really fascinating. It sounds very complex. It's almost like they've just kind of put a Band-Aid on the issue and not really solved it.
That's exactly what they did, which kind of came back and bit them on August 24th when. The problem with this is it contains one stock. Well, if you call Walmart dropping 5% and back inside of a second, if you call that contained. But when you have multiple stocks doing it and they're members of ETFs or indexes, and one of them is halted and the other one's not, and or 5 of them are halted and they come out of the halt at various times, it makes it very complicated for the people who are trying to arb at the ETFs. And whenever there's complication or confusion, that instantly results in more volatility and less participation. So you end up with liquidity evaporating very quickly. So I guess I could ask you, where are these tight spreads that are being claimed by these high frequency firms if we have these mini flash crashes all the time? I mean, dozens and dozens every day occur. So if there truly were providing tighter spreads, you wouldn't have this. We certainly didn't have it before 2007.
Yeah, no, that's wild. Now, from what you see going on, on a day-to-day basis, what's the likelihood that we could experience something much more significant and damaging than the 2010 flash crash?
Well, August 24th is pretty bad. The Treasury incident back in October of 2014 was pretty bad. The dollar 5% crash 1 year ago today was pretty bad. They keep coming, they're just not being talked about. So that's the solutions. We're just not going to talk about them.
Last question I've got for you, Eric. Now, I know you've been a great supporter of the development of IEX and then potentially becoming a recognised exchange. What's significant about what IEX is doing?
They're people of integrity. Remember I said what will happen when you get somebody of integrity in power? So if the IEX becomes an exchange, they're now SRO, which means they have legal immunity, which also means that they can see what's going on, and somebody with integrity and power to say, hey, this firm, what you're doing is wrong, and calling them out on it, and not having, that worry, oh, I can't do that. I can't talk to them and tell them not to do that because they're buying my data feeds, and that's all of our income. And these guys generate all of our income. We can't tell them to stop. So you get a person of, you get people of integrity with power, and these things will go away. And that's what IEX represents.
Okay, sure. No, good answer. And I'm hoping to have one of the guys from IEX on the podcast sometime soon. So that should be a good discussion too. Well, Eric, let's wrap this up. It's been an eye-opening conversation, that's for sure. I mean, I've really appreciated having you here, and thank you very much for setting aside the time to do this. I know you're a busy man and you've got a lot going on. So, it was really good to speak with you. Where can listeners go to find out more about you?
Our website, nanix.net. It's hard to miss us. Just Google or nanix.net. I frequently post on Twitter under Nanix LLC.
Awesome. Well, I strongly encourage you guys listening to go and follow Eric on Twitter at Nanix LLC. He posts a lot of really great content, very outspoken, and some awesome visualizations, which I get a real kick out of looking at. So, Eric, once again, thank you very much for doing this, man. We'll speak again soon.
Thanks for having me.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey guys, thank you so much for tuning in. Welcome to another episode of the Chat with Traders podcast. You are listening to episode number 72. Now, this week's guest preferred to remain somewhat anonymous. Although his name is Rob, others know him as RG, and he's a part of Discovery Trading Group. Rob is an active futures trader and is what most people would call a pure scalper, but he refers to himself as a street-level gambler with an appetite for risk. Either way, he is a very short-term trader and often just trading for a couple ticks at a time. So that's one side of what he does. The other side, Rob is also involved in a quantitative research firm which trades a whole range of strategies over various timeframes in many different markets too. Over the next 60 minutes, you'll hear about Rob's early years of trading during the 80s and how he's developed into the trader he is today. Rob also really drives home the importance of risk management, shares a few gambling analogies, and talks about the benefit of interacting with other traders on a regular basis. So, speaking of which, I've opened up a Facebook group for Chat with Traders, and it's totally free to join. So if you'd like to connect with other traders and listeners of this podcast, I'd encourage you to get amongst it. If you go to chatwithtraders.com/Facebook, that'll redirect you to the actual group. So just hit the join button and I'll let you in. Again, if you missed that, that's chatwithtraders.com/Facebook to join the free Facebook group. Also, another really exciting announcement is I've just released another ebook, which is also free, and it's titled The Comprehensive Guide to Trading Mentorship. Now, I often hear the question, how do I get a mentor? So I took everything I know about the subject and packaged it up into an ebook. It'll probably take you about 10 to 15 minutes to read, and I think it'll be really helpful to those of you who are seeking out a mentor. And when I say a mentor, I just want to be clear on this. I'm not talking about coaching or education, education providers. I'm talking about genuine mentoring. So to get a free copy of this, just go to chatwithtraders.com/mentor. And again, in case you missed that, that's chatwithtraders.com/mentor, MENTOR. Now, just before we jump to the interview, I will point out some of what you hear from Rob may contradict what you've heard in the past. So I just want to emphasize that it's really important that you do make your own mind up for what you believe to be true about markets and, of course, trading. Anyway, here we go. I'm Aaron Fifield, and here is my guest for episode 72, Rob from Discovery Trading Group. Rob, what's going on, man? How was your weekend?
Hey, Aaron. Real good. How about you?
Excellent. Really good. It was a nice long weekend here, so bit of a break, which was nice.
Good.
So thanks a lot for taking the time to speak with us, Rob. I know you run a tight schedule, but I'm glad you could fit this in. Now, I'd like to give listeners just a little context. So we originally spoke a few months back. We were introduced by a guy who listens to the podcast who works in a prop firm in, I think it's Sydney, who is a very good friend of yours. Following that, we had a really interesting conversation. One of the things you continually emphasized throughout it was the importance of risk management and how to think about risk. A lot of people say risk management is important, but something I often question, and I presume many listening also question, is what does that actually mean? So we're going to tackle that, and we're going to get your perspective on the subject of risk, among many other things. But let's start at the start with your intro to trading. So Rob, tell us a little bit about where did your interest in financial markets come from, and where did you initially start out?
Boy, I'm not the youngest guy in the world, so it goes back a long ways. I guess I first got interested in markets, in a general sense, at least when I was an undergrad in college. I don't really remember the exact lineage of what happened, but I think there were two things that stand out to me. One is that I had a roommate who had a brother, an older brother, who had a seat on the NYMEX and traded crude oil. So I was really sort of fascinated hearing stories from him about sort of the secret world of the pits, and trading was very different in the 80s, than it is today, as you know. And the other thing was, for some reason or other, I don't remember exactly how it came about, but I started to get information or become interested in what some of the, obviously it was, directed from my, original exposure to my roommate's brother, but to what some of what came to be known as the long-term trend followers were doing in Chicago, specifically Bill Dunn comes to mind, certainly Rich Dennis and Bill Eckhart. Who else? Larry Haight, of course, on the New York side. But guys basically trading all of the commodity markets simultaneously, long, short, in longer periodicities. And I didn't know exactly how they did what they were doing, but I had my own ideas that I think stemmed from my own interest in games and game theory, specifically gambling and card playing. And so I think early on I started to develop some of the hypotheses about markets and what makes them tick, and more specifically what doesn't make them tick that we use today. So that's really the genesis of it all. And of course, the markets have changed drastically since then in many ways, but in many ways they're exactly the same.
Okay, so you came into this business inspired by some of the legendary trend followers that were around at the time, although from what I understand, you were never actually a trend follower yourself. Why was that?
I think early on, I don't really like the term trend following, and I have a really specific reason for it. I think people throw around terms like, well, this is, the market's mean reverting, or this market's trending, or this market has momentum. And what always seems to be left out of the discussion is periodicity. So I believe that you can't define even what a trend is unless you define for how long, or a mean reversion event or anything else. So I guess in a classic sense, I don't really believe in what was definitely the foundation of some of the early trend followers, which was that if a market is rising, for example, it's evidence that it's going to keep rising. I think that it's easy to inadvertently curve fit. In fact, I was just talking about this the other day with one of my partners, and we were talking about some of the early days in trend following, and it just so happened that in the context of the periodicity that they were trading, and in the mix of markets that they were trading, specifically in the grains and the softs and the hard commodity markets as opposed to the financials, in that classical sense of the word, those markets were incredibly trendy. It just so happenstance during the time that they really got a foothold. But it doesn't necessarily mean that their original thesis for developing those programs was correct. Sort of stacking risk is what I'm talking about, where whatever the market is doing, well, keep adding to it because it's going to keep doing that. It doesn't mean that at all, but certainly if it works out that way, that's nice.
Okay, so one of the things I'd like to ask you is that when you came into the industry, from what I gather, you really avoided some of the retail traps and a lot of the pitfalls that retail traders experience because you were predominantly on the professional side of the fence. So, I mean, was that a conscious decision, or how did that sort of come about? I mean, I know the whole environment and the industry was really a lot different when you came into the field. So maybe if you could just shine a little light on that.
Yeah, markets were very different in the sense, the flow of communication and how they operated in that latent space, so to speak. I guess the best way to answer it was that, I think when I think about the 80s and what it took to be a successful trader back then, or what was really going on, it really was kind of a secret world that you sort of had to have a way in. But by and large, if you got into that door and you looked at what everybody was doing, trading was really about watching what size was doing. The brokers that had the biggest decks of business, or the largest locals in the pit, everybody wanted to know what the guy that was going to push the most size into the market was going to do, because he had the ability to move that market in a very specific way. So, when you think back to those days, or just to the pits in general, you think about the information that the majority of traders were working on was just what you would see on the big board of any exchange today. Although obviously we all know the pits are going away, but today's high, today's low, yesterday's high, yesterday's low, contract high, contract low, the opening range, the volume, and the last 7 trades, prices, for the last 7 trades. And that was how you determined what direction the market was going in, for example, or how the market was trading relative to the opening range. And the rest was really just trying to ascertain who was doing what, who was stuck, who wasn't stuck, who was really motivated to lift offers or whatever. And it was just that kind of information trail, and it was done over the phone. So, things sort of progressed. We got into the 90s and up to December 2000, with the tech boom. And again, it was more about information. Of a different kind, but so markets have really evolved, and so I think people that were originally exposed to markets during those times avoided what I would call, or at least in our experience, what we see now as the typical retail trap. Is really born out of all the software packages and the ease of electronic trading and indicators, and everything sort of coming down to this pinhead where most traders think of a trading strategy or what they should be looking for, or where they're going to find that success, as how do I enter the market, only and exclusively. How do I read these various metrics or whatever that I'm looking at, to try to find the one best place to enter that's going to ensure that I win most of the time. And I think that that's the treadmill, as we call it, that most retail traders get on from the very beginning. And the vast majority of them, well into the 90% range, are unable to escape it. They never escape it. They keep doing something that another friend of mine calls method hunting, where they find something that makes sense to them, and they pore over tons of chart history, and they say, okay, this is what I'm going to do. This is how I'm going to enter the market. And they avoid, all of this stuff that really matters, which is, certainly the risk overlays, and, how they bet, and what their size is, and how they're going to adapt to volatility over time, all those kinds of things. And they're just focused on the entry. And when it stops working, it's sort of back to the drawing board. So to answer your question, I think it was pretty easy for people who were exposed early on, before any of that stuff existed, to avoid it. I certainly didn't avoid it. I just wasn't exposed to it until later. And thankfully, I had the previous experience to spot it as an issue really quick, and nip it in the bud before I went too far, down into the rabbit hole looking for Alice. So I was fortunate, really only because of my age and when I first became exposed to this stuff. So
Okay. Yeah, that's a really interesting answer, Rob. And that's, one of the reasons why I really wanted to bring you on the podcast is, this is one of the things you discussed in our prior conversation. So we're going to dig into this a lot more in just a bit. But I think this is probably a good point to ask you about. You mentioned that you didn't avoid it completely. You just experienced it later on. So what you're referring to there, I think, is when you actually attempted to hire a programmer and automate one of your strategies that you were trading. Can you tell us about how that worked out for you?
Yeah, it's kind of an interesting story. I was trading a momentum scalping strategy for a small hedge fund. It's in the mid 2000s. It's actually a commodity pool structure. And we had the idea that we wanted to scale it up and get rid of some of what we call the key man risk, meaning I'm the key man and it's me with my finger as a discretionary trader. And if you're just the semantics of trading with a mouse and being one guy doing it, you have a limitation to how much size you can trade in. And we were interested in scaling up this particular product. So we had what we thought was a bright idea at the time of seeing if we could replicate what I was doing via automation to other markets and even other sort of adjacent strategies. You're right. We hired a programmer, and a very interesting thing happened. What I had done was I had at least what I thought I had done is distilled the components of my strategy into something that could be seen with various indicators that would sort of capture the essence of what I was doing. And I was pretty convinced that it was quite mechanical what I was doing. Really convinced. I mean, enough to go down this rabbit hole. And what happened was we hired this really, really gifted programmer who has the added benefit of actually being a trader and being a successful trader, which is rare amongst quants, and at least good ones anyway. And he coded my stuff, and he kept coming back to me saying it doesn't make money. And I would just go crazy. I was arguing with him, saying, "What are you talking about? Here's the results. Here's the trades. I've been doing this." And he just said, "I don't know what to tell you." And at first, I thought it was him. Was he making mistakes? And I just wanted to know everything about what was going on to try to find out why it wasn't making money. And what I found out was what I thought was purely mechanical. Really wasn't mechanical, as stupid as I felt at the time. But I found out that these little adjustments that I was making, as a scalper, of course, to how I adapted to volatility in certain situations, certain trades that I would pass on rather than take them all. The risk overlays, maybe slight adjustments in size and things like that, had a drastic influence on results, and certainly discretion was, at the forefront of all of it. So it was a real eye opener to me, for sure. And that I guess is what I would qualify rather as a period where I had gone down that rabbit hole of trying to see the market as a chart, it became a very long project. Say, okay, well, if this doesn't work, well, then how about this? Well, if I'm doing this wrong, well, how about if we do this or we do that? And the next thing you know, you come out of the ether and you've spent, way longer on the project than you thought you were going to spend. So that at least made me smarten up and realize what the problems actually were so that we could fix them. But that was a big moment in me, or at least in my history of forming what are my opinions today about the best way to be what we call a single market intraday trader, and that's to trade with discretion, because all that stuff really matters. When you get into longer periodicities and blending strategies so you could benefit from strategy-based non-correlation and periodicity-based non-correlation. It becomes easier and easier to be purely quantitative or even non-predictive, as in the case of many of our other strategies. So that's really a big takeaway from that period of my life, for sure.
Okay, so would you put it down to the reason why that attempt to automate your strategy failed was due to the nature of that particular strategy, or was there something else to it?
No, it had nothing to do with it. I mean, it could have been anything. In fact, over the years, we've coded literally thousands of similar strategies. It's gibberish. I mean, it's just squiggly lines on the page. In any strategy, it doesn't matter whether it's a short-term quantitative strategy or otherwise. The intersection of a lot of moving parts is where the edge comes from, and it's never exclusively the entry. In fact, in most cases, in our experience, the entry has very little to do with success. So definitely the risk overlay, how you bet, and really understanding the nature of the strategy, whether it's supposed to be a high win rate strategy or whether it's supposed to be a strategy that operates naturally at the center of the bell curve, winning half the time but gaining its edge from a mathematical risk advantage. Betting $1, and then when you win, you're making $2 or more, but when you lose, you're never losing more than $1. You can be very, very successful winning 50% of the time. So, but you have to know, you have to understand the strategy, understand it from a more visceral standpoint. What are you trying to do? Is it the type of thing that you're going to win a lot of, or do you have to accept a lower win rate? And the truth is, a lot of retail traders, at least that we encounter, they just aren't willing to accept a lower win rate because it doesn't feed to the psychology. They don't want to experience any pain. That's why they keep looking for the one best entry that has a very linear success rate, wins 70, 80, 90% of the time. It never falters. It does the same thing all the time. It's very simplistic because it feeds that part of the psychology that really needs that. Human beings are always uncomfortable with risk. You're supposed to be, but it's really how you manage that. It doesn't mean that the only way to be successful as a trader is to have a high win rate, linear performing strategy. In fact, the vast majority of strategies aren't, and they never will be. And it's really a futile pursuit.
Okay, Rob. So tell us about how this, what do you call it? Maybe the rabbit hole that you went down as you described it. How did this pave the way for you launching a quant research and development firm? Because I find it interesting that you went down what you called the rabbit hole.
Yeah.
It led to a failed attempt, but it actually also led you into starting a business out of it. So
right.
Tell us a little bit about that.
Well, probably the simplest answer is I didn't want to fail. I took it pretty hard that I had spent all of this effort and money thinking that I could just lick this thing and we could accomplish everything that we wanted to do with that scalability and that particular product. And I just really wasn't willing to accept no for an answer. So I kind of had to go through all that to find out the best way is just to leave it alone and not attempt to do that anymore. Because what I thought would bear fruit wouldn't, and it didn't matter how many ways we pounded the square peg into the round hole. We were never going to beat it into submission. I think, interestingly, what happened was I kind of came full circle and went back to what I had told you earlier that I originally started thinking about when I first became exposed to, the early long-short trend followers. Just in the sense that for nothing else strategically other than the fact that they were trading all of the markets long short. And I started to think about what the application of game theory principles would be to that kind of thinking. And that's what gave rise to the quant firm, is developing a bunch of models that were longer term in nature, entirely non-predictive. The entry means absolutely nothing to the edge. The edge comes 100% from the risk models. So, volatility adaptive, trades 20, 30, 40, 50 markets, long, short, average time in trade ranging from a few days to years. So, it was really just, sheer will that I wanted to end up with something that was successful and marketable, and thankfully we got there. So
okay, that's really cool. That's really interesting as well. So, that's obviously one side of your trading. There's also the other side of your trading today, where you're still trading by hand. So let's talk about that a little bit. How are you personally trading on a day-to-day basis, and how would you best describe your trading approach or methodology today?
Right. Well, I'm what most people would call a pure scalper. Actually, I like to call it low frequency market making. I typically trade for a tick at a time, buy bids and sell offers, or vice versa. I do so exclusively in United States Treasury futures, mostly the 10-year. In certain market conditions, mostly fast market conditions, I like to trade the 2s as well. And I also spread basically 1-year strips in the 90-day LIBOR contracts, otherwise known as Eurodollars. So that's pretty much it. I know market making is kind of a mystery, I guess, to a lot of people, but I'm really classically reading order flow, both in the order book and the tape, to identify temporary inefficiencies, really not based on anything quantitative at all, but rather psychologically based. Where everybody traded, who's on the wrong side, and when they take heat, how will they react? That obviously combined with a million little details like book position and whether there's a presence of other participants in the market, and whether the book's particularly thin or thick, or icebergs present, or it's a really specialized thing. So, but that's what I focus most of my time on in terms of short-term discretionary trading. That, and I like to spread some of the commodity contracts, specifically intermarket spreading. So I like to trade crack spreads and spread the metals against each other, and those are typically like 1 to 3 day kind of time frames. But again, exploiting pure price inefficiencies, not no indicators or directional cues or MACDs or any of that kind of stuff. Just price and price action.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
Okay, so you said something really interesting there, that your strategy is kind of like a market-making strategy. Could you explain what that actually means to trade a market-making type of strategy?
Well, it's very, very short term. So it's I know we've had prior conversations about this, but I'm really set in my view that I don't really believe in predicting the direction of a market beyond the next tick or two, or I don't want to be really hard and steadfast about the one tick rule or whatever. But in general, it's just, if you understand what a market is and you understand how it operates and you understand that it's just an auction, then you have to understand that the deck is constantly being reshuffled, to use card parlance, right? Whatever your criteria is for entering a market, if you think it's a predictive criteria and it happens to work out that way, it just seems like you predicted it. So in other words, let's say you're a guy who likes to trade counter-trend moves, and the market moves down real big off the open and it reaches some market structure, and you say, well, I want to fade this level, and you get in, and then you're holding it for 2 hours, trading it back into the center of the range. The notion that whatever you saw or whatever was going on at the moment that you entered the market several hours ago has anything to do with you crossing whatever this arbitrary price is that you'd like to, scale your position out at or whatever, is really absurd, because every tick, every second, every market is constantly, the net of its participants are evaluating and reevaluating. Perhaps news hits the wire, and it makes somebody do something, and then because that somebody does something, other people see that little piece of price action, and then it makes them nervous about their position, and then they do it. So it's really, the butterfly flapping the wings effect, creates snow halfway around the world kind of a thing. So I think I'm really just speaking to my own beliefs about markets, but that's basically the reason why I like to make markets. In other words, step up and take the other side in what I think are advantageous positions. So somebody wants to be a really aggressive seller in certain spots, I'm going to step up passively and suck up those shorts and say, give me all you got, because what I'm hoping to happen is, now that they realize, maybe they do, maybe they don't, but if they realize that their short isn't going anywhere, they're going to start sweating and going, boy, this market had all this downside pressure and it doesn't seem to be wanting to go down anymore. What do I do? Maybe I should get out. And, so I'm basically wanting to take the other side of aggression. And when they're exhausted or nervous or tired or fearful, I'm immediately exiting into their reaction. So that's really what market making is about in general. But it speaks to how I feel about the viability of prediction beyond the next tick, which is that I don't place much. I should add, by the way, Aaron, that doing so in the futures market as a mouse trader is still possible. Whether somebody can do it in the stock market is questionable because of the presence of, you have 13 competing exchanges, maybe 70, 80 dark pools now. And the fastest participants, sucking all the edge out of the market via latency arbitrage. So, in the futures markets, certainly the ones I trade at least, we have the ability to trade one product on one exchange. So I never have to wonder what the price of it is somewhere else. So that certainly needs to be punctuated. I'm not sure anybody can trade for ticks as a mouse trader, trading the spiders, for example. Maybe they can. Maybe they can. Maybe they can't. It's beyond my experience. So I just thought I would qualify that.
Right. Yeah. No. And I imagine that's a really good point that you added on there at the end. So thanks for doing that. So what factor does volume have within your trading strategy?
It's everything. Not just total volume necessarily, but whether the volume is predominantly aggressive to the bid side or the offer side, and the cadence, as I call it, of that volume, whether it's coming in quickly or trickling in slowly, and how the market in the aggregate is reacting to it. And again, it's all really just code, for lack of a better word, or a window into psychology. How volume always precedes price, of course, and what that volume is and where it comes from is definitely rooted in fear and greed. So obviously, whether the volume is large traders or small traders, or whether it's machines, top of the book market makers, as we call them, they all play a role. So in finding those edges, inefficiencies.
Okay, great answer. Well, Rob, I'd like to zoom in a little more now to actually the subject of risk management. So let's dig into that. One of the things you said a little earlier was that entry is the least important thing for most people. And another thing you've said to me in prior conversations is it's the bankroll and risk management that truly matters. So could you just spend a few minutes to help us understand why this may be the case?
I think, we would probably go back to the core philosophies that I talked about earlier. And if we use a casino as an example, we embrace the idea of gambling. It's a dirty word to so many people, and in certain aspects of the industry, it's a really dirty word. Nobody wants to accept that when you're taking risk of any kind, that you're playing a game of chance. So a lot of the work that we've done in quant research has been aimed at treating markets as if they're random. They're absolutely not random at all. There's nothing random about markets, but very interesting things can be discovered if you start. You don't have to study them to the depth that we have, but if you start thinking about markets as if they're random, it can pave the way to kind of understanding how edge can be created through risk models. So if you think about a casino, and you think about a typical casino, they have a whole bunch of different games, with table games, and they have slots, and they have various betting limits across those games. And these are all games of chance. And I always say the word, I always bring up this analogy for gambling because I think it's really important. If you knock on 100 doors in your neighborhood and you say, hey, I'm doing a survey, what do you think about gambling? A very large percentage of those people are going to say, oh, gambling. Oh, gambling. It's a seedy, it's seedy, or, they conjure up the image of this guy down in his luck that, was, betted on black and was stuck in Vegas and can't get home, and he's living in a seedy hotel or whatever. And but if you go back the next day and you knock on the same doors and you say, sorry, I'm back again for another survey. How would you like to own a casino? Now all of a sudden, everybody says, well, yeah, and of course, it would be fun on some level, at least, if you could say to them, well, what's the difference? I mean, do you think that the casino isn't gambling with the player on every hand that they play or on every pull of the slot? Again, what we're talking about here is edge. We're talking about mathematical edge. Casinos lose all the time in various pits and in various games, and guys come in and they catch a run of cards and they beat them for 100,000, 200,000, $1 million, $2 million. Happens all the time. But they know that over time, that because of the edge that they've built into the game, in the case of the casino, it's actually the structure of the games, to a lesser extent the betting structures. Some of the betting structures benefit the players and so on. But at the end of the day, what they're really doing is grinding out a risk model. So a casino never has a meeting after a shift and goes, hey, listen, blackjack dealers, we got to do something about these hands. I mean, you guys are losing way too many hands. I mean, what would the blackjack dealers say if their boss said that? Like, what are you talking about? How can I control what hand comes out of the deck? So when we talk about, entries being the least important, at least, in the context of this conversation, that's what we're talking about. Your entry doesn't really necessarily have to mean anything. There's other caveats. I mean, you have to be diverse enough. You have to, there's other components to it. It's not realistically necessarily to trade, a single market, for example, intraday with very few occurrences, and expect to replicate an edge entirely from the risk model. You need to, have enough events. Obviously, the casino deals a lot of hands and so on and so forth. So all of those things matter. But that's really what we're talking about when we talk about math advantage risk management. Having the ability in a market is unique to set your own payout odds. No casino lets you walk up, to a blackjack table and say, hey, I'd love to play this game, and I'm totally comfortable with your 1% or less house edge or whatever it is, based on the structure of that particular game. But here's the deal. you don't even have to give me 3-2 in blackjack. Just any hand I win, you give me 2 chips, and any time I lose, I'll give you 1 chip. Well, of course, no floor man's ever going to give you those odds because they can't win, right? That's what I'm talking about. When in a market, nobody says to you that nobody tells you how to create your betting structures. So if you want to risk 3 points to your stop on some trade that you make, and every time you get out, you start to get nervous and you take a 1-point win. Well, your risk math is inverted, as we call it. So, you get a couple losses for 3 handles apiece. You're going to have a lot of 1-point wins that you're going to have to crawl back from in order to do that. But it's your choice. In other words, you can say, "Oh, I don't care if I have a 20% win rate, a 15% win rate, whatever. I'm going to bet $1, and I'm not going to get out or accept a win until I've made 8-1 on my money or whatever the number is." You're probably not going to like it psychologically, but it doesn't mean for a second that that's not the best application that's going to make you the most money. Typically, what makes you feel the best as a discretionary trader is never what's going to get you the money. It's always, we always say, being a trader in general, but especially being a discretionary trader, is about managing discomfort, and it never gets any easier. I mean, I've been doing this a long time, and I'm never comfortable about being in a trade. I'm never like, "Oh, I got this licked. I'm going to win this. I got this." I'm always nervous. I'm always skeptical. I'm always thinking I'm early or I'm late or I'm not making the right decision. It's just something that you have to settle in with and realize and make sure that it's not influencing, how you should react. And how you should manage your position or put on a position at all. So that's really what we're talking about when we talk about the importance of that stuff. But if you're focused on, when this indicator lines up with this, and that's where you think you're gonna make your money, it's not. And even if it is temporarily, if that kind of inefficiency exists in the market, it won't for long. So the market will eventually find it, and it will render it obsolete. So, you really have to be focused on how to manage your money, not only how to risk manage each individual trade, but how to not, it's not going to be linear. You're going to have to adapt to changes, in volatility, or even how the markets change and the way they move, and cadence, as we call it. And it's just something that you have to do. And most people that fall into that retail trap, they don't want it to be adaptable. They don't want it. They want the easy route. What's red light, green light? This lines up with this. This does this. I get long. I go to the beach, and a year from now, I'm just printing money. I mean, that's the dream that a lot of people get sucked into. And I'm sorry to say, but there is just no light at the end of that tunnel. Well, actually there is, and it's the front of a train. But that's really the truth.
So, I mean, in some ways, you view markets in a very mathematical way, especially when it comes to finding an edge and defining a risk model. I mean, what's your mathematical background like? How advanced is your knowledge on math?
I'm not a math genius at all. I'm not. Hopefully, by somebody listening to me talk, they've figured out that I'm not Goodwill Hunting or some brainiac from MIT. I'm just a street level gambler, basically, with an appetite for risk and enough experience to, school of hard knocks to know what works and what doesn't work. A playbook from my own bad beats, so to speak. So, and honestly, Aaron, the risk math that we use in our firm is absolutely elementary. There's nothing interesting about it in the least way. It demonstrates fully the simplicity of everything that we've talked about here in the last few minutes. Very, very simplistic application of payout odds and simplistic adaptation to volatility, gaining benefit of strategy-based non-correlation. Most people talk about non-correlation and they think they're talking about markets. which oftentimes markets are very tightly correlated or inversely correlated, meaning that you get no benefit from thinking about them as if you're getting non-correlative benefits. So strategy and periodicity-based non-correlation is a big thing of ours, very purposefully. And exploiting, and again, and this is where we make the distinction between what it is to be a successful scalper or market maker and what it is to be a successful longer-term trader. In our mind, those lines of division are pretty clear. Market making is about identifying an inefficiency and winning very often. Having a very high win rate. You have to risk a little bit more than what you're typically going to get when you win. So you have to have a high win rate, but it is a predictive strategy preying on inefficiency and psychology. So you're able to do that. And this is what I was trying to allude to earlier about understanding what your strategy is and what it wants to be. And don't try to put a square peg in a round hole. You shouldn't try to be a market maker. When I say this, qualified by saying you shouldn't try to be a mouse trading market maker competing against the machines, trying to win 50%, 50% of your trades at 2-to-1 on your money, because you'll go broke. You'll never be able to compete at that level in the top of the book trading for ticks. Most of the order flow in the markets, in our markets, in the futures markets here, it's all top of book market making flow. In other words, they are basically, I'm talking about the Citadels, the Jumps, the Get-Go's of the world that have paid a lot of money for speed efficiency and have a lot of risk capital to be able to occupy a lot of positions on the order book very, very early. So a lot of parked orders, and be able to make very quick decisions on whether to keep or fold those positions faster than you can blink by a long shot. So it's a different game where, somebody like that who is, a high frequency market maker really they're happy if they win 50% of their trades in a day, because the ones that they lose, they're scratching, so they're paying 9 cents to trade or whatever. And when they lose 9 cents. When they win 15.6250. So it doesn't take a genius to figure out if you even had a 30% win rate or a 40% win rate. And when you won $15, and when you lose pennies. That's a very viable model, but it's not a realistic model for a mouse trader. So not only from the trade cost perspective, but also just being able to be that quick and efficient in the book and get those exit prices that you want. So, conversely, you go to the other side of the fence, and what's a longer term strategy? Where can it live? It can absolutely live in that space where how can you be predictive? If you're going to be in, again, what we talked about earlier, if you're going to be in a trade for months at a time, again, how you got into the trade or whatever your criteria was for segmenting the market into trade events, as we call it, what does it have to do with anything? 8 months from now, this model says you get out here and you book your profits. So, it's a very viable application of what we call a mathematically risk advantage strategy to say, okay, I've got all of these occurrences. I've got a bunch of occurrences, and I'm going to keep my bet size low, or my, to my risk point, and I'm going to make sure my average winners are at least significant on some level, significantly bigger than a typical average loss. And so you're grinding it out. You're trading a lot of positions long, short in a lot of markets, and you're actually gaining the edge from that risk model. And this is very common. I mean, we like to say in the quant world, we definitely haven't reinvented any wheels. We just think ours are sporty, or maybe than some of the other ones that are out there. But this is all standard stuff. I mean, there's nothing really remotely cutting edge strategically about what we're doing. The nuts and bolts of the trading. It's really very, very boring. Simple application of standard deviation, statistics, game theory. On a very rudimentary level. So, but the world's I think it's important to punctuate again that those worlds are very, very different. And there's a big difference in how to apply those principles to a single market discretionary strategy, which is what a lot of day traders or very short-term traders are applying, to undertaking something like a strategy or multiple strategies that are trading 50 markets with 12 models long short. So you literally have hundreds of intersecting strategies and that are keying on different things and gaining edge from different places. It just isn't practical to trade, let alone take the time to and the financial resources to develop. For the average trader probably that's listening, that's an aspiring trader. So you gotta go with what's realistic, for what you actually can do, and really give some thought to that. So.
Yeah. Okay, Rob. Well, let's just round this off on the subject of risk management here. So, is there anything in particular that you've noticed amongst traders on a retail level that they often don't think about or consider when it comes to risk? And I guess lastly, why do they have a tough time being profitable?
I think a lot of people think that risk is. They say, well, I manage my risk. I use a stop loss on every trade. That's a common one. We think of stops as placeholders, for the most part, as a way to sort of define, your max risk on a trade. But it really, that alone isn't really a risk model. I mean, when we think about risk models, you definitely have to have those components of, striving to really understand what your typical average win is and what your average loss is. And these are very complex issues because some people trade all in, all out strategies. Some people scale out only, but not in. Some people scale in, but not out. Some people scale in and out. And depending on what the strategy is, all of these things can be different. But that's definitely a component that you have to understand, and you have to understand that is part of the risk model and not just using a stop on every trade. The stop to us just defines your placeholder or theoretical percentage risk on a trade. So in other words, you use it as a divisor to create your trade size. So if somebody trades, I don't know, they're trading one contract in the ES, for example, and their maximum stop that they ever use is three handles, right? So it's $50 a handle in the ES, so it's $150. Well, then you want to divide that $150 into your equity in the account and understand what it is on a percentage basis. So if you lose that trade, what percentage of your equity are you going to lose? And then so now you understand. So let's say it's 1%. So you're risking 1% of your equity theoretically to your stop point in every trade. Well, is that enough? Well, I don't know. How many occurrences are you going to have? How frequent do you trade? Are you trading 8 times a day? You're trading once a day? Or, how many over the course of a month? How many events or occurrences do you have? And how does that play into it? Well, now let's go to the win side of the equation. Are you scaling out? Are you not scaling out? How far, all of those things come into play. So you start to create this construct of kind of understanding that you're trading. So in other words, if you're sort of developing a risk model that's based on having a typical maybe 1, 2, 3 events max per day, trading this one market, well, you can't just all of a sudden start trading 20 times a day and think that it's not impacting it. And it's okay. I got my stops in place, right? All of that stuff really matters. And I think the other thing that we see is, again, this goes back to the psychology and the trying to mitigate pain, which is very common amongst humans in general. But trying too hard to achieve a linear result, or better yet, evaluating their prowess as a trader or the effectiveness of their strategy solely on its linear ability, to produce results. In other words, they go, well, if I'm winning 3 trades, every 4 trades I win 3. Well, on every single series of 4 trades, I want to have 3 wins and 1 loss. So it's like win, 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 loss, win, win, win. And I mean, I'm not even joking. People really, whether consciously or subconsciously, have stuff like that in their minds. And you have to accept things like starting to stop over analyzing every individual trade. Because again, like I say, the deck's being reshuffled. It doesn't mean anything. It only seems like it does. And any one event, any one trade, what's happening with that trade really has nothing to do with anything. So you want to stop analyzing, well, if I lost this trade, it must mean that I made a mistake. And if I win this trade, it must mean that I'm pretty smart, right? Unfortunately, a lot of people think that way. And the truth is neither is true. It's just you win some and you lose some when you're a trader. You have to become very, very comfortable with that and grinding it out, as we say. So we tell people, start thinking about blocks of trades. I mean, we say for a typical day trader, you shouldn't be analyzing anything statistically or evaluating your risk model until you've got a month's worth of trades. Because the idea of it's whatever happened today, you had 3 trades and you lost them all. Oh my God, back to the drawing board. I got to change my model. I can't believe I got fully stopped out on 3 in a row. This model's broken. Well, you don't know that. It's just, it's really inconsequential. But so it just, these things are what feeds the back to the drawing board, and they keep going back to drink from a well that doesn't have any water in it. And then eventually they lose interest. I mean, the typical, we've heard from some of our clearing firm relationships that right now the typical average retail account attrition is inside of 3 months. So the average person that gets interested enough in active trading to open an account doesn't last 3 months. So that doesn't mean they all blow up their accounts. It just means that for whatever reason, and a big number of them from the people that we've experienced and interacted with from that world are definitely ending up in that line of failures, not because they blew their account out or because they don't have what it takes to be a trader. It's because they're focusing on entries, hyper analyzing each individual trade, using that as ammo to quantify success or failure, go back to the well, try to create a new model, rinse, repeat, rinse, repeat, rinse, repeat. So that's it. I mean, in a nutshell, it's not, most of them never even get to the point of where we could have a discussion about what's wrong with their risk model or how to develop it better, because they're stopped in their tracks at that.
Okay. Awesome answer, Rob. That was a ton of insight there. Thanks so much.
It's pain. Trading is pain. You've got to get used to losing and not thinking that it means you're making a mistake. That's the biggest takeaway I can give.
No doubt. Solid advice. Well, one of the last things I'd like to ask you about is Discovery Trading Group. I know this has been a big part of your day-to-day interaction with the market. Now, give us a bit of an overview of what is Discovery Trading Group and how it's helped you, I guess.
Yeah. Discovery Trading Group is a happy accident. It really was an interesting confluence of events of how it came about, and it's kind of an interesting story. Some of us in our group are geographically dispersed, and of course, which is commonplace these days. And like many people, we communicated via the web, sharing ideas not only related to the quant firm, but also intraday trading. And so we had these blog spaces that we used privately, and one of our software providers had a lot of videos that had sort of explained, all the features of the software. But he said, you guys are hardcore order flow scalpers. It'd be cool if we did an event where you actually showed the application of these order flow tools, sort of nestled into what would be the shell of a real trading strategy. So we did. I did a series of 3 webinars for Market Delta. That's the charting platform. And Trevor and I go way back, the owner. Anyway, it was like a hit, for whatever reason, specifically the 3rd installment, which is the really nitty-gritty order flow stuff. It was just unexpected. We just had a deluge of people emailing us and asking us additional questions. So we actually opened up an area of this, one of the blog spaces that we had. We gave it a name, which again was totally arbitrary. It's not the name of a company or anything. we started interacting with other retail traders that were asking us specifically about trading price action and order flow, related to our short-term intraday stuff that we do. The interesting thing happened, at first I got really overwhelmed. I said, I don't know if we want to do this. This is crazy. We never set out to be trading educators, or, we never sold a course, or, did any of that usual stuff. We were just rapping with people, sharing our, the same plan sheets that we were trading every day, and, our levels and such, and different trades that we took during the day. And it was just very, very low key and very simple. And, but an interesting thing happened, and that's that I found specifically, and I know, my partner NJ did too, that as the time went by, it started to shift from being like a burden where, we're getting all these emails and people are asking questions and maybe we shouldn't have done this, to, man, we feel sharper than ever and we're trading better than ever. And what we found was that just the act of interacting with somebody who asks a question about something, or you're talking about a trade that you took, or whatever, it has this uncanny ability to keep you sharp. And as you're saying it or speaking, or you're typing something, you're doing that, it sort of points things out to yourself that you weren't thinking of, or different. It sort of accesses different areas of your mind and keeps you sharp. So it's something that we're really proud of. It's obviously we still do the daily plan sheets for the ES every day. I don't trade the ES anymore, but my partner does. I'm just in the interest rates. But traders, futures traders from all walks of life, trading, everything from the indices to currencies, to the interest rates, to grains even, and energy. And so we've kind of had the gamut. I think, what I would like to see more out of people is, I wish that I could impress upon people more the benefit that I've had from it, in terms of just the act of forcing yourself to interact, because not everybody wants to do it. Ever since the beginning, a very large percentage, often a majority percentage, they just want to get the materials. They just want to get the levels, so they know, where the cool spots to trade are, or whatever. Or they want to, maybe see some of the example trades, or some of the annotations and stuff at the end. Or they just want to we have a methodology kind of white paper that's on there for, that's been there for the members. And some people just join to get that. And we always say, like, you're missing the point, because I'm telling you, and I'm not exaggerating one bit, that every single person that has joined the site and has gone through the member journaling process, where we give everybody a journal space and we say, just get in here and start running your mouth. Anything that comes to mind. This is how I'm trading. This is what I'm thinking about for my risk model. I changed this. I changed that. I'm looking at this. And, just soliciting feedback and interaction, not just from the partners, but the other members, who many of which are very sophisticated traders and very successful traders in the industry. Just the act of doing that, we have watched every one of them have a light bulb go off. And at this point, it's 6 years now into Discovery Trading Group, and I can honestly say that in the tenure of the member forums, every single success story of the rockstar traders today, all without fail, were very active in that process. And they didn't just show up and get in other words, it's like you can tell, like the method hunters. Oh, great. This is like floor trading, applied to the screen. And they something pretty in a chart or something catches their attention, and they go, I got to figure out what this method is. And then they join, they leave, and, c'est la vie. But, the ones that really hang around and work it and realize trading isn't about learning a method and, okay, I'm in school now, I'm learning a method, and a month later I'm a pro and then I go make money. It's like, name any other profession that you are going to be a champion at. I mean, trading is the hardest thing in the world to do. It's why it's the best paying job in the world. The cream rises to the top. You're not just going to learn a method and be a rock star, and you've got to put the time in. And if you're going to put the time in, I'm telling you that if you interact with people, not just with us, I don't care who you are, you got to interact. It's going to make you or break you. And this used to be commonplace. I mean, that's, back in the heyday of the pits, we talked about everybody was on the floor, or, in the heyday of the prop desk, when all the proprietary trading operations, you had, 100 guys in a room, and everybody's interacting and talking about what they see and what the markets. And we've lost a lot of that in this electronic trading revolution. And another friend of mine says, don't trade in a closet. That's his saying. But, it really can be damaging. I mean, you just don't want to be alone with your charts, because, you need somebody to talk you out of being an idiot. I do. I mean, everybody does. It doesn't matter how long you've been doing this. It's a full contact sport, and it's a team sport, or I think best played as a team sport, where I talk about the markets all day, every day, and I'm not just talking about the blog. I'm not just talking about intraday, order flow trading either. I'm talking about other strategies, everything. I talk to 50 people on a daily basis. And a big part of my success is attributed to that. And but a lot of people, they just don't want to interact. They just want to get a method and clam up. And it's important for me to punctuate to your audience that, whether it's at DTG or somewhere else, I'm here to tell you, I've never seen anything like it. I mean, it's just those who interact and communicate, all of them are at least a profitable trader now, and some of them are absolute rock stars and hold very big positions in the industry. So, I don't know how to argue with that statistically, and I know that even for myself, that's been the case. DTG, I guess it's been 6 years now that we opened it up and started interacting with somebody other than ourselves, and I can honestly say I'm 5 times the discretionary trader that I was then, and by the numbers too. I mean, so I'm definitely evaluating my performance. So it's really something. I speak very highly of the power of that process. So that's what DTG is. It's one of our past members called it an elite dojo. I always thought dojo was kind of a cool term for it, but it's really just a community of hardcore market structure, price action, and order flow traders. People who trade pure price, and volume, and in the futures markets predominantly. Although we do have